2, baby. Check on 2. Mic check, mic check. That looks good. Reset that whole entire thing. Let's go back. Because that's not temp 2. God damn it. Let's get right into it here.
Not too much, but just a couple of things. You know, obviously.
One second here, boys and girls.
Voluntary request of documents from the SEC.
Save that.
Why? We don't know.
So that's
I still
wrong.
Don't know. Was it a whistleblower? Might have been. The company doesn't know.
Good morning. All right, so we've got a. Let me mute this here for a minute.
Now you can data mine the Edgar database, for example. You know, does.
Just a heads up for this morning that we've got. Let me move some of this over here. Hold on here. Move that slightly over. Just heads up for this morning that market looks like it wants to drop here. Or not drop necessarily, but it's got some gaps to close to the downside. A brief gap down on the hourly trigger on SPY at least. But I am cautiously optimistic into the end of the week here. Or at least into the, not the end of the week, but maybe into the 30th. Or at least if you can find a dip to buy on the 30th. Otherwise, it looks like back and forth slow drift to the right and down. But, you know, like yesterday, I was looking at the action yesterday in the market. It was brutal. So I think from my own sanity here, nice dip to buy would be nice. Good morning out there. How y'all doing? How you doing? All doing out there? Give me one quick second here. We got some stuff to go over before I have some other meetings this morning. So we're about to launch this website, and there's a ton of stuff that's background launch specific that I have to be available for. Hey, buddy. And I've got more of the same of that this morning. Give me one quick second here. Let me get the setup. Give me one quick second here. I got some stuff I got to do.
How mortgage apps are inflecting positive?
Yeah, I thought that this is one where it got up because of Lennar and Toll Brothers. And not
good morning. Good
right.
morning. Good morning. Good to see you.
I think you got to give it a day or two, and then you can come back and buy it because it was 282 versus 289. But the order missed.
Oh, we've got some format changes too.
Decrease, backlog down. Backlog's down 11%, but the orders, as you
Bork
say,
suggested
for 40.
yes.
My problem with selling a home builder is if rates are going down, you don't want to sell.
Members.
Jim, one name we haven't gotten to, I don't think, is J&J.
Oh, yeah, I'm ready for you. What do you need?
I just want to know what your thoughts are about the quarter. The stock is down a little over 2% right now.
Okay, medical device was very good.
Okay.
Pharma was very good.
I got to refresh the chat too.
To talc.
Right.
Not
the litigation
YouTube.
related to the
Moving into
accusations that talc is a carcinogen, essentially,
some of us
or that it included carcinogens.
Some of us were hoping that there'd be an imminent of a settlement. Instead, it's going to Texas. That's what's hurting the stock, and I know that they don't want to hear me necessarily say that, but I love J&J, but I did compare J&J to the Eagles. I just don't know what happened after the sixth game of J&J.
So you stay away?
Until we get a resolution of talc, yes.
Okay.
Because I fear the plaintiff's bar. The plaintiff's bar will come after me if I say anything negative. There's only one guy in the world the plaintiff's bar would not mess with, and that man is Dwayne Johnson. If the plaintiff's bar comes after him, he'll come right back, and believe me, they will rue the day they took on Dwayne Johnson. Oh, holy cow! I'm sorry, I didn't even know you were here.
Jim, while they get mic'd up, really quick on Bitcoin, you've been telling us the charts were prepping us for a drop, now below 39K. This is going to be coming off 20% down after the post-ETF highs.
They'll try to make a stand here. The problem is that the value of Bitcoin went up more than $400 billion in anticipation that there'd be a huge amount of money in. But net, the actual money's like about $1 billion. Very, very disappointing.
All right, so if you let me mute this again for just a couple things. I got to go over some.
I call it Number Down because there was a great book called Number.
Some housekeeping stuff. So I will be with you here today at some point. We have some changes coming up here on the formats. Yesterday afternoon, Bork had asked me if we could consolidate the bottom left-hand side of your screen down here. You know, you have the 2 or split level screens on the bottom of your viewing experience. So I've switched to a one screener that cycles every 60 seconds. This morning it's set for SPX, QQQ, and Tesla. If you would prefer me to every day, you could always ask in the stream. Start of the stream or something like that, and you're like, hey, this one ticker is standing out, like NVDA today is the ticker, IWM is the ticker, whatever it is. If you guys have suggestions for cycling through charts, see how that just flipped to the Tesla 30-minute chart? So this should stay on for about a full minute for you. They're all set to 30 minutes, but I can set them elsewhere if you like. And let's start with 3 tickers on this bottom side of the stream. If we can cycle in more, we will. There is an issue here. When I have original instances of TradingView running it really like hammers the performance from my end. It's working fine right now, but we'll keep looking at it and seeing. I might have to switch browsers to, like, Google Chrome will run in the background. I think Firefox might not run in the background. Like it doesn't tax resources. So we'll see how this works. If this slows the stream down or something like that, I'll try to switch to a maybe a different browser that isn't so resource intensive in background operations. Now, right now it's set to SPX, Tesla, and QQQs. But if you want it like to NQ or Apple or something like that, let me know. Just trade for my phone. Too funny. Anyways, these charts are down below. It should give you a somewhat better view or viewpoint. I can possibly even turn up the what you see here if you want. That way you can at least read all the numbers and stuff like that. I don't know. Let me know what you think. Let me see what this one's set to here. That's at 125%. Yeah, these are all at 125% now. I think yeah, it's all at 125. This might help you at least be able to read this stuff over here. I can turn it up larger too. Just let me know what you guys want to do. Let me see if I can yeah, I think that does it right there, but I'm not sure. It's pretty crunchy down here looking at this. It's a 30-minute chart on the Qs. It's kind of, I don't know. You guys got to let me know what you guys think of this. These are all 30-minute charts right here. At least you can see where these clusters are. By the way, too, Tesla. Oh, man. I don't know what to say about Tesla here. You don't want to... Oh, I just lose Tesla? Yeah, you've already heard my spiel here on Tesla. We had a failed breakout yesterday in Tesla. And there's a wall of pain coming down in Tesla right now. Sometimes we can escape this, but this stuff right here is not looking good. Let's see if I can do that. That's better. when this is a bear cluster, like this bear cluster right here, this monthly, daily, weekly, it's not going to be pretty. We talked on social media about wanting to see us trade that 233, 230 failed breakout yesterday. I'm really watching this ticker today, Tesla specifically, and it's even if it goes up, it's looking for whether this went up yesterday to test this cross or today to test this cross. Whatever rejection that is going to be can cause some real violence to the downside. It can get ugly. So I'll leave this one up today because this one's looking for the biggest action or reaction. I was talking to a buddy last night about my thoughts on Tesla, and it's right now where it's at. It's at a place where you have to parse your words. Well, be careful as to what specific things that you say about Tesla, because you can get a major squeeze out of this. But until it shows you something, it is setting up for some really negative news. I don't know what that news is for a major downside move. It's really, really bearish right now. So we'll find out. We'll see how this plays out. See if it squeezes. And what we're really looking for is that if there is a rejection above on that, all that momentum coming down on top of Tesla right now, if it does not escape that momentum, it's going to get ugly. And like I was looking at 165 and then I'm like, yeah, but we're already down there. When it's that close, I mean, sometimes we can validate that it's consolidation for a larger leg higher. But with that momentum above, that's where above that's raining down on Tesla, that is where there's a problem. It's one thing if all that momentum on Tesla was underneath, I would be extremely bullish. But where that momentum is coming down on Tesla, there's likely something we don't know that's really negative. Not guaranteed, but you want the inverse of that chart. You want that chart flipped upside down if you're going to start talking, if you're going to get serious maybe about Tesla being extremely bullish. If I had to guess, there's going to be some news on Tesla that is not good. If I had to guess, there's something coming out that we don't know yet. Yeah, no, this isn't earnings related. I don't know what it is. Or it's news during earnings that we don't know that's pretty vicious and bad. Let's go back to that chart really quick. You got to look at it from this perspective here. If this chart was upside down right now, if we flip this chart here upside down, I would be telling you expect some unknown, extremely good news for Tesla. They would drop some unknown news that's really good. At any rate, you can see this velocity down below at least. Watch this velocity down here. You really do want like minus 50 on Tesla specifically. So we're at minus 19. We're at minus 27 yesterday. So I'm still expecting that squeeze on Tesla, a bigger one than yesterday. Yesterday it squoze, but not like it should. So maybe today that comes into play for Tesla. I'll tell you what, man. I'm gonna tell you, like Tesla, that is not the chart that you want. It's not the chart that you want as a Tesla bull. Yeah, no, I know, I get it. I totally get what you're saying. Like, there's something there. I don't know what it is. If I was Tesla, the company, if I was an insider in Tesla and I had Elon's ear, I would say, today I'd be telling Elon, get out your worst news and have it ready to drop, because if you needed a moment to dump some bad news, now's the time. Which is horrible to say. All right, so on some other stuff here. Let me go through your levels here for you. Here's your pivot. Here's your S1 down here. This little mark down here, I don't know if I have that there still. I don't think I wrote anything in there. This is I don't know what this came from. This is supposed to be Just check this really quick. Yeah, this is the close. I guess S1 really is the only thing that needs filled. You had to fill something. S1 and maybe the closing price on Friday, but it's just this gap shit down here at S1 that I can see. Only this stuff right here. Like, that's mandatory. This stuff back here, we'll talk about that later. What they need to close that is to get underneath S2. S2 is kind of like the danger zone. You don't want to see the price of SPY below 41.38. 41.38, we start erasing shit. That over here for now. Okay, so now onto the other part of this. So we're coming into the 31st of January. We are about to launch a passion project we've been working on for, I want to say, at least a year, if not two. At least a year. We tried to launch last July. Oh, not July. I think September into December of last year. We wanted to launch a more sustainable version of what we do, and wanting to launch that version of what that more sustainable version. We couldn't proof a way to do it cheaply, where someone can support what we're doing. So right now, right, we are at a place where we try to keep out the bots on chat. It's like $5, right? We've got a Discord that is free and open to the public. That's not a good thing. It invites all kinds of shit into Discord. And we need to make this more, what we're doing here, more sustainable. And one of the issues we ran into originally was the price or cost to make that happen. And so it's taken us, I want to say at this point, at least since July, at least July of 2023, where we realized that we needed more done, and the development is finally coming to an end. It's done. We're testing right now in the background. We're actually testing this stuff so that we can launch a sustainable version of what we do. That's an entry-level price of like $20 a month, which is dirt cheap. We were talking about we're trying to get it down to like $5, figuring like $5 for the chat and then $5 for the Discord. And for all the data and the cost of everything, the cheapest version that we were able to get it to is $20. So I'm pretty happy at this point. There'll still be like a really super free one. Version where you can watch the show and that kind of stuff, but you can't get into the Discord because we have to charge to keep the scammers, the bots, and all that shit out of there. So we're at a place, though, where we are attaining that goal, and we're about to launch. Anyways, we're about to launch this shit on the 31st. And as we're coming into that delivery date, that deploy date, there's a monster stack of little things that are piling up and piling up and piling up and piling up. Just like absurd small things that have to be complete for that launch. Now, I know some of you out there are going to say something like, well, we're coming into earnings season. I'm here in the office all day long. I'll stop in at key moments. But there's always a fire, is my point. There's always a I don't know, a Fed meeting or an ER season or a holiday or something to say, hey, we need you here right now at this moment. This really, truly does free us from a lot of stuff and opens us up to being here all the time. So we're almost there. Keep be patient with us as we get closer. It's going to be super cool, and we're very excited with what we're launching here. that were able to meet that need for a regular retail trader, and especially a new retail trader, which was our original hypothesis, was to take care of new retail traders that need tools in their life, whether it's just a toolbox of information or a toolbox of, hey, I'm going to do these setups with you repetitively until you stop becoming or stop trading as a net loser at all times, that kind of stuff. So whatever. Anyways, I've got more stuff I got to do this morning. I got a bunch of Discord stuff going on today. I had some Discord yesterday. I had an attorney stuff in the morning, and then I had Discord stuff in the afternoon, and then today, or actually, we worked on the Discord last night. The main dev and myself were up until 2 in the morning last night, burning the candle, and I'm coming right back in again this morning to do a bunch of stuff for the Discord. There's like all this crap I got to do. So I'm hoping to be done with that stuff in the next coming days, and we're finalizing, checking off some membership level stuff, making sure that you have specific ticker choices and that kind of crap for you guys on the website. So I'll be doing that all day long today. Look at those buyers stepping in on cues this morning, just like ramp it, baby. And what else? I think that's it. So you'll see me here all day long. I will stop in and pop in throughout the day. And Bork, dude, I did what you wanted. If you're out there, Bork, Bork's been inside of Discord past couple days, dropping some hammers to try to improve the stream and stuff like that. So we will also be paying it. We got to do this. Why is that so high up there? Let me see this for a minute here. What's going on there? It's too high. No, so he's making suggestions on how to improve the stream. We always like to switch it up every 6 months or so, try out new formats, and so we're going to continue to try to make these streams better for you. All right. Blissowitz, good morning, brother. How you doing? Yeah, so the issue here is this. The Discord. Let's talk Discord really quick. Someone said the Discord's gotten really quiet. So the Discord, part of the idea here is this. The Discord, number one, it being open to the public, where I give you an invite and you can do whatever you want with that invite. We are a financial services Discord, so automatically, it's not like a kid playing a video game.
At 10 a.m.
You're a target for you are a target for very nefarious behavior.
With a range of -13 spot 5 to -15.
You're like a honeypot for scammers, basically bot scammers, you name it.
-11.
And we have to protect you. That's basically where we are. We've shaved off users, and we go in and cull users. At one point, we're at about 3,000 people on that Discord, and it was very active and great and banging and all that kind of stuff. But we've come to a moment where we have to transition and keep out the scammers and the bots. And how do you do that? You charge. You charge, and you run everybody through a website first. So instead of people just being able to click a link saying, hey, I'm in, what we do is we run you through our website to allow you into a safe place. So we're doing a roll at some point into a new server. It'll be the same server, but into a new server. The second part of that, too, is you're also going to be able to get you'll get more of me inside of the Discord from this point we make that roll. So you'll see more. You're going to see more interaction inside the Discord as well. More time spent in the Discord. So look forward to it. It's going to be cool as hell. And we've got some big changes coming. So that's coming at the end of the month or something like that. Yeah, there's no, it's not like, so I want you guys to realize, so I agree with you on that one there, but don't ever accept a message from me. You shouldn't do that anywhere on Twitter either. If I reach out to you on Twitter publicly and say, hey, I'm going to reach out to you via DM, that's okay, right? You find me on Twitter or something like that. The same thing on Discord. If you ever see me like talking to you directly in a room or a channel, and I say, hey, I'm going to DM you, you can answer those. But otherwise, just reaching out, that kind of stuff, you should never do. But the public Discords they're horrible, absolutely horrible. They're not horrible if it's like you and 100 of your friends or 20 of your friends doing innocuous stuff. It's really bad though when you start to bring in the thousands of people in any kind of free form. Matter of fact, too, a microcosm of that is when we first started this live stream. We first started by trying to chase all the Russian bots. Remember the Russian bots we had? We first started streaming for the first 6 months to a year. We had Russian bots everywhere. The moment we charged $5, it was like or free chatting through Amazon Prime. The moment you introduce 2 or 3 steps, the low hanging fruit, you're getting rid of all that low hanging fruit, that low barrier to entry to run scams on people. All right, so I'll be back with you guys in a little bit. We talked last week about the expectations for this week into the 30th, and that would be where tech trades range bound, buy the dips, sell the rips. Should be a good week for tech. S&P 500 should trade sideways and slightly down into the 31st. So we'll see if that plays out. I mean, this all looks extremely bullish to me and not that. But I'd like to see it happen first. SPY still trading sideways, not producing much. A little bit better action on Qs, it looks like, but still kind of subdued. And if you guys want me to change how this looks,
1 minute remaining.
let me know at some point. Just watch this the rest of the day. Let me know if you want to see a 1 minute chart on this stuff, or zoom out a little bit, or if you prefer to see it so you can read all this stuff. Let me know what your thoughts are on it as the day moves on, and we'll test this out and see how to make this perfect for you. Take a peek right there. Gamma flip is down here on the daily trigger.
Richmond Fed
4729.
Earlier than expected.
Take this Tesla one right here for you.
15 lower than forecast. -6.
Yeah, we should be good here for the day. We'll figure out. We'll check on this later and see if this helps you guys in your day or not. I'll be back later.
Good Tuesday morning. Welcome to another hour of Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla, David Faber, and bonus, Jim Cramer hangs around with us. Head of a big interview that we've got in just a few minutes with the CEO of RTX, Greg Hayes. We're live at Post 9 here at the New York Stock Exchange. Take a look at stocks right now.
No, Turkey, I'm not. I'm fine, man. Don't pay attention. We lead China. China never leads us, man.
Of 1% following, of course, the
not bearish at all.
That continued into yesterday. Got a number of sectors green this morning. Tech and communication services are on top. Energy's coming back a little bit today. Just healthcare and utilities under pressure. We're 30 minutes here into the trading session. Here are 3 big movers we're watching. GE under pressure despite better than expected numbers there after guidance comes in a little light. Shares hit a 6-year high just yesterday. United's in the green despite news yesterday that the company expects a quarterly loss of at least 35 cents a share due to the Boeing 737 MAX 9 grounding. United has 79 of the aircraft in its fleet.
Just a note here, Spoos has some form of a cluster here.
Planes at all until February. And then China stocks are rallying. China's security regulator says it will step up an injection of capital into the markets there in an effort to stabilize the market and confidence. More on that in just a moment. Actually, let's start there with China, because this had a powerful effect, whether Chinese stocks were oversold going into it. But the word is that they're going to spend $275 billion to prop up the stock market.
You know, that was a really good point she just made there. She said, you know, and this is to whose point? Turkey McNugget. So did you just hear what she just said, right? She said China's going to inject cash into their monetary system. And she said, and it's not like they weren't oversold there anyways. Key point right there. It's not like they were not oversold anyways.
And be on the bleeding edge of news for non-farm payrolls? Then sign up.
They should be embarrassed, and they should maybe look at themselves and rethink the way that they do business. Because I think that this kind of thing, Sarah, is disgusting and disgraceful. Wow.
Really? Disgusting and disgraceful? What if they came in and then,
we're treating it seriously.
Jim, what if they came in and just supported the economy in the way that many anticipate they would, and or that our Federal Reserve, for example, has in the past?
That
You'd be fine with that.
Because that's not manipulation of a giant market. I think that they should offer maybe a resolution trust for apartments. Maybe they offer, do a Keynesian economic package. But to point blank say, you know what, we're going to manipulate the market and take it higher, that's not what you do. Can you imagine right now President Biden said, listen, the stock market, it's not up much. We got this guy Trump. You know, take the stock market up.
Fed buys bonds. The Fed buys bonds.
Well,
they're in the market.
Well, there was a period where we wondered whether they would one day buy
stocks.
Yeah.
Jim Cramer's like, we don't want to do that in the United States. We do it all the time, brother.
How about why don't they help the companies? I mean, why don't they deal with reality? What are they doing? Do they have any? Do you think that's capitalism?
But it's not. But that's, so what?
Okay, so they're allowed to do whatever they want with stocks. Do you think they sit around right now? Do you think our chief economic advisor and Yellen are sitting down and saying, you know what, the sheet is down, let's get that higher?
No,
yes, Yellen is doing that, yes.
We're a capitalist country, market-based economy.
Yeah, but you see, there will be analysts at major firms who need a lot of
I like Bloomberg
coming from China, who will say this is the bottom, and people will believe in it, and our people will lose a lot of money, as they've lost a lot of money in Baba. They lost some money in Baidu. They lost money in BYD. They lost money in...
So we used to play Bloomberg on this show, and then Bloomberg started doing like pieces on shit that had no relation to the stock market. So we gave up watching Bloomberg here on the show. On days like today when I can't be here, we'd put Bloomberg on, and it was a disaster. They would just like randomly talk about stuff that had nothing to do with the stock market. So we're back to the CNBC again.
Really use their balance sheet to help industry, then you would buy the stocks because that could be beginning of a turn.
Yeah.
But they're just moving stocks up. Just reminds me how fraudulent their stock market is to begin with.
There was also a Reuters report that they removed the draft rules for video gamers, which sent those stocks spiraling. So maybe they're rethinking, I think, the tougher regulatory agenda there. Again, something necessary probably to bring foreign investors back in, which is clearly front and center and a problem for them. FDI, foreign direct investment, was negative for last year in China. First time we've seen that in a while.
Well, when are they saying that, listen, if you sell, we'll arrest you?
We haven't seen that yet.
Well, they had a lot of white-collar executions a couple years ago.
So, beyond China, the other big news story overnight that's moving the markets was the Bank of Japan. Most dovish central bank on the planet.
Well,
Bank of Japan Governor Ueda.
Now, this is who you want to pay attention to here is Japan.
That if the wage gains continue, service price inflation will continue. Here's the money quote. If we get further evidence that positive wage inflation cycle will heighten, we will examine the feasibility of continuing with the various steps we are taking under our massive stimulus program. So actually the yen rallied and JGB yields went up a little bit on this idea that, okay, maybe they'll hike in March or April. Still, they have not hiked rates, and they are still in negative rates. And that's partly why people have loved the Nikkei.
Look, we're about to see a wave of acquisitions coming from China that I think will shock us. I mean, from Japan. China should do it. I think there's probably a $15 to $20 million deal at work right now with Japan.
Really?
Yes.
With what, American companies?
Yeah.
Buying Japanese companies.
Japanese companies buying
American companies.
Oh, I think it's very much 89. I hope they don't buy the equivalent of Rockefeller Center.
I push back on this before I will continue to. I'm not saying that there won't be some deals, but there's not going to be a wave.
Okay, when it happens, will you buy me a steak dinner at Del Frisco?
Well, I look out for your health, so I will buy you some sort of vegetarian option.
Those are hard to get into, those places. They're candy. Try to get in there.
There's an animal spirits happening in Japan. We've covered it all last year.
Isn't it?
It's continuing into this year. People are really bullish. And Bank of America says investors, I mentioned this yesterday, are still underexposed to Japan.
It's been wrong.
And we wonder about the U.S. as well, and where we're going to get GDP. I'm excited for GDP on Thursday and also for PCE on Friday. Those are the big numbers. Because it's been tough to figure out what the consumer's doing. We're going to talk to 3M, for instance. Some of the end markets there on consumer and on electronics have been weaker. But then you talk to a Ralph Lauren, like I did last week. very strong demand. They're seeing, and he's optimistic for 2024.
And how about Cincinnati's favorite, Procter & Gamble, which finally did not say we're doing poorly?
I thought you were going to say the pride of Cincinnati, Procter & Gamble.
Well,
or is that Cintas?
No, it's Kroger. Look, I follow all of your companies, and I think they're important. And I wish the best of luck to Joe Burrow. But I do think that for once, Mueller understood, maybe listened to our show, and stopped talking about what was wrong and start talking about what was great. Because the company is a great company, Sarah.
Here's the thing. They've had a lot of price increases over the last few quarters and years, and consumers are now, that's it. Volumes have declined. Organic volumes have declined for the last...
Is that why beauty was so bad?
Beauty was bad. Healthcare was bad. Grooming basically saved the day,
right,
as far as the portfolio. So they can't do as much on the price increases, and volumes are negative. So they're not going to get the kind of growth that they were getting. Now, to your point, they're still getting growth.
Yes, they
and
are.
The commentary on the call was kind of bullish. They said people are trading up to our brands.
I thought that was fantastic. I thought that was fantastic. I am very proud of you and proud of Cincinnati.
Oh, thank you.
You're quite
proud
welcome.
of you, too. Appreciate the support for me and Cincinnati.
Well, you know what? I'm going to intrude further on your hour. I'm going to bring in Greg Hayes now. Greg Hayes, of course, CEO of RTX, and the stock is just screaming. I got a couple of reasons why, but I certainly want to hear from the man about why. Greg, I cannot believe this cannot really possibly be our last talk together, is it?
Be my last earnings release before I step down as CEO of RTX. But we've been doing this a long time together. I'm not going anywhere. I'll still be around as executive chairman for a while. So feel free to give me a call.
Well, I will. I was very gratified that today's all your releases and the analysts are not talking about the problem you have with GTF. It's one of these engines, which I think that a lot of people are critical of you, saying that you put a very low bar. It's going to be worse and worse and worse. In truth, Greg, isn't this one problem almost behind you and not nearly as bad as you thought it might be?
Well, Jim, I wouldn't say it's behind us. I think if you know anything about RTX and the way we approach these issues, we tried to put a number out last September that we thought would more than adequately take care of this issue. Now, it's going to take us a couple of years to get through with all the inspections and to get through all of the MRO activity. But what we have seen over the last few months is the shops are coming up to speed. We're seeing a lot fewer aircraft on ground than what we had originally anticipated. So we feel good. There's no surprises here on GTF, but still a lot of work to do. And give kudos to our airline partners who have stepped up and are working with us to try and minimize the disruption, given everything else that's going on in the airline market today.
Well, I was always hoping we could just be commercial because Collins was such a good deal, and you've made so many good deals to become such a force. But we have to speak defense. And I think we have to speak defense because when we do something right, it tends to be one of the programs that you're involved with. Can you tell us the state of Ukraine and what you could do to make it so that perhaps Ukraine could do better? Because I think you have it within your portfolio to make it so this is not a two-year stalemate.
Jim, it's really pretty simple what we need to do for Ukraine. We need to give them additional weapons to support their air defenses. We've put the Patriot air defense system in. We have put in the NASAMS short-range air defense. We've given them Stingers. We've given them Javelins, all of things out of inventory. But frankly, they're running out of missiles. Whether it's the GEM-T or whether it's AMRAAM for NASAMS, they need more munitions to counter this threat. And until Congress can act and spend some more of our hard-earned money over there, this conflict is not going to end. And I think that's the one thing we need to, as Americans, think about is the Ukrainians are fighting this war for NATO. And the only way they're going to prevail is if NATO and the U.S. specifically steps up to the bar and helps them fund what they need to prevent more atrocities in Ukraine.
Or what happens, Greg?
Well, I think as we've seen over the last year, it's going to be a stalemate. This is World War I trench warfare with drones. And again, the drones, pretty effective the way the Ukrainians have employed them. The Russians are starting to also employ them, though. So this is going to be a long, bloody stalemate, absent some significant infusion of additional weapon systems into the Ukrainian battle space. I'm not talking about F-35 fighters or anything strategic like that. I'm just talking about air defense missiles to protect the skies, to protect the people.
Now, let's talk about something that you have that if we could get more of, maybe it would help a lot of countries and also help shipping. Talk to me about the program called Coyote.
So Coyote it's an interesting weapon system that is in low rate production today. It's a small missile. You can mount it on the back of a pickup truck or an ATV. You fire it against a swarm of drones, and it can take on a drone swarm either kinetically by hitting the drones or through high-powered microwaves by simply knocking them out of the air. The issue with Coyote, again, at low rate production, we're talking 40 going to 50, eventually 100 a month. There's not enough of them. And what we've seen in Yemen with the Houthis is a constant barrage of, I would say, low-tech weapons. And using GEM-Ts at $1 million a pop or using SM-6s at $5 million a pop to take down $10,000 drones, that doesn't make any sense. We'll quickly run out of these very expensive munitions. So it's up to us, Raytheon Technologies, to ramp up the production of these, and we're working very closely with the DoD to do exactly that.
One of the things that I'm concerned about, it did not impact you as much as it did GE, but I think you're still having a problem finding people and still having a problem with inflation. I wonder if you're the Federal Reserve, you're listening to what you're about to say, and you're thinking, you know what, we haven't won against inflation. We have not created the workers we need to keep wages down either.
No, Jim, this is an existential problem in aerospace and defense today, is the supply chain cannot find enough qualified workers to meet the demand that we're seeing. Last year, we hired about 24,000 people within RTX, added about 5,000 net. We had about 19,000 people leave. We're fortunate, right? We pay at the very high end of the pay scale for most of these jobs. These are great jobs. But the fact is, there is still a lot of pressure on inflation. Last year, give you an example, we saw $2.3 billion of cost growth from our supply chain and from our labor base. That's about $800 million more than we expected. So the thought that the battle against inflation is over is, I think, misguided. I think this idea of cutting rates when you have 3.7% unemployment is also misguided. The fact is, we need more participation in the workforce, and we need to get wages back to a sustainable level of increase.
Well, Greg, it's David. How are we going to do that?
Well, I think we have to figure out, what happened to the 3% of the working force population that went away during COVID, right? We were at 65% labor force participation. We're at about 62% today. That's a big number out of 150 million people or so in the workforce. We need to find ways to get those people back to work. The good news, if there is good news, the pandemic aid is obviously starting to fall away. I think people will rejoin the workforce. The wages are good. And frankly, we're willing to train anybody to do any one of these jobs. We've got great apprenticeship programs. We've got partnerships with community colleges, state and local governments. We just need to get more folks back in the workforce, and that is going to be a challenge.
Greg, forgive me for this in a way, and to my viewers as well, but I remember a conversation we had a long time ago with you here regarding a potential presidential candidate at the time, whose name was Trump. It seems very, very possible at this point that he will be the president a year from now, at least based on current polling and expectations. I'm just curious as to what your thoughts are, what a Trump administration second time around would mean for your company, particularly given these theaters of war in which obviously you are one of the key suppliers.
David, we at RTX, we try and keep a bipartisan mindset in all of these things, because the national defense, defending democracy is our mission, really is a bipartisan activity. We can't choose sides between Democrats and Republicans. What I will say, in a second Trump administration, I think we have to continue to make the case why we need to fund NATO, why we need to protect our allies in the South Pacific and in the Taiwan Strait. And we're going to have to make that case with President Trump, if indeed he does come back, because we cannot pull back from these relationships. The Taiwanese depend on us, the Australians, the Europeans, everyone. And I think we just have to make sure that President Trump, if he does become president, fully understands the consequences of pulling back on some of these very, very long-term strategic partnerships.
Well, it's going to be a little bit of educational need there. Greg, this will be your last appearance. Now, when President Eisenhower completed his tremendous 2 terms, he gave a speech about warning us about the military-industrial complex. Have we now gotten too far? is the military, is industry so separate and military so separate that we actually need to talk about having a complex again?
Well, look, I think the fact is defense spending is around 3% of GDP today, which is close to an all-time low. And given the fact that we're in the middle of conflicts around the globe, I think we're going to have to rethink what our priorities are in terms of spending. Clearly, you know, recreating, as President Eisenhower said, this military-industrial complex is not what I'm talking about. But what I am talking about is having the wherewithal to be able to have a credible deterrence to aggression. And that means having the best technology, the best innovation, and the best people focused on that mission.
Boy, I sure hope people listen to you, Greg, because you have a strong view, and your comments on Ukraine should also be, I think, echoed in Washington. Anyway, look, I'm not saying I'm sentimental and we'll miss you, but I think you've always told it straight with us, and I appreciate it very much. Greg Hayes, the man who put together RTX, and by the way, Carrier, and by the way, Otis, all very successful. Congratulations on an amazing run, Greg. Good to see you.
Thank you, Jim. Thank you, David. Thank you all.
Jim, we'll see you tonight. You'll have Netflix to kick around.
Yeah, we got Logitech, which I think is very important because, remember, I think that there is a resurgence of the PC. Logitech's up a great deal before it went into this, but we're going to explore that situation. Of course, peripherals and gaming. Wow, what a show. Did a good show.
And then some.
Yeah, I mean, wow, I'm very proud. Thank you for letting me be on the Eisenhower. It's Eisenhower mentioned
You're
twice.
always welcome, Jim. Thank you. As long as we talk about Cincinnati companies only. As we head to break, here's our roadmap for the rest of the hour. Shares of WWE and UFC parent TKO surging on news. Dwayne Johnson is joining the board, and the sport coming to Netflix. Find out why he's so bullish on the business next.
Plus, Salesforce, Mark Benioff is weighing in on activist investors. We're going to bring you Sarah's exclusive, or at least highlights from her exclusive this hour.
And 3M shares under some pressure as guidance comes in light. Mike Roman's going to join us, talk about the outlook for the company when Squawk on the Street continues.
%50 off.
I'm excited, you know, and I'm always looking to grow. I like to say that I'm a builder of things and I enjoy building. Sometimes they work, sometimes they don't. But with something like this, everything that I do and everything that I do touch, there is usually, not usually, there 100% is a deeper meaning to it. So joining this board, I have been asked to join other boards in the past. Joining this board was unique and different and special in that, again, I'm sitting at a board that my grandfather and my dad helped build, and also helped building a company and growing it globally with a global footprint with a guy who I love and admire.
That was Dwayne "The Rock" Johnson. He joined us last hour with Ari Emanuel, the CEO of TKO, because he's joining the TKO board of directors. The company also announced that its WWE Raw will be leaving linear television. It's going to Netflix next year. Now, in a filing, they said the deal's worth a little over $5 billion over 10 years. A lot of different analysts and investors trying to figure it out. On our air, Ari Emanuel, CEO of TKO, said it was more or less in line with expectations, but that given Netflix's presence, that in part is accounting for a lot of the enthusiasm with which this deal is being met because of its global reach and the like. And that certainly can't be argued with at this point. Obviously, the importance as well of what was a property that was on linear, now going to streaming. Netflix has moved more deeper into live programming, also worth noting, of course, and the presence here in international markets, Canada, UK, Latin America, optionality as well around some other markets over the next few years, such as India and Australia, where they're unwinding the WWE network internationally. So that gets you closer to that $5 billion over 10 years, is what some analysts are saying, and again, and essentially de-risks much of the business, because there had been a fear perhaps the numbers would come in below and/or a deal would not be with as strong a distributor as Netflix. So you can see that. Of course, we're waiting on Netflix earnings after the bell as well. Subs there are pretty significant in terms of expectations, Carl.
Yeah, Citi today puts a bull case 135 on TKO, and that was written before the Netflix news came out today. So we'll watch some of the upside scenarios for that stock. In the meantime, after the break, an exclusive you don't want to miss. Co-founder, chairman, and CEO of Salesforce, Mark Benioff, sounding off on activists, AI, and a whole lot more in a moment.
Last year at this time, Salesforce was under heavy pressure by a number of activist investors. Though over the course of the year, many backed down as the company substantially improved profitability and the stock shot up. I sat down with Salesforce CEO Mark Benioff last week in Davos, where we talked about this. He didn't hold back in sharing his thoughts about that activist environment, AI, and much more. Have a listen.
I get a lot of calls from my friends who are dealing with activists. It's an industry, activists. And activist investors are number one investors. They want to make money. They love money. Maybe activist investors make and love money more than anyone I've ever met. So they're just money people. So I think you have to kind of get that set right away. They're not going to want to hear about all the things that you and I have talked about for decades.
Stakeholder capitalism?
No. They want to hear about capitalism, but they don't want to hear about anything else.
Yeah.
They only want to hear about money. And I think that's the first thing you have to kind of get your head around. And that's fine. You know, you can just say they're investors. And I think having investors is very important, and making investors money is very important. And then number two is that each one is very different. So each one of these personalities is totally different. And you know a lot of them.
Yes.
Like you're even calling me going, oh, let me tell you about this person. He's so nice. And
it seemed like it didn't
remember
seem
that,
like,
though?
Yes, I remember.
Yeah.
But it didn't seem like it got heated or
no, because
tense.
I
You leaned
actually
in.
like them all.
Yeah.
Actually, I have a lot of really good stories, you know, about, you know, these activists. Like one funny story is, activist said to me, you know, your hair could be a little better, and you know, you should call my hair guy. And I'm like, okay. And then another one's like, we're talking
did you do
about.
it?
I didn't do it yet.
Okay.
Do you think I should? I don't know. Does it look
I didn't know
bad?
that was part of their playbook.
I don't even know.
Your
But
hair's
anyway,
great.
no, thank you. And then number two is like one of them was super interested in meditation. And, you know, I have taught meditation and I enjoy meditation. I actually just did a half an hour meditation before I got here. It's like, will you teach me meditation?
Yeah.
And I'm like, I'll teach you meditation. And so I brought them to my apartment, you know, and I was doing a whole meditation, razzmatazz, and all that. And about 45 minutes into the meditation, the activist is very teary and crying, emotional.
Seriously?
And I'm like, it could be maybe a movie, really. And I think for a lot of them, you know, each one is different, and they all require something a little different, and that was a moment. And that was nice. And by the way, that was a beautiful moment. You know, that you can kind of go from a hostile situation where the first call is they all want to be tough, right? To the point where there's a tear in somebody's eye. Hey, that's what, you know how I am. I think dealing with somebody's heart is the most important thing.
This is
if
the
we can bring more
backstory.
love
Yeah.
to the activist community, then I'm all for it.
I mean, this is the story that we needed. And it's the
that's only two.
Because, like, the story that we saw
We had
is
like
that
6 or 8 activists.
you improved margins, you boosted the stock price.
Well, yeah, right.
Rethought some of the strategy. I mean, the one you're referring to is I interviewed Jeff Smith. At
We didn't
Starboard.
just improve margins. Our margins are up like over 1,000 basis points over like a year. Like it's crazy. Our margin improvement is phenomenal.
How much
awesome.
more is there to go on that story?
Well, I think that, you know, there's no finish line for anybody when it comes to margins. So that's a huge opportunity. It continues to be a huge opportunity. You have to, of course, you know, realize we're in one of the greatest moments of our life with AI. So if you are taking $1 into margin, you're taking a dollar out of AI research. So you do want to have the right balance. I think those things are important. By the way, everybody understands that.
That's part of my question, which is how you balance growth, which has been decelerating.
Sure.
And profitability.
Sure.
Which you're really ramping.
Well, we talk about deceleration, but our size and scale, I mean, on the absolute numbers, we're way bigger than anybody else's growth. You know, so people say, well, you know, growth is decelerating. Have you seen the numbers? We're saying that we're going to hit almost $35 billion in revenue this year, and we're the third largest software company in the world, second largest in Japan. And who else is at this size and scale in enterprise software? And I like it when smaller companies go, well, you know, we're growing a lot faster. I'm like, yeah, you know, we added your entire company onto our company this quarter. So that's, you know, growth is relative.
Mark Benioff, there's a lot more there. We got into AI, we got into social media. You can catch the full conversation in a CNBC Leaders double feature tonight. It's Benioff and then the CEO of UBS, Sergio Armati, at 8 p.m. Eastern Time, who's also got a tough challenge there integrating Credit Suisse with UBS. But Benioff didn't hold back. And wait till you hear what he says about AI. And also, he used the word, and I thought this was interesting, maybe not so surprising because he owns Time, but ChatGPT, OpenAI stealing copyright information in order to put it into their AI programming. So we went pretty deep on that subject as well. Excited for everybody to see it tonight.
I can't wait. 8 o'clock this evening. Looks great.
Yeah, that was some good. I like that color
like the
on the
activist color?
Yeah, it was just interesting trying to figure out who he was talking about.
Right.
But that was, I mean, obviously we covered it very closely. First Jeff Smith, then, I mean, it just went on and on and on and on. But to your point, it worked too.
Right. I think they're mostly all out, except for Starboard's still in.
Yeah, many of them may be out, but the margins got a lot better.
Yeah. Meantime, I think it was Morgan Stanley made CRM their top pick yesterday, effectively replacing Microsoft as those top picks expire. Meantime, I got some earnings names in the green this morning. S&P's holding 48.50. We're going to break it down with the former CEO of Truist in his first broadcast interview since leaving the helm in a couple of minutes.
Welcome back. I'm Courtney Reagan with your CNBC News Update. It's primary day in New Hampshire and voting is underway. Former President Donald Trump is hoping to solidify his frontrunner status, while former UN Ambassador Nikki Haley is hoping her strength with independent voters can lift her to an upset. Polls close tonight at 8 o'clock. A powerful storm inundated San Diego Monday as intense rainfall flooded roads and homes and swept away cars. The National Weather Service says nearly 3 inches of rain fell, and Monday became San Diego County's wettest January day on record. Nuclear bomb drama Oppenheimer, produced by our sister company, Universal Pictures, led the way in Oscar nominations this morning, securing 13 nods. Its box office competition Barbie brought in 8, behind Poor Things 11 nominations and Killers of the Flower Moon's 10. But Barbie director Greta Gerwig was noticeably absent from the Best Director nomination. The award show will be held March 10th. Carl, back over.
Wait, thanks, Courtney Reagan. Let's get to the broader markets and financials. Our next guest believes that inflation will continue to moderate and is, quote, quite bullish on the banks, at least. Kelly King, former Truist chairman and CEO, joins us now for the first national interview since retiring from Truist. He's currently a senior advisor at KSK Investors. Kelly, it's great to have you back. Good morning.
Thank you, Carl. Great to be back. Good to see everybody. Thanks for having me.
Yeah, a lot of water's gone under the bridge since we last spoke. I think 30,000 feet, most broadly, you think the economy is going to chug along nicely here, normalize in some areas. Talk about how you see the year unfolding from a macro point of view.
Yeah, Carl, so I'm clear that the economy is solid, is doing very well. And I think one of the reasons that it is a little bit misunderstood. If you go back through many cycles, cycles are created out of excess supply, creating a boom and then a bust. In '90, we had the commercial real estate boom, 2000, tech boom and bust, in 2008, residential boom and bust. But this is very different. We didn't have a boom. We simply shut the economy off because of the pandemic, which was appropriate. But it's taken some time for supply chains, et cetera, to normalize. And so when you kind of get back to going, you don't have an inherent excess of supply but demand. Therefore, the economy doesn't have to contract in order to allow demand to catch up with supply. So I think if you look underneath all of that, what you see is a good, solid foundation. There certainly are a few little pockets, but underlying the strength is strong and will continue.
We mentioned your optimism regarding financials. How much of that is going to be yield curve normalization, and how much do you think is going to be a return to activity in capital markets?
Well, Carl, I think the yield curve normalization will be certainly positive and additive for the financial space. Fee income, capital markets, mortgage income, all of that will rebound materially as rates normalize, which I fully believe they are on the cusp of doing. And so from a banking sector point of view, you're likely to see something like we saw in 2000. If you recall back in 2000 with the tech bubble, from 2000 to 2024, Fed funds dropped from 5.3 to 1%. Banks went up by 90%, while the NASDAQ was going down 46%. So this market is set up, in my view, very positively for banks and overall very positively for the economy. And I would say generally for the stock market. There are some areas in the stock market that are a bit exuberant, and that'll have to be washed out. But I don't think it's going to be enough to create a catastrophe in the market.
Kelly, it's David Faber. I'm curious as to why you don't share some investors' concerns about commercial real estate exposure, particularly office and particularly at regional banks, given the need for so many of these owners to refinance at levels that are simply going to be untenable for them. Hence, the banks may end up with the real estate. Why not a concern? Or if it is a concern, why not perhaps rise? Does it not rise to a level that would impact your overall view here?
Right. It is a concern, but it is a controlled concern, David. There's a lot of misunderstanding about the exposure in real estate and then the exposure in real estate in banking. First of all, the real issue in real estate is in large commercial office buildings. That's, by the way, not because of an excess supply, because of a dramatic reduction in demand, which is slowly coming back. Some multifamily. But look, here's the thing that you need to take into account when you think about banks. When I first started in banking in 1972, most of the loans in this country were held by banks on their balance sheets. That has changed dramatically. Now, a huge portion of the loans, especially large loans, may be originated by a bank, but they end up in the shadow banking system. So when you look at the average small bank, regional banks, and even the very largest banks, you don't find huge concentrations of very large office complex buildings. They're often syndications. And it's problematic for the aggregate economy, but it's not as specifically problematic for the bank. So I do worry about that, but I think it's going to be controllable because it's so dispersed outside of the banking system largely.
Kelly, finally, I got to follow up and ask where you think the potential is for maybe irrational exuberance in the market. We've seen some forecasts lately about what, for example, the forward PE of infotech and communication services might do in the years ahead.
Well, Carl, I'm a bit conservative, but I've been a banker for 50 years, so I guess I'm allowed that. But no, look, I think there are pockets of irrational exuberance. Look, when you get some of these companies selling at 40, 50, 60, 70, 80 times earnings, people don't understand what that means. If you pay 50 times earnings, that means it's going to take the company 50 years to earn back that stock price. And so it's irrational because what now is happening, in my humble opinion, is people are super excited about generative AI, which is good, but it's overstated. There's a common belief running around now that AI is going to change the whole world and it's going to do it tomorrow. That's not going to happen in my view. It is important. It is a very significant factor. It is not going to reduce human beings, and it will be additive. It will increase productivity, but it's not going to change the world.
Well, we try to be disciplined about giving viewers occasional gut checks on those multiples. Kelly, it's great to chat again. Hope it happens more often. Great to see you. Thank you.
Thanks. Great to see you. Have a great day.
Well, shares of 3M, as you can see right there, are down sharply this morning. This after there was a revenue miss, and Chairman and CEO Mike Roman is going to join us to break down the numbers and the guidance in particular that also seems to be giving investors pause.
3M shares falling sharply after a Q4 earnings beat. Revenue miss, though, as well. The company forecasting full-year profits below analyst estimates on slowing demand amid higher rates and inflation. Chairman and CEO Mike Roman joins us now for a CNBC exclusive interview. Mike, it's good to have you.
Yeah, good morning, Sarah. Thank you for having me on today.
Good morning. So what happened here? It looks like, so the organic revenue growth was a miss, and the guidance looks like some were saying was conservative or light. What are you telling investors?
Yeah, I would say, Sarah, there's a lot of discussion about the outlook for 2024. I would start with how we finished out 23. We had a strong delivery of our Q4. We improved our operational performance. That showed up in our results. We had EPS that beat our guidance and beat consensus. We had another quarter of very strong cash flow, double-digit growth in the quarter. And our revenue in the quarter was in line with what we had guided. The total year, similarly, we executed well. We delivered on commitments. We exceeded our guidance for EPS and cash flow, delivered 30% increase in cash, for example, reduced our debt by $2 billion. So strong performance. And we carry that momentum into 2024. And as we look at 24, we expect to build on that. Another year of strong growth in margins. And we will grow earnings. We will drive robust cash flow. And we'll see improving organic growth. The discussion was around how that organic growth guidance that we have for the year, 1 to 3%, excluding some portfolio actions, which is an important priority for us. So I would say we're building on our momentum, and we do expect a successful 2024.
Well, it is a little messy, and you reference this because you are spinning off the healthcare business, right? And that's going to be factored into the outlook in 2024. You have these big settlements coming when it comes to all of the legal issues. So how much of that is incorporated in here? And if you strip that out, what does it tell us?
Yeah, and you're highlighting, we have 3 priorities we've been focused on relentlessly as we came through this year, and we'll carry those into the new year. It's driving performance that I've been talking about. It's progressing on the spin with healthcare, and we're on track to spin out our healthcare business in the first half of 24. And importantly, to continue to make progress on reducing risk and uncertainty related to legal matters. And we've announced 2 settlements that we're also focused on taking to final approval. One of them here in early February, another one later in March. So those are part of our priorities as we come into 24. In our guidance, we guided for 3M as a whole co, if you will, with healthcare as part of 3M, and that helped us. We think it helps us show that continued improvement in how we're executing, showing our margin improvement. We talked about 75 to 100 basis points of margin improvement as we come into 24. Again, driving growth in EPS and improving revenue growth. So we did guide it as a whole co. The timing of the spin has an impact on how you would separate the 2 companies. It's not, you can't just subtract healthcare from 3M. There's other factors you have to consider. We spent a lot of time with analysts trying to help them walk through that. So that does make it complicated, but it's really a reflection on the things that we know are creating value, those 3 priorities. So focused on those as we come into the new year.
And then as for growth, Mike, is it just that some of your end markets, the consumer products and electronics and industrials are weaker than the broader economy? What are you seeing there?
Yeah, as we start 2024, I would say Q1 looks a lot like Q4. Q4, we talked about some of the dynamics we were seeing. We had some strength in our industrial businesses mixed in our industrial business in the U.S. and notably, we had a strong automotive OEM business in the quarter. We had soft demand in China and in consumer retail. We saw stabilizing in consumer electronics, something that we had seen a negative growth in as we went through much of 2023. So as we come into first quarter and we look at that, we see a lot of those dynamics continue. The automotive does flatten out. The build rates are expected to sequentially flatten out. We continue to see softness in China and the retail markets in the product categories that we play in retail, where we have products in discretionary product categories. So we carry that in. That's how we're looking at the year. There is an expectation that the macro improves as we go through the year, and that certain end markets will improve. But I would say we're starting out the year with a view of Q1 similar to Q4.
But Mike, as you said earlier, and it's David, you expect 2024 to be a good year. your investors seem to have a different view of what good means. I'm kind of curious as to how you would explain the deviation here. I mean, you got more than a 10% loss in your market value this morning. That being said, the stock had moved up sharply into this earnings, but still, your good and their good don't seem to be the same thing.
Yeah, I would say the focus, David, as we've been talking about, is on the guide for 24, and growth is part of that, and that impacts what you deliver in margins and EPS, and the EPS was certainly a topic as well. So I believe that we are, we'll grow those, we'll drive that execution, we'll grow as we go into 2024, and as the markets improve, we'll take advantage of it and deliver and leverage that for greater growth into our results. So I do believe we'll continue to make progress and build off that momentum, deliver growth. The market's reacting to the overall outlook for 2024, and we'll see how it plays out through the year. Again, we're starting with confidence in our ability to execute and drive that improving bottom line and cash flow.
Yeah, well, to your point, the guidance perhaps below what many investors had anticipated. You do seem to be more positive perhaps in the second half of the year. Again, I don't want to put words in your mouth, but I think I basically heard you say that, and I'm curious as to why.
Well, I would say the macro projections that we look at show improving as you go through the year. I would say end markets more than the macro. That said, we were in the same place a year ago. We expected the first half to be cautious, some of the challenges in the end markets that I've been talking about, and the second half was going to get stronger. We didn't see it play out that way, so we have been, I would say, as we come into the new year, we've been really focused on what we control, that execution, focused on what we know we can do. We do continue to invest in our growth. We invest in growth, productivity, sustainability as priorities. As we drive that execution improvement, we leverage some of that improvement into those investments. We are driving, I think, a very healthy pipeline for innovation, and that will help us grow in the most attractive markets that we're facing. As the end markets improve, as the macro improves, we'll take advantage of that as well.
Yeah, I was going to ask how you grow, how you can get top-line growth if we don't get the kind of GDP improvement that we need, or whether it's just that's what we should track.
Yeah, and that's an important. We talk about what we do. We use science, our technologies to make a difference in the world, and we prioritize investments in the most attractive markets. And we've talked about a number of areas that are emerging, like automotive electrification, climate technology, industrial automation. These are all investments for us where we see opportunity in our driving growth. Our automotive electrification portfolio is now a $650 million business, growing 30% in 2023. We also grow close to our customers. Our innovation starts with them, and so we're always building what's next for them. We look, our relationship with them allows us to see new applications, new penetration.
New applications, new penetration. Okay, so just want to show you guys this over here. Whoop. This came all the way down here yesterday for a brief moment, right, on Monday. Let me see if I can show you that. Came all the way down here, but left a little bit of this gap down here. So just don't forget that S1 down below there. Close this gap up. We do not, if you are a bull, you do not want to see us trade below S2 over here. It opens up a pretty big door to the downside. All the way down here, pretty bloody. And then you get all this stuff down here too. Oof. All that nasty down there. That's down at 473, pretty big. So there's not much holding us up. All like this will hold us or holdish us up, but you don't want to see us breaking down below this S3, this S2 kind of stuff down here. I would personally not on the SPX gamma chart. It's showing negative gamma below S3. But like there's more support down here than there is above. So, I'm going to assume here that any breaking of S2 is going to be pretty bad. You don't want to see that. Looking to be buying a dip down here if you are a bull on this hourly trigger. Don't forget that. We're buying dips on the hourly trigger. That's kind of what a bull does. And there is some room to go down here for a brief moment to come back up for the V shape. If you start to see like the breakdown and then the rejection, we start heading down, you break that previous low, look out to the downside. And I'm still in SPY puts, by the way. So I haven't even sold those SPY puts. I'm not looking to sell those until end of the month. Right there. Leave that right. There's that little bit. If you look on the if you look on Bookmap over here, there's this little like stink bit down here. This down below. Still nice downtrend right here, gorgeous. Leave that up right there. You can see that angle of attack. They're selling you right here. So we're going to look for that other sell point right there. The downside. Copy right underneath. All right. Yeah, you should see. So we were talking about this earlier last week. You should see like more downside on SPY than you would on Tech. Tech should trade like sideways and slightly up, versus SPY should have a little bit more capitulation in it than the Qs.
The US to sell $90 billion in forward bills on January 25th to settle on January 30th.
Good Tuesday morning and welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla, live from Post 9 of the New York Stock Exchange. Today, Oaktree's Howard Marks here on the unintended consequences of ultra-low rates with more than $180 billion in assets under management. We'll get his outlook for the Fed.
Then the straw that broke the camel's back. The CEO of United Airlines casting some doubt on Boeing. United a big winner today after results. We'll break down the state of the industry with the company's former CEO, Oscar Munoz.
Plus, he has one of the most in-depth looks inside the consumer. You'll hear from Jamie Salter, CEO of Authentic Brands, owner of names like Aeropostale, Forever 21, and Brooks Brothers.
Meantime, markets reacting, as David said a minute ago, to a bunch of corporate earnings in the industrial and the transportation front. Lost some gains, though. Dow's gone negative, down 140. S&P trying to hold 4850 here, just a couple of points below, as we look forward to more results tonight from Netflix. And, of course, the macro data heats up in the next few sessions.
High bar, I think, for these earnings, right? You saw the disappointment in 3M, even though it was a profit beat, and a 10% slide, because the setup has been so strong, I think, into some of these reports. One of the biggest drivers of the market's rally here to new highs has been the Fed and the many years of ultra-low monetary policy. But that era has come to an end as rates have been rising. So what happens now that we're moving from an ultra-low rate environment to what our next guest says is a more normal one? Joining us here on set is Oaktree's Capital Management co-chairman Howard Marks. It's great to have you here.
It's great to be here, Sarah, Carl.
So you have done a lot of writing lately. I read all your memos about the ultra-low interest rates as sort of a setup for where we are now. What's the big takeaway?
Well, you know, the Fed took the Fed funds rate to 0 at the beginning of 09, kept it there until the end of 21 when they gave up on inflation being transitory. The rate was 0 for half that 13-year period, and I think it averaged about 0.5% over the whole 13-year period. So, you know, interest rates are like adrenaline. They're stimulative. low rates, and I think that the rates were artificially low, which meant that the economy and the markets were artificially stimulated. And after 13 years of that, people start to say, well, that's normal. That's the way it's always going to be. My belief is that it's not normal, and it's not the way it's always going to be. And if rates will be higher, but still not high in the coming years, then it seems to me that most assets will be worth less than they would in a low-rate environment, and the economy will not be as stimulated.
So where we are right now with these, I would say higher rates, you would say elevated.
Well,
higher,
just not high.
Just not high.
You know, I mean,
so
today's.
Is that where we're going to settle?
No, I think we'll settle lower, because today's, just as those rates were artificially low to stimulate the economy, today's Fed funds rate at 5.25, 5.5 is artificially high to cool it off, constrain it, but you know, one of these days we'll declare victory against inflation, and then the Fed will be able to bring rates down from this, I would say, emergency rate to something more normal. So, you know, I believe that over the next 10 years, the Fed funds rate, currently 5.25, 5.5, will average somewhere between, let's say, 3 and 3.5.
3 and 3.5.
Yeah.
Where do you think the neutral real rate is? Does it have a 3?
It's around there. That's why I'm picking it.
Right.
Yeah. You know, it's the kind of thing that we know it exists, but you can't find it. There's no place to look it up. People talk about 2.5. So 2.5, 3, 3.5. I think inflation will be a little higher in the coming years than it was in the last decades, largely because the gains from globalization will slow. And I think that labor is getting a little bit of the upper hand in this country today. So if inflation is 2+, and if you want to have a real Fed funds rate, then you would think that the Fed funds rate would be 3+.
The market's been all jazzed up about the prospect of lower rates and the Fed managing to avoid a recession, the soft landing, the immaculate disinflation. I think you call it Goldilocks in your report.
Yeah.
Well, can that happen?
Goldilocks is not my invention, but over the various points in my life, people have talked about Goldilocks thinking, which is to say, you remember Goldilocks? This one is not too hot and not too cold, just right. So, you know, the belief is inflation will abate. That means the Fed won't have to raise rates anymore. It'll be able to turn dovish and start cutting rates. That means we won't have a recession. And that means, you know, that the economy will do well and the market will do well. And the only trouble is, if you think about it, that's a compounding of positives. You know, and you have a half a dozen things there which you think will go well. Well, what if they don't always go well, or what if they don't go as well as people are hoping? You know, it's a funny thing. The Fed has the Fed consensus for the Fed is that there will be 3 rate cuts this year. People can impute what is implied by market prices, and that's 6 cuts. So people think the Fed will do more cuts than the Fed says the Fed will do. And what you know, is that right? Now, there's a lot of funny things that go on in our business. I was listening to you talk about 3M, one of my favorite companies. I followed it 52 years ago. And what you said was that people are disappointed, even though it's an earnings beat. I don't even know what that means in English, right? It was an earnings rise, just not and people had said the earnings will rise, but it didn't rise as much as people had said it would. Well, that could happen with the things we're discussing here.
You think the bar is set high now?
I think the bar is set high. I think that, look, every day people go to the market to do business. And it's a tug of war between the optimists and the pessimists. And when the optimists win, prices go up. When the pessimists win, prices go down. I think today the optimists have been winning for the last 14 months. And, you know, we've had a solid rally in the S&P. And because of the power of optimism. And when the optimism abates, or a few less people are optimistic than were optimistic yesterday, then things can soften. It's, you know, you want I'm a contrarian. I'm a value investor. I try to buy things when nobody else likes them. You can't say that today. Today, more people like them than don't like them.
But it sounds like you do think there is value in value names, in broader market structures than narrow. Yes.
You know, when I go on TV, people try to get me to say buy or sell. Most of the time, I'm explicitly not a market timer or forecaster. Most of the time, the market is in what I call the zone of reasonableness, at which time there's nothing smart to do in terms of trading for its own sake. If you want to own a company, that's a different story. But I want to increase my bet or decrease my bet. No. And today, I think we're in the zone of reasonableness. And, you know, it just doesn't pay, in my opinion, to say buy or sell, other than when the market is laughably low or laughably high. Then you can make these observations with a good chance of success. But in between, I think not, and I think we're in between today.
Well, what you are known, obviously, is for fixed income and distress. Right. And I do wonder if, first of all, where the opportunity is there, and whether we can get out of this without seeing a bigger, uglier distress cycle.
Our prime measure of distress is defaults among high-yield bonds. I started Citibank's high-yield bond department in 1978, which is when that world began. And the default rate over my 46 years has averaged about 3.8%. From 10 to 2010 to 2019, there was only 1 year that got up to the average, and the average was like 1, not 4. So again, artificially stimulated, defaults artificially suppressed. What if they move back in the direction of normal? What if the default rate for the next decade is 2 or 2.5 or 3? That will be much better opportunities for the distressed investor. We had a slow decade in which there just wasn't much to do. I think that when interest rates are no longer artificially low, the default rate will no longer be artificially suppressed.
And do corporate balance sheets or household balance sheets act as a suppressant on any rise in the default cycle?
Yes, they're not too bad. They're not too bad.
That 30-minute chart on
really
Q's looks gorgeous right now, by the way.
What really matters is individuals. You know, 18 years ago, there was about $1.5 trillion in outstanding debt of companies rated below investment grade. And today it's close to $5 trillion. So it doesn't take a big percentage default rate to produce a lot of dollars of distressed securities.
So this whole notion, I mean, there are some investors out there, Howard, that say Fed's going to start cutting rates. Typically, they cut a lot once they start cutting. They're bringing back unprofitable tech companies. Bitcoin's had a really great run. I mean, this whole notion that low rates are coming back, you think, I know you've said this, but just is not happening because of why? Because inflation's going to be sticky?
Because I think Carl talked about something called the neutral rate, which is neither stimulative or restrictive. I think that's where we should be most of the time. And I think that that interest rates should be the natural rate, which is a little different from the neutral rate. It's the rate that where interest rates would be if the Fed didn't exist. You know, if it was just people with money who want to lend it meet with people who don't have money but you have use for it who want to borrow it, and they negotiate the rate. That the result is the natural rate. It ain't 0.5%. And so I just think we're not going to settle there. And there are lots of reasons. Read the memos. OaktreeCapital.com. And by the way, they're free. Price is right. But you know, the Fed had to cut rates to zero to get us out of the global financial crisis, which was the worst financial episode of my time. And then they got into this jam of how did they raise them back up without annoying people and without causing a taper tantrum. And they never really solved that problem.
Do you think that the next presidential election this year will have a big market impact, and should investors be positioning one way or the other?
Well, you know, eight years ago, in November of 16, there were only two things that everybody, well, almost everybody was sure of. Number one, Hillary would win. And number two, if by some chance Trump won, the market would collapse. So Trump won, and the market went straight up. And if that ain't enough to convince you that A, we don't know what's going to happen, and B, we don't know how people react to what happens, then I don't know what will. I go so far as to say we have no idea.
Right. I was going to ask you, but there was a contrarian view at that time. It's hard to glean what that is right now at this point.
Well, the contrarian view, yeah, I think so. Yeah. You know, most of my friends are Democrats, the contrarian view. So the consensus is that they're worried that Trump will win. The contrarian view is that Biden will win. I don't know what it is from the other side.
Well, the good news, Howard, is we will hopefully talk to you many more times before
I took the labels off of the SPX. By the way, Qs look great right where they are. And I took the labels off of the gamma chart for SPX on the triggers so that you can see the actual gamma levels here. So we'll leave that as it is and see how that works out.
Now, plus we will hear from the CEO of UBS, his outlook for inflation and rate cuts. He had some really interesting comments about the markets right now as well when Money Movers returns.
Fed bids for 52-week bills total $2.6 billion.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%.
Authentic Brands Group, one of the biggest voices in the market on the state of the consumer, parent to brands like Aeropostale, Nautica, Forever 21, dozens of others, I sat down with CEO Jamie Salter to talk about consumer sentiment in 2024 when we were in Davos, Switzerland last week. Listen.
The world's getting smaller, for sure. Business is being done all over the world. You know, there's 4 big regions, Latin America, EMEA, Asia Pacific, and of course, you know, USA and Canada. And I think, you know, what we're seeing is there's still big expansion really in these international markets, China, India, Latin America, Middle East. So I think if you're a company that actually is well diversified, you're going to get upside, you're going to get that organic growth that you need. But I do believe that the U.S. is probably looking at, you know, a flat to, you know, possibly up 5%. But I don't think you're going to see huge growth in the United States this year.
Flat to up 5% on growth or on consumer spending?
On
business?
You know, organic growth, you know, from a business standpoint.
Why? What's changed for the consumer?
Look, I think the consumer, at the end of the day, I think really that value consumer is probably being hit the hardest. The middle consumer, you know, sort of, you know, middle America, I think they're doing probably okay. And then it seems like luxury is definitely taking a hit, at least lately. Now, you know, generally luxury people, they have a lot of money, so they come back pretty quick. But I think the value consumer is where we're going to see the biggest hit in America and possibly in other parts of the world.
How were the holidays? How did they stack up relative to other recent years?
You know, we were up a little bit in fourth quarter. The holidays were, you know, a little stronger than we all projected. But I think that, you know, a lot of companies probably gave back a little bit of their margin in order to make sure that their revenue lines, you know, were uptick.
And then you're seeing that sort of pain in the value consumer continuing into the year, but not recession.
Definitely not a recession, but I'm a big believer that interest rates are not coming down anytime soon.
Why?
There's no need for them. You know, we seem to be functioning as a country, at least in the U.S. and other parts of the world, with, you know, higher interest rates. And as long as, you know, we can function with higher interest rates, there's really no reason, you know, to take them down. And I think they got inflation relatively under control. So I mean, maybe they'll lower them a little bit, but I don't see interest, like, you know, going back to the levels that we had, you know, 3 years ago. But could we see a little bit of a dip? Maybe in the second half of this year. But we, you know, from our company standpoint, we're sort of projecting that interest is going to stay here for a while.
What are you seeing on the inflationary front in terms of your categories, apparel and shoes and accessories? Has it come all the way back down?
I mean, look, you know, we sort of look at inflation. Are we buying for the same price today that we bought for, you know, a year ago or 2 years ago? There's always problems. There's problems right now, you know, from shipping standpoint. You know, shipping rates have gone up again, you know, in the last couple of months with the problems with the war. But generally, footwear and apparel price points, you know, are relatively the same as what they were a few years ago, as far as the FOB costs.
I was going to ask if you're being affected by the shipping delays in the Red Sea.
I mean, definitely, you know, it just happened, right? So we haven't felt it yet, but my guess is a couple months from now, we'll start to feel sort of the pain of what's been happening, you know, over the past, you know, 4 to 8 weeks.
All of these kind of risks that you're talking about and slower growth, it's not stopping you from deal making. That's been very active right now, right? How many deals have you done in the past few months?
I mean, there's no doubt about it that we're still on the front of buying, you know, great brands at great value. You know, interest rates being higher, you know, should we be buying for lower multiples? I guess the answer to that question is probably yes. But because interest rates are where they are, it's putting an enormous amount of pressure on some really great companies out there that, you know, have to go for refinancing, and they can't get the debt that they've had on their books in the past because interest is 3 times what it was, you know, 3 years ago. So it's giving us, you know, big opportunities to go big game hunting. So we're looking at, a number of great consumer brands, not just in America, but also, in Europe and other parts of the world. And we're quite optimistic that 24 is going to be a very robust year for Authentic.
More deals coming.
More deals coming.
One of the opportunities you took this year has been, and we've talked a lot about this, the partnership and investment in Shein with Forever 21. How's that going?
It's going well. Look, we did the deal with them. We did it the back half of last year. So we can only make so much change for fourth quarter, for Christmas time. Wherever we did pop-up stores with them, with Forever 21, incredibly successful. Successful for Shein, successful for Forever 21. It's clear that they have a similar customer. So now that 23 is over, we are planning to open up a lot more shopping shops and also a lot more pop-ups with Shein, and also really, making the Shein website more robust with more Forever 21 products on their site.
Finally, you have a lot of perspective on the licensing, right? That's the business and copyright. And I think the other big topic of Davos has been AI. I'm sure you've been part of these conversations. And I do wonder about the whole copyright intellectual property issue around fashion, your business, and AI using that, and whether you get paid.
I mean, look, there's no doubt about it that AI, it's good, okay? There's going to be issues with it. There's going to be problems with it. Just like social media has had, issues and problems with it. They're getting in front of it. They're getting smart about it really quickly. So they're going to put lots of rules in place on sort of what you can do and what you can't do.
You can listen to the entire interview by subscribing to our Money Movers podcast. But we did talk about a number of things, for a company that is moving fast and has raised a lot of money. And I always ask him about an IPO, but they raised $500 million last year from General Atlantic. They've raised money from sovereign wealth funds. It's valued at more than $20 billion. Not clear whether an IPO is coming anytime soon, but they're doing a lot of the deals in the meantime. And I thought it was interesting what he said about the consumer, that we're handling these high rates pretty well.
Yeah, as long as real disposable income growth continues. Interesting to hear Procter today say they're seeing signs of trade up in the United States, at least.
I thought, which would benefit their brands and is very different than what they saw in the 08-09 recession, where the company was in a different place, but one of the telltale signs of the consumer weakness was that they were going down to private label brands away from those brands. So Salter echoing the kind of consumer strength. While in Davos, I also spoke with another big corporate leader, UBS CEO Sergio Armati. We talked a lot about the markets, the impact that rising rates and geopolitics have had on client behavior over the last year and a half. Listen to what he said about it.
There has been a huge shift in the last 18 months with rates going up. All of a sudden, both a short-term money market, but also bonds investments has become a more of an attractive asset class than we had in the past. And the uncertainties, particularly on the geopolitical front, has put a little bit of questions around clients' confidence. We do expect for this year still a fairly challenging environment. I think that the markets, in my point of view, is still complacent.
Dude, look how they're
central banks.
I'm watching that Q's chart, and they're just like touching the PP down here, right?
About the inflation coming down.
Watch them. I'm going to switch this Q's chart to the 1 minute chart here
in financial markets,
and just watch the this is the Q's chart down below. Look at them down here, just touching right here, almost a near perfect pin strike down here at 421.21. Kind of your place, man. If you're a bull, this is it. It's kind of it right here.
Tonight, 8 p.m. Eastern on CNBC as part of our
This
Leaders
back
from
to
Davos
the 30
series.
minute
We go
chart.
really
They're trying to
deep into the
pound through it right
integration,
now. They
but
want it. They want to get
how about
underneath
him
this.
saying the market's too complacent about rate cuts?
He's been pretty
They
vocal
are
on,
trying right
the
now.
risks of the private credit world. Obviously,
You've got
that's something you'd expect a
your
legacy banker to
velocity
say,
is
perhaps.
-3 right now on the hourly.
What the lessons were from that
on
shotgun
Qs.
marriage between Credit Suisse and UBS last year, where he was called off the
It
soccer
could break
field
here. You might
to
see a
come
break
in,
here. It's
come
possible.
back in as CEO.
This is
and
kind of
put
like
these
the last
together.
spot,
What
though,
kind of
right?
hard
If you're a
work he still
bull,
has ahead,
where you buy the
including
dip on Qs.
more potential layoffs.
That's going to be great. 8 p.m. tonight.
Thank you.
Later on this hour, look at United and how the grounding of the Boeing 737 MAX 9 is going to impact the current quarter with the former CEO, Oscar Munoz.
Plus, Carl mentioned P&G. Mixed quarter, earnings beat, price hikes boosting revenue, but still reporting a miss. Plans to write down Gillette and restructure certain markets, narrowing the earnings outlook. Best day for the stock in nearly 4 years. In fact, we're back in 2.
Shortly expecting the 52-week bill auction, I'll lead with the high yield.
Courses.
European markets mostly lower ahead of Thursday's ECB rate decision, but it is China that's capturing investors' attention abroad today. Bloomberg reporting that the country is considering a 2 trillion yuan, or roughly $278 billion rescue package to help shore up Chinese stock markets. The funds would primarily come from offshore accounts of state-owned enterprises. The report is boosting the markets. The benchmark CSI 300 index, Shanghai Comp, Hang Seng, all up, still near multi-year lows. Also, some news out of the Bank of Japan, keeping its ultra-loose monetary policy intact for now, but the BOJ governor did say that the era of negative interest rates could end soon as higher wages boost sales and services prices. About 1/5 of investors see a March hike as possible. A majority of investors aren't expecting a move until April. A little boost for the Japanese yen there, but the China story is is interesting because it did seem to boost sentiment for stocks, commodities, everything tied to China. Question is for how long, and are they going to address the problems in the real economy, and will it work? I keep thinking about Jim Cramer calling it fraud.
Yeah, I mean, their hands are tied to some degree by the amount of property debt. It's not like they can just go willy-nilly on stimulus, but we continue to look at charts of China versus Nikkei, China versus the NDX, just completely going in opposite directions. Yeah. Let's get a news update this morning with our Courtney Reagan. Hey, Court.
Hi, Carl. Well, the Israeli army says 21 soldiers died Monday in the deadliest attack on IDF soldiers since the Hamas raid that triggered the war in Gaza. The incident could add to mounting calls for a ceasefire, as Israeli officials say they proposed a 2-month pause in the war in exchange for the release of hostages held by Hamas. Meanwhile, the Hamas-run health ministry said today 195 people died in Gaza in the last 24 hours. Defense Secretary Lloyd Austin made his first public appearance today since he revealed his prostate cancer diagnosis following a secretive hospitalization earlier this month. He participated from home in a virtual meeting with the nations providing assistance to Ukraine. And California State University faculty members reached a tentative agreement for a new contract after walking off the job Monday. 30,000 people went on strike in the largest public university system picket in U.S. history. The deal, which includes a pay raise, still needs to be ratified by the union. Carl, back over to you.
All right, Court, we'll check in soon. What we all know what tech has done over the past year, but is healthcare about to have its breakout moment as well? We're going to discuss that with Morgan Stanley's Sherry Paul after a break.
Traders pair Bank of England rate cut bets and see fewer than 100 basis points this year.
Halfway through the hour, get a check on the markets with our next guest, who says it's time to stop obsessing over recession fears and focus on finding value in what she's calling a new industrial revolution. Joining us here at Post 9, Sherry Paul, Managing Director of Morgan Stanley Private Wealth. And it's always great to have you on set. Thanks for coming back in.
Yeah, it's my pleasure.
Yeah, the running theme for your commentary is stop obsessing about things that might go wrong and maybe think about things that might go right.
Yeah, things I think are going to turn out better than people usually believe they are, and it takes a lot of effort to kind of snap out of a negative mindset. I mean, like the brain has to adjust to something new and exciting happening, and I believe we're right in the middle of it. And I really want to make an appeal to investors to stay focused on this thematic underpinning of industrial revolution, AI, innovation that's going to produce basically a productivity price, cutting enhanced bull market, which is a different kind of bull market than we've had in the past, which has been more expansive oriented, but this is like about productivity and cost reduction. So however those price to earnings ratios can expand, the market will take it.
So you talk about not a price to earnings multiple, but a price to innovation multiple?
Yeah, so I'm really trying to educate investors, maybe rethink about the word combination a little bit more. So we go price to earnings to price to innovation, price to PEI, price to earnings to growth. And it's worth it to pay the premium at this point because it's a very different kind of innovation market that we're in versus where we were in the 2000s. Where that was, new technology emergent without earnings. Here, we have the technology. We're now going from enablers to installers. And I think that companies that do that are going to be on the winning side of profits growth.
I feel like, Sherry, there's more an obsession lately with everything being good than everything being bad. Like, we've gotten over the recession thing, and now everyone's obsessed with the soft landing and lower rates and AI. And we're wondering if there's too much positivity.
Yeah, I love that. I love that you put it that way because too much of a good thing can be a bad thing. We know that consumer sentiment is often a contrarian indicator. Like last year, people thought things were going to be terrible, and we ended up with the market up 26%. So what I'm suggesting that investors do is go right down the middle of this market with an overweight in equities, extending bond maturities based on expectation for Fed cuts, and then to really break open the S&P and be very careful about sector selection, which is one of the reasons I'm recommending healthcare right now. It was one of the worst performers last year. Great dividend yield, relative PE, and a tremendous opportunity for vaccine innovation using new technologies.
That said, there have been some extreme losers and winners even within that space.
Yes.
Right?
Yeah.
So you buy it as a bucket, or how selective are you supposed to be?
Well, I wouldn't get too cute. It depends on how much money you have to invest. I break apart the S&P and use exchange-traded funds, the sector weight. But if you have the sizable portfolio that can endure single stock selection, it's going to be crucial to pick the right companies. I think that's true across the board, though.
You are looking for about 100 basis points of cuts, right? That's the house view.
Yeah, the
beginning
house
in
view.
June.
Yeah. Second half of the year, we probably see those cuts. Although I would expect that the Fed does a lot of jawboning, which they've done over the last 4 years, and they start to sort of test the market for the cuts by talking about whether or not they're going to do it or not. This has been a very chatty Fed in terms of leading the market, and the markets have reacted to that kind of like pillow talk from the Fed. So we'll see if they actually follow through.
I like that. Are you fielding questions from clients at this point about the election?
Yeah, thank you for asking that, because as we go into this election cycle, what I'm saying to clients right now is don't allow a political headache to turn into a portfolio heartbreak, because we really want to decouple political volatility from this opportunity of industrial revolution volatility that's occurring in the market. And so we know statistically that markets tend to kind of outperform after presidential elections. We've got a good setup in the current year. And so while I am talking to clients about how they may feel about the politics, we're focused on the math and science of investing in terms of constructing the portfolios and trying to get them to separate the two.
So don't do anything about it.
Well, I wouldn't trade your portfolio based on a party that you believe will be in power. because none of that disrupts the underpinnings of thematic innovation. It doesn't take away any of the AI trade, right? I mean, that really becomes more policy disruption, which takes years for Congress and the Senate and the president to sort of put together the sausage making. And typically that's in the planning-based area of the market, like for taxes and things like that.
Sure. Trade and tariffs and all.
Yeah, yeah.
Well, we'll have plenty of time to talk before we get there. It's great to see you. Thank you for coming in, Sherry.
Thank you.
Sherry Paul.
More layoffs at Alphabet and the continued search for revenue outside of advertising. That story when Money Movers returns. The slow drip of layoffs at Google continues, this time with cuts at X, its innovation lab responsible for moonshot projects. That's the focus of today's Tech Check segment with our Deirdre Bosa. Deirdre, what do we know?
Slow drip indeed, Sarah. It feels like we haven't gone a day without some kind of headline. But in this era of efficiency and AI, Alphabet may finally be taking a hard look at its moonshot factory. It is the latest to be affected by layoffs and will reportedly turn to outside investors to help fund its projects and easier allow spinoffs. Now, this comes after years of pressure from Wall Street and heavy financial losses. The Other Bets division lost more than $6 billion in operating income in 2022. on just over $1 billion in revenue. Activist investor TCI wrote in a letter a few years ago, quote, Alphabet's investments in other bets have been unsuccessful, and they called on management to cut losses by at least 50%. To be fair, progress has been mixed. X is where the company pursues things that sound undoable, but if done, could redefine humanity. Everything from self-driving cars to ocean preservation to internet balloons. Some projects have proved too ambitious, but others have gone on to graduate into Alphabet's Other Bets unit and take a bigger role within the company. There's Google Brain, for example, that was the deep learning division. It became the backbone of Google's AI strategy, merging with DeepMind in 2021. Waymo grew out of X as well and has autonomous cars now giving rides all over San Francisco. Google's core advertising business, often called one of the most lucrative and greatest business models of all time, it has paid for these moonshots for years. But this year, the cash cow could be coming under pressure. One, growth is slowing. Two, cracks are showing in the Meta-Google digital ad duopoly. And three, the DOJ, don't forget, is looking into its ad tech practices. That goes to court this year. And this all makes ambitious and costly side projects less palatable. It does raise the question, though, what business could offset a further slowdown in advertising? Something like cloud computing, that might make more sense. And every time I get on the phone with current CFO Ruth Porat, she reiterates her commitment to investing in cloud, guys. But this idea of how is it going to diversify away, it hasn't had to, but increasingly may look like it need to.
It's interesting, Dee. There was a commentary yesterday, I think it was the B of A desk, that basically argued we are still in a CapEx arms race, at least among the big Mag 7 or the cash-rich behemoths. Does any pullback on moonshots mean that CapEx is also at risk?
That's a good question. What it looks like so far, and this argument we've made before in regards to these layoffs, is maybe redirection, right? CapEx is things like infrastructure and GPUs to enable the building of large language models and this generative AI hype cycle. So maybe shifting towards that, and we haven't seen CapEx slow down. It's only required, this generative AI cycle has only required more. So again, maybe it's marshaling resources elsewhere. And that has been a theme. Even Senator Pichai's letter, I think it was last week, talking about layoffs in another division. He said that they need to focus, and generative AI is sort of the shift of a lifetime. So that's maybe where it's going. But it'll be interesting this earnings season to see across the mega caps how that's looking.
Yeah, I mean, I feel like the market won't forgive you for if you're cutting CapEx away from AI. But to Deirdre's point, you've got to reprioritize there, because as long as you're spending there, then investors will be good with it.
That's okay. Exactly.
Yeah.
Picking your battles. Dee, thanks. Great stuff. Dee Bosa this morning. In the meantime, United Airlines, the top gainer on the S&P, despite this first quarter loss due to the grounding of the MAX 9. Former United chief Oscar Munoz is with us in just a minute.
Attaining Insurance.
Welcome back. Shares of United jumping this morning after the company beat estimates on the top and the bottom line, though they are forecasting a first quarter loss after the grounding of the Boeing MAX 9. The CEO of United on our air this morning sharing some concerns about future deliveries.
We're now, best case, 5 years behind on the original delivery of the MAX 10. And as we've gone through the last year, internally at United, we've grown increasingly to believe that best case, the MAX 10 just gets pushed further and further to the right. So we'd already started working on alternative plans. I think this is the straw, the MAX 9 grounding is probably the straw that broke the camel's back for us. We're going to at least build a plan that doesn't have the MAX 10 in it. Now, we'll hope that Boeing gets it certified at some point, but we're going to build an alternative plan that just doesn't have the MAX 10 in it.
Boeing did respond to United saying, quote, "We have let down our airline customers and are deeply sorry for the disruption." They go on to say they're now taking action on a plan to improve quality and delivery performance. Joining us today, former United Airlines CEO and CNBC contributor Oscar Munoz. Oscar, great to have you back. Good morning.
Hey, Carl. Good morning.
Street's obviously focusing on the print, which is pretty good. It was leading the S&P at the open today. Are they underplaying the degree to which this is forcing the carrier to maybe build in some other planning?
You know, I think the markets are very efficient, and I think they see, hopefully, a track record at United, certainly, of making some of their plans come true, and they have a very ambitious growth plan. You know, I think that the company was very transparent with the impact in the first quarter and what it might be for the longer term. But specifically, I think the comments from the company were very upbeat. 24 is going to be a repeat of 23, which was, you know, above everyone's expectations. And so it's a pretty good team. I may know them, a few of them pretty well. But I think there's a lot of confidence in the leadership team.
Yeah, and some definite positive commentary on business travel and corporate. Kirby said it's taken a, quote, step up. I've seen some positive commentary on the credit card companies today because of what summer may bring in the way of international travel. Are you relying on that kind of backdrop for 24?
I think across all my broad business things that I'm doing today, I think generally there's again, and you just had somebody on, and we do talk ourselves into some of these malaise. And while there's clearly concerns and issues, there's a lot of money waiting on the sideline. People are expecting lots of things. Yes, it's a political year, and there's going to be all sorts of activity around that. But generally, the market, especially the middle market of folks, are back and certainly flying in the world that I live in. So I always remain bullish because that's just our nature. But again, it's just feeling stronger and stronger every day, even when you have these kind of hits, which an airline always has, right? It's like there's never a dull moment in this space.
On the Boeing, you know, Oscar, just hearing Scott Kirby say the straw that broke the camel's back, you know, there was a real frustration there, I think, and he was trying to be polite. How do you think this changes United and Boeing's relationship?
You know what, and he said it, I know it because I have the same relationship. We are very strong partners with each other. It is a great company with great people. They've hit some rough points, and all of that's got to get fixed. And of course, there's going to be some frustration and disappointment, but they'll come through. I think this MAX 9 issue will pass relatively quickly. The MAX 10 is something in the future. But again, it's a world where you have to move forward, and you know, our airline teams can't be sitting and waiting and hoping for things. And so this concept of developing an alternative plan that does not include those MAX 10s is I'm sure something they're working for. How they would do that, how effective that would be, it's yet to see. But you also heard him say, it's like, listen, we hope they come, we hope it's approved, and we hope they're ready to go, because it is a big part of it. But it's been a long wait. So the frustration has been going on for some time. And there will be some conversations and negotiations to some degree. But again, there's only two large people that do this for a living in this planet, and they're both behemoths, and they're both going to be around for some time.
Industry's obviously been watching M&A between Spirit JetBlue and the Hawaiian potential deal. I wonder on the Spirit JetBlue issue, Oscar, whether or not you think that changes the ability of the fare structure to change. I mean, the judge's opinion, this idea that JetBlue kind of lost its way as a discount leader, is that fair?
That's a big and broad question. So from a standpoint of the specific deal, JetBlue and Spirit, it is a shame because Spirit had a great deal with Frontier, much better aligned, their cultures, it would have been such a better deal, but share owners and the board decided to go with the more lucrative / more risky deal. And so that is a shame. The laws, Clayton Act, and the exact wording of that probably is due for some updating. I'm not a lawyer, but your point is exact. It's like, these two coming together would have been more of an impact on the competitive environment than airlines. With now potentially Spirit going away and losing all that niche of customers, I think that's more impactful to the general consumer. So there's a blend of updates that maybe need to do. Again, not a lawyer, but I personally think the Frontier deal would have gone down a lot easier than that.
As you say, it's such a complex industry, from safety to trade to consumer. We'll watch it in the months to come with your help. Oscar, great to see you. Oscar Munoz.
Thanks.
Talking some United today. Meantime, markets got the VIX back with the 12 handle as we get PMIs tomorrow.
We did lose a little steam from the early morning. It looked like we were going to rally at the open with the S&P. We've given that up, although we're back to the flat line right now. So kind of marching in place ahead of key earnings. GDP on Thursday, PCE on Friday.
Yeah, and look for Netflix and Texan tonight. Let's get to the judge.
All right, Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. Exuberance or exactly what the market should be doing and how it should be trading. We'll debate the state of stocks with the investment committee. Joining me for the hour today, Joe Terranova, Shannon Sakosha, Jim Lebenthal here, Post 9. Check the markets. We do have the Nas is green today. There's the S&P. Well, the S&P's barely gone green. Dow's red. Watching yields today, the 10 years at 4.15, so they've been backing up a bit. Maybe that's putting a little bit of pressure on stocks today. Shanna, I want to explore this question, whether there's too much exuberance in this market, as some are suggesting, some notable market people raising that issue. What do you think?
Well, I think the exuberance, that the signification of the question is really around the fact that we're at a new all-time high for the S&P 500. But if you go back to January of 2022, Scott, a lot of stocks in the S&P 500 haven't participated in this. And so does the exuberance really around the fact that the technology part of this trade is going to continue to build additional momentum? To me, that's not necessarily a positive, because what you're seeing right now is you're surely seeing a barbell impact. You're seeing investors go back to the things that they feel most safe in, that they're looking at these companies able to continue to grow their earnings, when a sizable part of the market that hasn't participated in last year's rally, where we should be allocating capital, maybe not as firmly in the camp of being able to grow their earnings. And so I think it's almost a little bit of a risk-off trade in my mind, in terms of what do you expect for the broadening out of the market, and are you going to get that? Well, this, to me, just seems like a continuation.
Last couple of days, I mean, the Russell was up almost 2% yesterday. So your point's well taken for the majority of the beginning of this year. It's still young. Last couple of days, though, today notwithstanding, last couple of days, you have had a return to some of this broadening. But on the idea that the market is just, people are just too exuberant right now. We mentioned what Ed Yardeni had written to his clients in the last 24 to 48 hours or so, talking about this exuberant melt-up phase. I want you to listen to what Cheryl Young told me yesterday, Joe, on Closing Bell. Okay. She of the Rockefeller Global Family Office. She's a private advisor. She also happens to be in the Barron's Hall of Fame in terms of wealth advisors. Here's what she told me. And she's positive, but listen.
I think the market is priced to perfection right now. I mean, we just hit all-time highs today, which is exciting to be on the show today. I'm a little worried. And the last few shows I've been on, Scott, I was very bullish. I was doubling down on tech the last time we spoke in October. And valuations are a little bit stretched, so things are priced to perfection.
Pretty, interesting view from a well-known wealth manager and highly regarded one. What do you think of what Cheryl told me?
I do know Cheryl well. I've worked with Cheryl in the past. Cheryl has been incredibly accurate in her assessment of the market over the last several years.
Is she right now?
So what she spoke about yesterday with you is utilizing the options market to hedge out some of the risk that she's seeing in the marketplace. Well, she's been writing covered calls against her positions to do that. But on her broad view, stick with me, on her broad view that the market is priced to perfection, do you agree or not? The difficult the difficult answer to that, Scott, is when you say the market, I'm having difficulty understanding what specific market we're talking about, okay? If we're talking about the S&P...
We're talking about the stock market.
Well, no, because right now you have complete
we're not talking about the
Wait, let me finish.
grocery market.
You have complete bifurcation in terms of performance. So you have to be careful when you say we're talking about the market. We began the show talking about this broadening out. Yesterday, the Russell was up 2%. Where's the Russell today? There should have been follow-through today. There was not. So, no, I don't think there is exuberance. I think there's exuberance as it relates to equities. I think there's exuberance surrounding monetary policy. Got me wound up. Surrounding monetary policy, okay? Because the exuberance surrounding monetary policy is expecting disinversion of the yield curve. It is expecting lower yields, and you're not getting that right now. So Cheryl is correct that the market is priced for perfection if you believe that you're going to get disinversion, if you believe that yields are going to move lower. Scott, if you don't get that, then the market doesn't belong here where it is. It's going lower.
Okay, so Howard Marks, right? Oaktree's Howard Marks, a legend in terms of looking at the markets and trying to decide where we're going from here. Talked about this as well within the last hour or so. Are things
one
really
second
as
here,
good
gang. I gotta stop
as the
in
market
briefly.
would have you believe by virtue of the fact that we are
I
at
got
new highs.
a.
Shannon, for
I'm gonna
those of you
set up
who
a scene here really quick. So I'm just gonna cut away briefly from the screen that you're looking at, and put something up here. Give me one quick second, okay? How do I do this? Give me one quick second here. I'm going to go to this screen right here, I think. Let's see here. I'm going to exit that right there. And go home right there. Give me one quick second here. Directly to viewers. I'm going to add display capture. Is it a display capture? Primary monitor. Nope. 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 That's kind of it. Cancel one quick second here. Shoot. Hold on one second here, boys and girls. Just see this here. There we go. Right there. That works. Mute this. Mute that right there. I think that works right there. Okay, we're good. Main screen, back to there. Sorry about that. Apologize for all that. You guys can hear me out there? Okay. At 12:15, Trader Podcast is going to show up to the show to give a market update. And as soon as I get him on here, we'll flip over to him and have him on for you guys.
So it's not all that expensive. But what I don't think we can say here, just to be clear, is that there's some trap door that's going to open up underneath the market the way it did in 2000 for technology stocks or the way it did in 2022.
Let's be clear, too. As bullish as you obviously are,
sure,
and have been, you're only looking for a 5% gain on the S&P for this
year.
Love
this. Love this. Can I just jump in?
Yeah.
Because yes, I am.
Yes, I actually want you to. Yes, I'm looking straight at you, directing this comment to you, inviting you to jump in.
Here we go. Because
just going to turn this off here and see if I can get Trader Podcast on here, maybe slightly early. Hold on here. Let's see what we can do here. One quick second here. Sellers relentless here, huh? In the half hour, you got the first half hour green bar right now. Q's coming back down to try to retest. you want to be watching the close here. So I want you to pay attention to this. Watch this chart that I've got down here, right? And you might be wondering why we look at the half hours. The stock market trades on the hour, and the hour begins on the 30 minutes, not on the zero. So whenever you're talking about stock market, you always want to be thinking about an hour basis and what happens at the start of each hour. So right here you've got the 11:30 hour, right? So 11:30 was the beginning of an hour, right? Then you've got the 11 or 12 p.m. to 12:30 hour. It's important in this candle, this red candle right here, that we do not get a new low. And this will show you a trend to the upside in half-hour candles if the bulls can win this second half an hour here. Give me one quick second. Trader Podcast, if you're listening in right now, I'm sending you a link to Google Meet via DM on Twitter. Let me see if he shows up here. I still haven't picked up. I refuse to call it X. I don't know why. I don't know if it's like a like, why don't I call it X? It's almost like it's just begging me to call it X, but I don't. So we'll see if we can get him in here. He can join us here in just a moment. Yeah, keep your eye on that 30-minute chart on the Qs. And you want to be watching that second half-hour candle to fulfill that hour. You want to see the strength of buyers and sellers, if it's bearish, if it's bullish, or if it's neutral. Yeah, it won't be an interview. Tension during this interview. Yeah, you guys, if you're out there listening right now, what you want to do is there's a few things here. If you're gonna ask a question of somebody on the stream, a big part of that would be, is it important, right? So a good question. Someone asks. So Momo's asking about Netflix, right? They have an ER coming up. You want to ask those questions. If you're asking a question about a ticker that's following the market, you may not get that question answered. When you're asking someone questions, it's always good for there to either be a market event coming up on that ticker, or that ticker is trading against the general market. Normally, you'll get an edge on the market that way, and it's something unusual that someone can answer for you. Yeah, Trader Podcast is watching the chat right now. By the way, Trader Podcast, I did send you a link to your DM if you want to pop on right now. We can do some. I want to make sure this looks good on the screen. So if you got a chance to pop in before we put people on. Oh, you are on? I don't see you here. I thought I sent you an invitation, but I don't see you as. Let me see. Yeah, I don't see you in the meeting. Did you already join? There you go. All right, don't say anything yet, Trader Podcast, because I think your mic is not muted on the show just yet. Give me one quick second here. Hey, Trader Podcast, can you just give a mic check? Just say check 1 2 or something.
Check 1 2. Check 1 2.
All right, so I've got you muted right now. Oh, hold on a second. I'm going to mute my microphone as well. All right, gang. So this is Trader Podcast joining us live here. He's going to give you a market update. If you don't know who he is, his name is Trader Podcast. We've had him on the show in prior streams, and he is a friend of the show, so please be kind to him. He's going to review the market with you, and if he has time, he'll also go over some other tickers possibly for you. So I know some of you guys are wondering about an ER for Netflix at the end of today, and we're going to add him into the stream here right now. Go ahead, Trader Podcast. Say what you want to say.
Hey, everybody. Good afternoon. Hope nobody's losing too much money on this theta day, as I see it. There was an opportunity to get out your MOC buys if you bought them yesterday at 4 p.m. and the MOC number came out to be more than 1 billion on the sell side. You can kind of see there was like that peak, and then we just saw. Actually, before I do that, let me explain what I'm doing right now. So what we're looking at is live options flow on the S&P 500 complex. All right. Now, the green line is 0 DTE calls. The orange line is all calls. The dark blue line that you see over here is all expiry puts, and the light blue line is all 0 DTE puts. So what are we seeing right now? As we look at this snapshot, what we are seeing right now is that there is about $760 million worth of 0 DTE call delta that came in today. We're also seeing about $868 million worth of all expiry delta that came in today. Now, if you subtract the two together from each other, about $100 million worth of delta is not dated for today on the call side. On the put side, this is what's really interesting. We're seeing that today's price action has primarily been driven by 0 DTE puts. Now, what's happening here is that we've had about $643 million worth of 0 DTE put delta. But if you look at the dark blue line, that says positive 8.19 million. So what that is telling me that even though there is put buying for today driving today's action, longer term, outside of today's expiry, puts are actually net sold to the tune of $658 million worth of delta. I don't know, that's probably like about the same in premium, because most of this stuff is closer to being 0.7, 0.8 delta at the money puts. So anyways, this is what's really, really interesting to me, is that right now what we're seeing is 0 DTE puts driving the flow, the show right now. And but longer term puts are the market, the dealers are net short put. So that's kind of supportive, just looking at the snapshot. So there's a couple other things we could look at. We could look at the implied volatility. So what this is, let me go to today's strike where we are right now, which is around the 48.50 spot level. And so what this is what's called a fixed strike matrix. And the fixed strike matrix kind of shows you what the implied volatility for that strike and expiry combination is at any given point of time. So what we're seeing right now is that all of this is red. All of this red means that the implied volatility at these strikes for these expiries is lower than what it was for what the average volatility was for that combination for the last 60 days. So right now, this is 1.029 z-score, negative z-score. So which means it's about one standard deviation away from what the volatility was on a 60-day look back. So generally, when you see a lot of low volatility, means there are dealers out there that are happy to sell puts into this price action. Now, when they're selling puts for a particular strike combination, they think they'll actually make money. Even though IV is so low right now, they still think they will make money on this. So this is what's called systematic underwriting. And what we're seeing right now is a lot of underwriters for tomorrow. So they don't think the market's going to go like that low based on just looking at this fixed strike matrix. What is interesting is this 2nd of February line that you see, that's all green. Now, if you think, what could be the reason? We have the FOMC speech coming up. We have PCE coming up, which generally lies in this general 31st to 2nd region. Longer dated, as you look, they're selling like down here. They're happily selling puts down here. Basically means that if you're trying to buy like an April 30th expiry 48.50 put, it is the implied volatility on that is 2 standard deviations lower than what it has been historically in the last 60 days. So looking at this, what I showed earlier, and then let's look at the IV term structure. Let's add yesterday, and let's add last Friday. So the T line is today's term structure of IV going out. And as you can kind of see, we are slightly elevated for the 26th than what we were like on last Friday. But generally, longer term IV on SPX complex, which includes SPY, XSF, and ES futures, all of those, like the IV on all of that is lower than where it was last Friday. So the gold line is higher. And this grayish cone, the bluish grayish cone that you're seeing on your screen, that is the range of the 90th to the 10th percentile of what the term structure has been in for the last 60 days. So again, very technical, but what this is like really telling us right now is that IV is going lower across all strikes, because, and when that happens, that basically means there's no fear in the market. Like, they don't expect us to like turn around and, gap down 1 or 2% overnight. Like, that's not what's expected. The market's not thinking that there's anything that could do that. So that's kind of like what the general market, snapshot is like. There's another thing we could kind of look at just within this chart. What we saw is now puts are starting to get like monetized. The 0 DTE puts, you see how this line in general kind of like goes up and to the right. It's the flattish or slightly uptrend. So that tells me that there isn't, too much fear in the market just for today. We have an auction at 1 o'clock. So this will be really interesting to see. And I think we're starting to see a little roll in the market because we're probably gonna see, like, let's see, TLT's Dixie. Dixie's up on a resistance line that I have right now, but Dixie has been fairly bullish. Now, if Dixie is bullish, that's not great for the indices. So this happens quite a bit to me, but there you go. With the trigger, you can kind of see that we're going back, trying to retest this 482.92 level that we had on the hourly trigger. So maybe we're going to go do that. But generally, from the options market perspective, now we see some more 0 DTE puts come in. We're seeing some calls getting sold off, getting monetized or sold off. But this is all kind of leading into that 1 o'clock where we are selling two-year treasuries. And we can look at what's happening with the 2-year right here in anticipation. The 2-year has been rising all day since bottoming at around 1:30 in the morning. It's been kind of going up steadily. So, but it still hasn't broken our previous highs yet at 4.419. So we're kind of like, everybody's kind of waiting. What happens with this auction? Now remember, a bad auction with a fat tail probably is not great for the indices. And when you're talking about indices, the thing that I would be really concerned about is what happens to IWM. So I have this big fat supply zone that IWM has been, kind of pushing into. This zone actually goes back months. So we've kind of, this goes back to December of 2021. So this has kind of been a fat, supply zone / resistance. We broke over it earlier in the year, but since then we've kind of come back and dipped back into the zone. So I am keeping an eye on IWM as a possible short if the treasuries auctions don't go well. Right now, I'm not super bearish IWM or anything. Like from an unwind and general moving pieces perspective, I would expect IWM to be one of the leaders. I think Cap has talked about that a fair bit too. Like IWM has room to run. We've never had the case where SPY has had an all-time high, the Qs have had an all-time high, and the IWM, the small stocks, small and medium caps, have been in a bear market, and they're still in a bear market. So I think this has room to run. I have an opinion on how I would like to play it. I would like to see a breakout of this big fat supply zone before a retest, and I'll buy that retest if everything looks constructive. That's what I would do. But right now, this is the ticker, which is going to be fairly sensitive to rate movements. So 2:00 auction, we'll keep an eye on it if I'm still on. Sorry, 1:00 auction, if I'm still on, we'll keep an eye on it. We'll see what happens. So with that being said, this is kind of, SPX in general. If there's anything in particular that you guys want me to look at, I know somebody had, okay, I see somebody's asking about FTNT Fortinet, I think, and somebody's asking about Netflix. So I can look those up and I can show you like what I'm seeing on Spot Gamma and the general thoughts are and how the chart looks. So let's look at Netflix. So this looks like this is bearish positioning today in Netflix. So what I'm seeing right here is that there's not really a lot of calls that came in today, right? And we've seen more weekly puts, about 21.64 million in weekly put delta. So that's next expiry. So that's Friday's expiry, and about 36.49 million overall in put delta being applied today. Now there's just as we are talking, there's a little bit of a kink in these lines. So somebody just put in some weekly calls, so we can kind of see that. But we can look at Netflix and just look at where all the options reside. Wow, that's an interesting looking chart, guys. Let me turn this off. Is this SPY? Oh, that's why. I was like, why does it look like this? What's going on here? Let's go. Okay. This is still a very interesting looking chart. So let me pull this up on. So Netflix right now, it kind of got some support around 483-ish. 481.5-ish. And it's kind of doing a V-shaped recovery. If you follow the trigger, it's going and testing the hourly trigger. There has been a bearish cross on the 30-minute and the 5-minute. Let's see if it holds and kind of slingshots up. You guys know that system. So I'm not gonna go into that right now because I'm not as good as Cap and probably some of you as you guys do this. So but let's go look at this. What's interesting. So right now Netflix is trading at 486.60. So this is where do you see this big, let me make this bigger because you guys can see that clearer. So at 500, do you guys see that big stick? That's all the call gamut that is in there. That means there's a fair amount of calls that are concentrated on 500 level. What we're also seeing is there is a nice buildup of calls up here with some puts in the money puts having are also present at higher strikes than 500. Now that's really important. If you're bullish, you kind of want to see like more calls above what I would call the call wall at 500. So when I'm seeing this, I'm kind of like liking that, 510 has good gamma, 520 has good gamma, 550 has good gamma. And in the middle, it's not a lot of like empty nodes. Of course, 490 has good gamma, 495 has good gamma, but then you see all of this puts down there too. Now, one of the cool things is like you see these lines that are coming down. These are basically think about it as ramps. So the steeper the ramp, the steeper the more attractive force in that direction, the price action will have, right? So we're about 486, so we're right about here at 485. But as we get higher, let's say we get to like 490 today before earnings, what you see is then there is more calls that are in the money. So there and more puts out of the money. So there's like a lot of Vanna fuel that comes from puts losing value. So dealers can, buy back the sold shares that they sold when they sold the puts. So, that's called Vanna. That's like a tailwind to equities because dealers are buying back those shares that they had sold. So you see that the orange line gets steeper the more towards, higher strikes, 525 we go. Like, so from here, from just eyeballing in from 490 to 500, that's a pretty steep drop off. So that basically means that the call gamma gets stronger and stronger, and we see like a higher preponderance to go towards higher strikes. Similarly, if you look over here, the steepest part is right about here from 485 till about 477. So, but then you kind of see the rate, the slope of this line is like lower, which means there's not a lot that's going to like push it very fast downwards. Now, this is very important when you come up on ERs. This is like if you see a structure like this, that's when you start like thinking about, oh, what's the ER move going to be like? If the ER move is upwards, right? Dealers can start selling those puts and they have to start hedging the calls that they had sold. So they have to keep buying. And that's why you get those like 30, 40% pop-offs. Like, because they just have, I'm not saying that's what's going to happen, but this is the kind of setup that you see where the dealers have sold a bunch of puts because, like they're just there, but they have sold a bunch of calls as well. And the ER is better than expected and what's been priced in, and dealers have to start covering the shares, and that's what like leads. The steeper this line is, the bigger the bounce is in after hours. So that's something to like kind of like think about. So this is what that looks like. But let's also look at, okay, so there's really no risk of reversal based on options positioning right now. And what we can look at here is how the expiries have gone. So currently, almost an equal amount of puts and calls are going to expire on Netflix on Friday. So if you're thinking weeklies, there's no edge there to play. But the options implied move as it is right now is about $13. So yeah. Yeah, Turkey McNugget. I just saw your message. Yes, I did buy Meta puts. I closed them this morning for 20%. So I closed my position today. What else? There was Fortinet. Somebody had asked. I don't know if it's on Hero, so I don't know if I have live flow or not. FTNT. No, it's not on here, but we can still look at FTNT on how the options positioning is done. What is it trading at? Because that's always helpful. 63.92. That's a big move overnight. Did it have earnings or something? What happened there? Interesting. I'll have to look into that. But let's look at what price has been like. So there's a call wall at 65, straight up. So that's, you have to be kind of, careful of that. Price is around $64 right now. There's a fair amount of people who will be looking to people, like, as it gets closer to 65, they'll be looking to, like, sell off their calls. Let's look at it this way. Yeah, so this concerns me when it comes to Fortinet, just because, so it's trading at $64, right? And you see this big stick right here. That's your call wall. But then you also have this right here with 60, which is like also has a lot of calls, but it also has a lot of puts. And I think that is a what is that? It's a key delta strike, and put wall is all the way down there at 50. So that doesn't really matter. But what this tells me, like, these are like fairly big, like almost twice as big as the stuff in the middle. So that forms a node. So these are nodes, and this is going to be a valley. So I don't think like there is a good risk and reward in going higher than 65 if I was an options trader, right? I also don't think there is good value right now going under 60. Under 50, under 60. So what I would think is that it's gonna like chop in this area, in this middle. Just from the options perspective, it might not do that. Just kind of need to think about it. And yeah. And even if it like shoots past 65, if it gets to close to 70, I would start seeing, like, I would anticipate, just because there's like almost like no calls in above 65 and 70, there's like just a little bit of gamma here. That means it would be like a squeeze and a fade as stuff gets monetized. So that's kind of what I would think about Fortinet. MS analyst, I guess. I don't know what that means. Explain gamma in terms of bull bear. Well, gamma is gamma. Gamma is the best way to think about that is it is the stickiness to price action based on options, because you, like, dealers buy and sell options, right? And you and I as traders buy and sell options. If why Fortinet is up today. I see what you meant by that. So let me a better way to think about that is like gamma in the market. If there's more gamma in the market, it is very sticky. It means that going up is harder, going down is harder. And probably the best performing trades are like, selling options, because then you can like kind of like sell a straddle or a strangle a few days out and collect data on it. In a negative gamma market, what happens is that dealers have to chase the trend, right? They have to chase the trend up or down. So it leads to range expansion. So in a negative gamma environment, you want to, if you're a vol seller, if you're an option seller, what you want to do is like kind of be able to pick a direction, or you sell something like condors or something, where the bet is that the price is not going to move too much, and you like bet against that essentially by selling that kind of option strategy. So the best way, there's better ways. There's like mechanical ways. There's like the calculus definition of what gamma is. But I think the best way to think about that is getting from somewhere, if you to know, like if you're in a positive gamma environment in market or a negative gamma environment in the market. I think that's more important than understanding exactly how gamma works, how it decays over time. It's not inherently bullish or bearish, but it kind of tells you like how much freedom a ticker has to move, or a ticker or a market has to move in one direction or the other. So hope that kind of explains. ASML. Yes. Okay. Yeah, I got you, bro. I think it's really funny that wow. So that's straight up. Look at that. It's weekly call buying. You guys see that? Like those green lines. There's about like $20 million worth of call delta that got put in for tomorrow's expiry. Oh, sorry, for Friday's expiry, and they've sold puts for this expiry, but somebody's bought puts longer dated than this Friday. So that looks like hedging behavior where they are selling, calendar, whether somebody's engaging in calendar puts. Like that's what the structure looks like in the market, where you're short puts on the near side because of heightened IV, and longer dated you're buying puts like maybe for like next week because IV is less, so you're just benefiting off of the put the IV on puts. You're just collecting that.
Just a heads up there. Sorry to interrupt. Just make sure you check in on the YouTube chat. It looks like they're asking a bunch of questions as well.
I don't have the YouTube chat. Let me pull that up.
I'll get you a link to it. Hold on. Keep doing your thing, Trader Podcast. You're doing great, by the way. Sorry to interrupt your flow.
No worries. Let me put this up here so I can see those.
Just 1 second there, gang. Just want to make sure he's still here. I might have lost him here briefly, but he should be back up in just a moment. Here, we'll switch back to the main screen until he pops back in, and wait for Trader Podcast to come back to us. Yeah, it looks like we lost him here for just a moment. As soon as he comes back, we'll bring him right back to the show. We do have some questions from YouTubers here. Let me see if I can bring them up here in the background. See what some of those questions the YouTubers had were. Hey, Trader Podcast. I'm bringing you back on here right now.
Yeah, sorry about that.
No worries. I don't see your screen at the moment. There you go.
See it now?
Yep. Yeah. Switch back over. Cap screen right. Or actually, let me move this. Give me just 1 quick second here. Move this out of the way. And I'm going to. Where are we at here? Right there. Okay, so you're back up and running again. Say something.
Can you hear me?
Yeah, you're good to go.
Oh, perfect. All right. I'm sorry about that, guys. I did something wrong. Anyways, this is ASML. That kind of looks, bullish from just today's options positioning. But let's go and look at ASML for. Okay, so that's really interesting. There is not that much call or put gamma where like in this, because these colors are very light. That's what that like kind of indicates. But the number of options being traded on it is pretty high. So let's go look at where we are on ASML. ASML, where does it trade? Hey, Cap, I can see that in your screen, by the way.
Yeah, I'm gonna list off some questions from YouTube for you.
Oh, perfect. Thank you so much.
Gotcha.
So ASML, It's kind of interesting. So this is a different indicator that I use as well. I use it in conjunction with the trigger. It kind of helps me see what price action is like, where like the pivots lay and whatnot. Where's chances to buy the dip, and if the trigger agrees with it, like it's a good place to to buy. So right now, what I'm seeing with ASML, they're kind of keeping it tight in a range. They're not letting it slip. The bulls kind of stepped in like right after the open, but the bears are also saying that, hey, you're gonna like stay in this little range that we've carved out, the maximum range that you've been trading in for the last 35 days. So yeah, this looks interesting. It kind of looks like 1 day, 2 day, kind of like eating away at that level. But there's a binary event. There is an ER, so we have to be cognizant of that. So price at 771 right now, and let's turn these off. So there is definitely a lot of calls at 800. And there is also, is that a call wall as well? Call wall is at 800. So that's your big first resistance. But that's what's interesting is also there's, a lot of gamma at 850 as well. And, it's not as much as the one at 800, but it's certainly more than what's at 790. So that you want to see above a call wall, you want to see like, as I said before, a good strong amount of gamma up there. But there aren't as many in the money puts. So that means there's not that much rocket fuel to go up. So the way this is set up right now, and this is also like, I'm going to say another thing, which is kind of very important to keep in mind. The way this is set up at 800 and it is set up at 850, this makes me think that the market is expecting a bumper ER, like a really, really, really good ER, where they're going to blow away expectations and guide higher and, like basically say that we are the next coming of Jesus or something like that. That's what that kind of looks like to me. If that does not happen, the MMs are very, very likely to take this all the way back. And where would they take us all the way back? Remember, we're at 770. That's a big strike. The next big strike is 750. So that's like a $20 drop. Now on a stock like this that trades at $750, a $20 drop is like what, like just over 2%. That doesn't really matter. But that's what's really interesting. But then you start seeing over here like 720. That's a lot of put gamma. That suddenly becomes more magnetic. And suddenly the lower it falls, you see there's all this blue stuff, this blue gamma. It starts increasing and you see like this slope gets steeper and steeper. So right now, where it is priced, just looking at this complex, this options complex, what I am seeing is a high expectations in the market towards ER, because people want to monetize the up end, and even on the bottom, the puts, there's not that much. So that's kind of really, really interesting to me. And right now it's just sticking to that 770 bar. So, 800 to the upside, that's where I would expect, a lot of profit taking, unless it just blows past it in ER. And then you're kind of like, oh, okay, how far does it go? But remember, there's between 800 and 850. There's like not that much in there. So, if it shoots up, it's going to be a grind up and then probably like monetization, and you start coming back again or rolling of positions, which takes away this inherent like call delta, call gamma structure that's there. The stickiness, the supportedness kind of goes away. So you can kind of see here, like in the orange line slope, it kind of like is the steepest, like between like 775 and 800, and then it kind of flattens out. So going up is going to be harder. Whereas if you start going to like, if you get a 760, this blue line starts getting steeper and steeper. So between 750 and 717 is the steepest where this blue line is. So that's something like I have to really think about. The expectations are high based on just the structure. That's what that tells me. And if you look at its fixed strike matrix for this next expiration, you see it's lit up like a green, like, I don't know, like green lantern or something. And what that's basically telling me, and if you look, like it's greener towards the upside, right? That means people are reaching for calls. That's what that really means. And how much higher is that? 8 standard deviations. Let's just look at 800. 800, the z-score is 8.172. So 8 standard deviations above where it's been. So that's really, really interesting if you really think about it. Like people are reaching for calls and dealers don't want to sell them calls right now. And they're charging more for their calls. That's why IV increases, right? Right, spot IV increases because at that price, the dealer's hedging is going to be more expensive if price goes up that way, or if like a lot of people want to buy that and the dealer is just like, man, this means I have to go buy shares right now from like dark pools or from the market, and I need to, like, if I'm selling this call, I need to have that as hedging, and this is however many delta, and that means I have to buy these many shares and it's expensive. I'm going to charge more for selling this call and to offset some of my extra costs. So that's why you can see volatility to the upside rise. I hope that makes sense. Please, in the chat, if you're listening, say something. Okay.
I know. I'm always like, say something in the chat, please. Blow up the chat, please.
Right. Let's look at Roku, please. Somebody said that on Twitter. So, yeah, let's look at Roku.
I just opened up the chat box inside of the on the screen here. I'm going to try to post it somewhere or push it somewhere that it can be seen here in the right-hand side of the screen for you, so you can see these guys.
All right, so this is a YouTube chat that you just put up there.
So I'm going to try to I'm going to refresh the chat right now and see if I can get the YouTube questions on here for you. Do you prefer the chat on the left or right-hand side? Any preference? Doesn't matter?
I think it right there where you had it. I think that's better.
Right down there, that'll work?
Yeah, I think that works.
Okay.
Just because I can kind of keep an eye on what I'm seeing. Oh, look at that, guys. This call's coming in. The 0DTE call's coming in. The overlap between orange and green lines means this is
we're about to rip,
flow.
dude. We're pretty close to having a squeeze here, a giant fucking squeeze.
Yep.
They won Bulls won the half hour or the past hour and a half on Qs. SPY might not produce as much as Qs, but Qs should explode to the upside right now. Sorry, go ahead. Continue, man.
No, I think so. I do want to highlight a trade since I have you here, Cap. Look at this. Somebody is buying VXX calls. Weeklies.
Look at that, dude. I'm going to look at that right now.
6.73 million in delta on VXX. So somebody is betting that volatility is about to rip. And they bought at 11.10 and they just bought at 12.49.
Mm-hmm. We're here testing the half-hour trigger right now on SPY. Qs looks gorgeous. I don't think SPY is going to produce like Qs does. I think Qs lead SPY.
But look at this term structure, man. Like, look at this term structure. There, 4,900 calls are getting expensive for today.
Dude,
it's funny, but like everything
we can get the VIX ripping, dude. If we go up, if we blast higher outside of our expected range.
Yeah, the expected range today is 56 BPS.
Nice.
So it's not even that, it's very tight. We're in positive gamma. That's what you expect. You expect a slow grind, up or down.
Slow grind, dude. Slow grind. Buy a
because the dealers will take opposite. So blood in markets, if that VXX calls play, that's what somebody's expecting, Turkey McNugget. I don't think so. Let me check something really quick. I will find out what it is, and I will share that on the screen. Just give me a second. VXX. All right, so 11.10.
No, not necessarily, Turkey McNugget. Not necessarily. You can get the VIX running, man, or even VXX running if we trade anywhere outside of expected. That's up or down.
So that was somebody who bought 126 14 strike calls and paid $165,000 in premium on the VXX at 1110. This spike right here, that was somebody buying 14 Cs. So in the money calls for 1 week. So that to me is that somebody, and and given that it's weekly, they're gonna cash out soon. So they're expecting a pop in volatility. They did not go out of the money. They stayed in the money, and then they they paid $165,000 in premium to apply at that point 5.82 million.
I'm checking VXX right now.
Delta. Yeah, it doesn't look that great. So
no, and you know what the other thing too is there's no bottom here. I'm looking at it right now and I'm not seeing like I see the bloodbath in VXX. Let me see, 1130.
Yeah.
And that looks like a blind trade. Well, it looks like they were trying to buy the dip on a bounce on the previous low.
Yeah, I think
from
so
the
that
11th.
Yeah, so 1110 was like down here.
Yeah, they were looking for a bounce right on the previous low on Jan 11. But well, I mean, yeah, from what I'm looking at, that
I'm not too concerned. I'm not too concerned. Yeah, I mean, like if I have the trigger up now, like thank you for sharing that with me. So for sharing this. But yeah, that looks like a really nasty downtrend.
Dude,
on VXX, and look at this, guys. Like you see that? Look, somebody might be
trying to buy
buying
that dip in that previous low, right?
Yeah, and look at this. It's all red, and if it's all red, that means put selling is happening, right? We look at the hero indicator for the S&P complex. Look at those blue lines; they're going up. We've sold $430 million worth of put delta today. All expiries, but the market has bought 400 million of 0DTE put delta, but so that means like the dealer is still making money because they're selling more longer dated puts than shorter dated ones. So they don't expect the market to go down because they wouldn't be selling your puts if they expected the market to go down. So that's what they mean by like vol drying up. Right now, vol is very, very well supplied in the market. Somebody asked for Roku. So on Twitter, I am getting you Roku. Yeah, so that's pretty negative delta today. Dealers are short calls, and the market is long puts. So I don't see anything there, but let's look at its structure.
I just posted. Someone just got annihilated long VIX or VXX. Thank you for playing. Man. Good. Sorry, I'll be quiet.
Oh no, it's cool, Cap. I'm happy you're here. All right, so let's look at the put call. We have a call wall at 100. Where is Roku trading right now? Roku is trading at 89. All right, so that kind of gives us, so we're like right here. Let me make this bigger so you guys can see it a little bit better. And we are like right here at the 90 area. Lots of calls at 94. Lots of calls at 100. That's good. That's good for a slingshot. You see the steepness from like 90 to like 100 is like, it's pretty steep. So there's a good chance price goes out that way. But at the same time, you start looking at on the put side, you're not going to see much traction because there's a big hedge wall. There's like lots of puts like right here, but there's a fair amount of call gamut here. So that's going to act as the bounce area, and that's right under 2. That's at 85. So 85 would need to break for a bigger like downside move on Roku right now. what the market is selling, given like how it's like priced at $89, and what we just saw in Hero, that's just neutral. That just seems like there's a lot of calls up here, so they're just, there's an expectation of, let's look at a fixed strike matrix. Yeah, man, like look at that, like everything above, like for the 16th and everything, like like it's people are reaching for calls, so they're expensive. People are also reaching for puts, so they're expensive too. Well, what's more expensive is, let's see, right under spot is 2.176 and 2.313. So calls a little bit more expensive than puts right now. So that should actually tell us on the volatility skew too.
Just a heads up here too. We've got a 4 trigger bull cluster with a back test, successful back test. We should rip faces off here
on SPX,
on SPY. We had one earlier on Qs, but SPY is happening right now. We had a successful test on the half-hour trigger. We should pull back briefly here to tag the half-hour trigger and then just launch.
Yeah, so I have some supply right overhead, like right around where we opened. At the, I'm sorry about that. It's my Roomba going off. At 4.857 460, I have some supply here. But again, where we are, we're really flat right now. I could see us trying to like get up to about 4870. There is some gamma at 4870, which we can kind of look at really quickly. Let's look at indices. So SPX absolute
we're
gamma.
right on a gamma level right now, right? Isn't it at
4850
or something? We've been parked on it all day, right?
Yeah. So 4850, like I have it up on screen right now if you guys can see this. Let me actually move that a little bit so it's in the middle. So right here, 4850 is where we've been parked. And the next big gamma is at 4900. This is a really, really bullish development. Now there's almost as equal amount of gamma in calls at 4850 and at 4900. Plus there's some put gamma there. You're seeing some like put gamma like building up in decreasing amounts in the money, so for puts essentially. So what we're seeing is there's fuel building up now to the upside, but it's not rocket fuel. We don't have like big gamma stacks down there. What you see here is 5,000, and on the 5,000 strike, there's a bunch of call gamma, and almost, I want to say like about 70% of the call gamma there's almost as put gamma there too. That is also very, very interesting, because that to me indicates a box spread between 4,800 and 5,000, because this just suddenly came up right as some of the other put gamma came up overnight. So this to me, it looks like 4,800, 4,850, somebody opened box spreads with 5,000 strike level just to kind of make more money. So looks like market is starting to rip. Is that what's happening? 1 o'clock just happened. So let's look at this really quickly together. And then I'll go, actually, it's better to look at it in Hero, because that kind of gives us a really, really good indication of, yeah, man, like calls are coming in, puts are being sold. No fear in the market. Nobody has any fear right now.
That's weird too. Look, all right. I'm still on. We roll down camp into the 31st, but
no, Cap. Okay, so it is time. It is time to show the naive thing again.
Yeah, like I
made it.
I'm still looking for that pull down into, but that daily trigger is so low right now.
It's not gonna happen.
I don't want it to be. I don't want it to be as deep as some are expecting it to be. Right now, the daily trigger is still kind of low for my tastes. It sits at on SPY at least. It's sitting way down at 421, or excuse me, 471. Excuse me. But we're almost in line at that 472. So that's kind of where I'm looking for that roll down to occur.
Gotcha. You know what?
I know we're against each other. I still have puts on, man, for end of month on SPOOs. Still,
I left mine on.
Yeah. I still got them on, bro.
I left mine on because it makes sense,
It's a nice hedge, man. Leave it on.
Yeah, I own the market right now. Like I'm long. I need to have a hedge. Otherwise, I'm stupid.
Yep.
Andy says B grade. All right, man, it's time to rip. You know, we're not seeing. Look, like puts holding steady now, right? You guys see that? Like puts holding. There's no more like extra puts coming in. Some fool is like trying to like I'm gonna short this right now, but let's see how that goes. If Andy says it's a B auction, that's really bullish. So I just regenerated this as of like price right now. So this is my overlayer. I kind of use it because I firmly believe that no matter what happens, human emotions and its reflection in price action kind of similar historically. Like 100 years apart, traders kind of behave the same way. So what this overlayer does.
Just sorry to interrupt, but you know,
no worries, man.
As time has passed over the years, I find it very. I used to give sentiment. I don't know, like I gave it a lot of quarter, and I really believe, man, sentiment really does matter here. Like it sets the tone for the discussion, right? To some extent.
Right. There's also the other thing you have to kind of like always keep in the back of your mind for a lot of people, and sometimes even I am guilty of this. Price dictates sentiment. So people get more bullish, closer to all-time highs, and people get more bearish, closer to all-time lows. So
yeah, the sentiment really does. With the age of the internet, I think it also just drives like deeper into professionals than it should, that spend too much time on the internet themselves.
Right, and I don't disagree. So like look at where we are. So on the chart, I know it's kind of really blurry for you guys. No worries, I can make this bigger, and it doesn't look as nicer this way, but maybe it's better to read. Anyways, I will call it out. The blue line is 1998 August onwards. The orange line is 1962 onwards. The green line is 1971, and the red line is 1972. Okay. The price action over the last 101 trading days has been most similar to those four time frames that we have. And what that means is, well, let me backtrack. 3 out of these 4 time frames I've talked about are generally bullish into the next 20 days. The only one that isn't is the 1972 analog, which is also highly correlated and has been predictive. That's the other thing too. Everything that's displayed here, I run a statistical test on it to see if any of those old series can predict the current time series, which is in black. So we are right now at a point where either we've peaked and we start our downward leg. You see that like red line? This is why I have a hedge on, because it's still highly correlated. We are going up, but this is still highly correlated. And
what was the other? You got the red line, right? And then what do you have? I want to highlight it for these guys.
The green line and the orange line and the blue line. Those are the 3 bullish lines.
I'm going to do green for the low end of that curve to the upside. And I'll do orange too for you, brother, so you can. The orange is somewhere in here. So you guys can see that on your screens at home.
Right. So, and you can kind of see the blue line pretty clearly anyway, so you don't need to do that, Cap. So anyways, what we're seeing right here is, you know, like if you think analog, if you think history, you know, similar price action historically is going to kind of occur again. So 3 of the times, like 3 of the time series that have been highly correlated with the last 101 days. And I chose 101 just because it kind of seemed cool. But at the same time, it was also because it's 101 trading days. So it covers about 5 months. So it's a good enough time frame to things. You see 472 possibly by tomorrow. Well, all right. That's great. But so there's one line that's telling me possibly that we kind of chop down and it's not going to be a straight plunge down, or where I lean is this green line where we kind of grind up. We just grind up into the end of the year. We have like, like peaks and troughs and, like drawdowns for like, 4 or 5% at a time, but then we always recover and we end the year up high. That's kind of where my bias lies. I am cautiously optimistic along this green line, but three of the four most correlated lines are bullish. Only one is bearish. This is why I am hedging. This is why I am not completely bull or I'm not completely bearish. It's like, yeah, could go up, could go down. We're kind of at the peak if we're going to start going down. So if we don't start going down today and then tomorrow and then day after, like if you're not going down into the end of this week, I don't think that's happening then, so that's kind of where I stand. But this is I do this. It's not, statistically 100% accurate. I've tried to make it as accurate as possible. But this is a good way to kind of like see what the probable outcomes in the market could be. So you don't end up getting, blindsided. That's all I really do with that. Anyways, let's go back to the SPY. As you can see, no more puts came in. Just a little bit of puts came in. They're holding steady. Calls are holding steady. This is consolidation. Let me look at what's happening in the mags, because that's always helpful to see. And you see in mags, we got like they're selling puts in the Magnificent Seven, and we're seeing calls being sold too, but now they're being bought back. So this is constructive over here too, in the Magnificent Seven. You kind of want to see that. We can go look at IWM flow really quickly. Wow, that's a lot of call selling, which has kind of tapered off. This could have something to do with the fact that IWM like ripped from like under 190 to 198 at open. So this is just like, I think, call monetization that happened, and it's kind of, it petered out around like 1050, and then some calls came in and now it's steady. But generally now we're seeing a steady put buying experience and 0DTE call buying. Is today Wednesday?
Today's Tuesday.
Yes, today's Tuesday. So it's tomorrow's expiries. Our calls are being bought. So yeah, so that's what IWM. Do I ever watch SVXY? No. I don't watch any VIX product. The only thing I watch is implied volatility. So, people have, if you go on FinTwit, people have theories about why VIX is low. People have theories about the government buying SVIX to crush the VIX, to crush oil prices, yada, yada, yada. There's a whole bunch of stuff out there. They're interesting. I am not poo-pooing anything. But to me, that's too much. There's too much noise with the signal, and the truest signal that I have found is implied volatility. If implied volatility is rising, that means people are scared market is going down, and implied volatility, going up, will show up not in the VIX, because remember, VIX takes is 30-day puts and calls, but 7 days before, 7 days later. So it takes only positioning in that 14-day window to calculate the what the VIX spot VIX value should be, right? We don't have hedging happening that far out anymore, because people are like, I can just hedge using 0DTE.
Tell them about that, by the way, because that is what's happening, right? We know that started, or I think.
Yeah. I mean, I did statistical analysis about this, and I posted it on Twitter like almost like 8 months ago at this point. I looked at VIX, and I looked at SPY, and I looked at how much intraday volatility there was in both those indices since 0DTE was introduced. And I kind of did what's called a difference in difference approach. And then I said, okay, let me just show you like t-test wise, how different they are. And what I found, people were all complaining about, zero DTE is going to like increase volatility. No, zero DTE actually decreases volatility because you can hedge short term. If you hedge short term, you get the result you want. And if you don't need the hedge, you throw it away, right? It's not going to lose. It is the purest expression of sentiment, because A, it's options, and B, it's closest expiry. So I am fairly on the side of zero DTEs actually suppress volatility over the long term. And that is why you see intraday VIX swings became smaller, intraday SPY swings became smaller, and you just saw a collapse in the VIX. And I honestly think it's because people are using, because you have everyday expiries on the index now, on the S&P 500, and that's the biggest options market. The other markets in equities, their volume of options traded is like minuscule. Like I would almost go out and say that if you combined all the options that are bought or sold in volume across all equities, and just look at how many options on SPX, not SPY, on SPX are traded, you will find that that is more than all of the other combined. So SPX basically has benefited a lot, because remember, you don't need to like think about hedging. Oh my God, market's gonna like go down, and the closest expiry I have like is a week away, so I have to pay all this money to like open up a position, and because I own this much under management, I have to open a certain percentage as a hedge, so I have to put a bigger hedge. Now you don't need to do that. You can be like, all right, if the market is going to crash because something is going to happen tomorrow, I'm going to buy a 1 DTE block, and it's going to cost me, a tenth of the premium that would have cost me for the end of the week. Yeah. So
there is another side to that story too, which is we were streaming way back or before the big roll in 2022, but then as we came into 2022, trying to make sure I got my years right, into January, right around that first roll down,
right.
That put I think sometime in like that January, March is when we was the first time that I saw hundreds and hundreds of thousands of zero date put buying too, and amplifying downside moves. So where we have the suppressed vol in these situations here, if you trigger that put buying, you can also see violence on the downside. They used to talk about that on Twitter a lot.
Yeah,
but
CNBC,
but it's fallen away because they're not, there's no follow through in that hedge.
No, because that's the thing. There's no follow through on the hedge. And you know what? Somebody like JPM says, all right, market's gone down enough. I'm going to plunk down $1.5 million in premium on 0 day calls. And it just arrests the drop like that, because suddenly somebody, and they say, and the thing is, Cap, you have to remember, we talked about gamma earlier. That scenario where the chase is going to happen, where 0 DTEs really exacerbate the down, it's only going to happen in negative gamma
combined with it. That whole thing at the same time, right?
Right, and so that's why like the CTA thresholds being so much lower, the daily trigger being so much lower, and the fact that we're in positive gamma, I'm like, yeah, dude, we're going to see a grind up.
And they're not buying right now. They have no pressure to buy right now. CTAs are along the market. They've got no pressure to buy. They're just sitting on the market. If we break a threshold, they'll start selling, but otherwise it's that slow grind up until they monetize.
Right. And so right now what we're seeing since 1 o'clock, we got that nice bump right into 1 o'clock. Look at that. Options are flat. Like the delta that's coming in is, kind of flat. This is just chop. You can't really like make a trade.
Yeah, I agree.
You kind of want to see, this to like start picking up, 0 DTEs to pick up, and these 0 DTE puts that are losing value.
We have some questions coming in right now too. We've got
sorry, go ahead.
No, it's fine. Let me see here. Curious about a window of weakness being a blow off top and not the slight pullback. I guess I'm assuming some of this some ad libbing on my end, but
yeah.
So they're asking about China stocks multiple times now. But do you have any thoughts on it? If you don't, you don't have to either. Don't.
Yeah, please comment on China stocks. Yeah, no, for sure. I am long Queb. I said that the last time I was on stream. I have June calls, I have June spreads on Queb, and I'm not going anywhere with them. I was a little contrarian when I bought them. They are red right now, but I am okay. I am okay being long exposure to China for this. I
think it's a great trade, by the way.
Yeah,
I've got it in my outlook for the year to be long Queb, KWeb, and all the other, or a bunch of Chinese stuff.
FXI, Yin. The thing is, it's there's some like new stuff happening too, right? Like they basically announced yesterday they were going to put 1 trillion yuan into China stock market, literally like move it up, and like I bet like Americans are like, we don't do that. Yeah, bitch, we buy bonds.
Yeah, dude, exactly, dude.
So yeah,
and then on CNBC they're like, our Treasury. I'm like, you pick the Treasury Department to say we don't do that? Come on.
Yeah, no, it's really funny, man. Like because like that's what everybody's looking for is the QRA. If the QRA comes out more bills than coupons,
yeah, dude,
that market is gonna just scream upwards. So I think that's the thing. I did see. I'm gonna throw.
I do want to make a comment on that. The QRA is unlikely to happen, but if it did, you're talking about a situation very similar to 2020, the bottom of 2020.
I think it would be again. It would be again. October 31st. It's going to be the exact same thing. If she comes out and like says stuff like right now, hey, we absorbed like $60 billion today in 2-year treasuries. We absorbed that.
I mean, there is a 5%
so they could be like,
they
could be like, let's do more coupons, and then the market is not going to do
coupons,
well.
And then they cut at the same, or no, hit us with either. Well, they can do either at that point.
Right. So the thing is, you're right. I think you're hinting at the same thing. I think we talked about this earlier too. Here's the mental calculus, guys. Like this is how I see it. You don't have to agree with this. I am not an expert in this stuff. I'm a retail trader like you, but I got a big brain, so I like to think about this stuff. So there's two things, right? There's the FOMC, where there's an expectation of a rate cut, which is getting priced out in March. Then on the other hand, you have the QRA announcement, which is for the next quarter. What are we going to be selling? How is the government going to fund itself? Is it going to be issuing T-bills, or if it's going to be issuing treasuries? Traditionally, there's like a matrix of how many treasuries versus bills you need to do, which is fairly conservative. I think it's like 30% of it should be bills and 70% should be coupon. But what Yellen did was she kind of flipped the script. She went 80-20. She said 80%.
That's right.
Of it's going to be bills, and 20% is going to be coupon. And the impact of that is very, very simple. It loosens the credit markets, because what that does is, because there's not more longer dated treasuries being offered by the government, the dealers or the traders are not holding back, anticipating for higher rates for them to get a better deal. So the yield curve on the long end starts coming down. If the yield curve on the long end starts coming down, businesses can get cheaper loans. Home buyers can get cheaper mortgages. People can start moving money around a little bit easier. So that's why what we saw on October 31st was such like, oh my God, how did this happen event, was because nobody saw this coming, was because you usually don't see that kind of structure. Now, there is arguments right now that the Republicans may not like that, because that is a very political move. It is not a structurally sound move for the Treasury Department to be issuing more debt that is short-term versus long-term. Now, on the other hand, the Fed, if there's more bills than treasuries, than coupon being offered, the Fed doesn't need to cut, because conditions are loosening anyways. In fact, they might actually come out and start talking down the market, being like, hey, inflation is not done, yada, yada, yada. They might jawbone the market down. The other thing is, if we actually end up getting more coupon than bills, the Fed can come out and be dovish. So the end result is going to be the same. We're going up. you know, the teeter is going to be ultimately like, which side does it happen? Do they come out and start talking, something very bullish, or do they come out and start talking something very bearish when the FOMC minutes are released and the QRA comes out? That's why when you look at this implied volatility structure, right when the QRA is, oh, wait, what? Go back. They actually are selling that now too. This was all green. This is still shades of green in here. You can kind of see it light, really faded out green. But this was all like lit up green because nobody wanted to sell puts into this. So right now it just kind of seems like nobody's really concerned. They're willing to sell puts for this expiry in February. I know I kind of like talked a lot. I answered a few questions, try to keep a conversation going. And with indirect taking a 60% auction, who's buying it? Foreign banks. Actually, no stretching walls. I am going to disagree with you. It is not banks or states buying it or banks buying it. It is investors in other countries buying it. There was a piece put out by Nomura at the end of November where they kind of went and looked at, who is buying all the treasuries that the U.S. is offering. And what it was, they found out that it was basically investors and not institutional money. So, yeah. So let's see. If Yellen reduces coupon issuance, the equity market and bond market will rip. Yes, absolutely. That is right.
That's me, by the way.
Yeah, I know. I saw that. Let's see. Interesting. I'll have to track that down.
Simplify it for them so that I figured I'd post it so that they're not going to understand, like, what do they need to know as a cash market trader? That's what you need to know. When that date comes around, that's what you're looking for. The answer to that question.
Right. So more bills, more issuance in bills, T-bills is bullish. So can you tell us more about my morning routine? Like I wake up, I put my pants on one leg at a time like everybody else, and then I go to the bathroom. But I'm guessing you want me to like talk about like what I look at. Yeah, I understand, Jade Pastor.
Do you do any manscaping in the morning?
On occasion for the lady. Yes.
Do you eat breakfast in the morning?
No, I don't. I usually have a cup of coffee.
Tea?
And
coffee? What do you drink?
I drink coffee, man, and I do a French press and I put creamer in it because.
Do you stretch?
You know what? I like it there. I stretch. I meditate every day.
Nice,
I meditate at night. I like my scotch. I like my weed. If you guys really want to know. But none of that's in the morning. In the morning, usually I am, like busy with home stuff. And then after that, when I sit down and look at the market, which is usually before open, I will look at options positioning. I will look at the flow because SPX now trades options 24/7. So you have flow coming in overnight and stuff. So you can kind of see how position is developing. You look at what the implied volatility is like this. You kind of look at the term structure, what that's looking like. So I was like, okay, this is kind of cool. Is it like bullish looking? Is it bad looking? I look at some of the news, like, are we like who released earnings in the morning, where they're going. And, then I try and look at why is that happening? Are they saying, oh, the consumer is strong? Are they saying that, hey, we've hit bottom? Or, opposite of, like if somebody's saying, hey, we like, had a bad quarter, you're like, okay, now is that a sector-wide thing? Or is that like them being like bad at managing? So I kind of like look at that, but not really on every ticker, but like on some of the big tickers that I think are interesting. Then I kind of like, kind of see like how this is fitting into the thesis. Like I am, as I said, I think I've said this before, I'm cautiously bullish on this market. I have a hedge on, but I am cautiously bullish on this market. And it does not show me any weakness right now. All it's showing me is that it does not want to go up as fast as everybody is thinking is going to go up after that big monster move last week, because it has to digest all of this information, and it's not going to move till that happens. But anyways, that's kind of what it is. What do I trade?
I'm with you on that trade, by the way. That digestion, that pull. I'm on the pullback trade. I'm not looking for major downside, but I am looking for that face ripper up into the 14th, up into that Valentine's Day move.
Right.
To 40. I don't know if we can get to 52 or 5,000. I'll take 49.
I'll take. I mean, you saw when I pulled up the levels on SPX, right? Let me put that up again. So, Cap, look at
It's
this.
trading 40. Well, SPX trading 48, 50 something.
Yeah, I mean, but that's the bar, right? Like that's what it's sitting on. But there's now equal amount of gamma happening at 4,900. So that's the new call wall. That's what we're reaching for. And what's really good is like this strikes above that are filling up with gamma, right? And so that's like, traders are taking, upside positions, and that's good. And you kind of want to see that.
Just a matter of when and what's the date, right? Or at least,
yeah.
I guess the big question for if you're watching the show here is, where do you pick your poison? Are you just buying a spread for the 14th of February to tag that 4,900, or are you waiting for the whatever that dip is, and when is that dip? For me, I'm picking the 31st. But I want to see those flows come in on the beginning of the month for February and get
right. So that's
real money buy-in shit that should come in the first of the month. But
yes, thank you for your 401ks for contributing passively.
Yeah, exactly.
If you're listening to this, contributing passively into the Ponzi that is the stock market. Like that's I'm kind of joking, but 31st first. That's why that happens.
Yeah,
is
that
because
first
there's
week,
buyers.
man, those flows come in.
That allocations come in.
Mm-hmm.
So we're looking to that now. Somebody asked about China. There was a very sad note posted yesterday by Citrini. It was a letter by a portfolio manager, like a fund manager out in Singapore, who basically kind of like almost blew up. He had a 19% drawdown this month so far in 19 days. So he kind of like closed down the fund, and he like said, like, hey, we were long China, but it doesn't seem to like be working.
Mm-hmm.
We were short Japan, but that doesn't seem to be working. We've had, like ridiculous amount of, drawdown.
2-year drawdown, right? 2-year drawdown basically in China, right? I think, or a lot.
Yeah. And so, he closed his fund, and I felt really sad. I left like a long comment about, like how that is really difficult to admit, and admit to everybody whose money you're managing. Like, I'm a retail trader.
Well, he didn't commit fraud either, right? So a lot of those guys sometimes will double down, triple down, commit fraud at some point, commit fraud. So
right. So like cheers to him for doing that and owning up to his mistake, right? And he goes like, I've lost all confidence as a trader. And to me, like, that was like, that guy has so much pressure on him, but he's willing to admit that. Like, I make mistakes, and I like, when that happens, I go cash and I walk away, and I don't trade for like 3 or 4 days. I rethink the market, see what I'm seeing, reevaluate the thesis I was trading with, and get back in the market. And usually that ends up working well for me. It's very rare that after a break I will make bad trades. Like my positioning will be better. It's good for me to like walk away, but he can't do that, right? He can't do that because he's got like lots of money under management. And the day he puts out that letter is the day that China announces that, hey, we're putting $1 trillion into popping up the stock market.
Yeah.
So that literally called the bottom in my mind in China. There's like,
I got a friend here. I'm not gonna say his name. I got a friend though that's a friend of this show. That's a licensed guy, and he related to me. We were on a phone call last week before, and he was talking about a lot of professionals in quiet conversations saying they have, or this past 3 months, I think it started. I think a good way to look at it would be like SDAO followed a trend down and bounced pretty consistently. And you could see SDAO get murdered at some point. It broke trend to the downside. And he mentioned that right around that time period, there's a lot of looking back this year to see there's a thesis being passed around that the stock market has changed again, and that they have to rethink their habits, how this market acts. And I think StockCharts.com had we were showing a video with like 3 or 4 fund managers that also said they were rethinking their market trade or market habits for this year differently, like unlike they had ever in the past. They spoke specifically about the manipulation in economic data and stuff that's happening. It has been happening since last year. Oh, sorry,
Right.
I'll be quiet again. Sorry.
No, it's cool. They're in a really difficult position. They're in a tailspin last couple of years. They've said a bunch of times that they're going to intervene, but that those interventions have not either panned out or not worked out. Either they're like kind of like not done that. So there's a lot of people who are talking about Queb and China in general, basically being like, hey, they've kind of promised stuff before. They might say that, hey, we're putting $1 trillion into the market, but they might not actually do that. They're just contemplating it. So that's a valid concern. To me, the R&R is to the upside at this point in all the Chinese stocks. You think they're going to stop making stuff for the rest of the world? So, yeah.
I'm going to try to take a look at one of these. I did a chart for the year predictions for this year. I haven't released this thing yet. Some people have seen it, but I'm going to look and see what tickers I'm looking at in China. Hold on.
Yeah. Speaking of tickers, there's something interesting happening with NVIDIA right now. It's kind of chopping in this like really tight region. And I think it might be trying to attack to the upside, trying to attack the 600 supply again. So that's $4 trade. So it's interesting. Anyways, somebody asked for Tesla. Let me show you Tesla. There's lots of calls coming in, man. You can kind of see that right there. There's a orange lines. It's 51 million in all expiry delta and calls, and most of the puts are weeklies. So they're for this Friday, because you can see this line, the light blue line, is deeper than the dark blue line, which is all expiries. So this snapshot is that traders think it's bullish. It's also sitting right at its under its hedge wall at 210. So that's a good place for it to start bouncing from. But the upside is kind of capped at 220 because that's the call wall. Doesn't mean it can't overrun that just because of earnings. It's such a binary event. So let's look at how overall positioning is outside of the hero signal. Wow, that's very interesting. Let me make that bigger. And so as I said, you have your hedge wall at 210. There's like a lot of call gamma, and there's a lot of call gamma right here. Well, that's 220. So you have your hedge wall right here. And it's pretty even gamma. And how much in notional? 13. It actually has twice as much put gamma there as it has call gamma at 210. All right, so that's kind of where it is right now. But we have this huge stick at 220, and that's the call wall. That's because it's like 47 million in notional at the 220 level currently. I need to expand this some more. Yeah, so break of 220, well, break of 217 leads to 220 pretty fast, but it's not.
I'm still up on Tesla calls right now. Surprisingly, I'm catching a lot of call or premium on my calls right now.
Yeah, IV is increasing, right? We can kind of look at it.
I was up big time, and I was up big time yesterday. I think I'm up like 10 cents or 5 cents or some shit right now.
Yeah, so the at the money call right now, the IV on that is 12.7 standard deviations higher than it has been.
Yeah, I think I
60
was
they
in at
look like.
64 cents or something like that on 235s for the 26. And even with all this blood in Tesla,
Yeah, the calls are paying, man. So you can think about
it's
trimming
riding
that
premium
position
right now.
or
But we are
yeah.
I'm watching right now because we are testing that low from Friday, I
Wow.
believe, right now. I could be wrong on that, but
Yeah. So we're kind
no. So
of
like
just
Friday,
due date of burn
we're
again
touching the Friday low right now.
on Tesla. Let's
Yeah, I
see.
think we're going, and I think we're going back to. Hopefully, we don't
Yeah.
test yesterday's low.
No, so I have the next supply like all the way at 2056.
Yeah, dude, I got 165.
No, that's where I want to buy. I think I told you that.
Yeah.
Like I
Oh,
want
you
to buy
have?
down there.
Yeah,
Yeah.
165.
And then you said, you might even go lower, and I was like, oh my god, really?
Well,
Did
the
that
low.
happen?
So all right, so the low that we had, dude, in like October or something, there was a tiny ass gap left behind, like $2 below, and
Right.
then there's a huge move down to like $68 or something.
Like the 6 month trigger or something like that, right?
Yeah, dude, exactly.
Yeah.
Down at that $89 or something like
Yeah.
that. There's a tiny ass gap. So when we hit that last major low in October, dude, I didn't buy that morning because I was like, you know what? They'll probably do it at 9:30, slam it down for like $3 or $4, and then we'll
Yeah.
get the ride. And they just off and running. I had to like
Right.
chase price after that.
Right. With Tesla, the other thing is also, guys, like it always moves up or down. Usually they kind of kill earnings every year. And the fact that it is so cheap, and the fact that there's more puts expiring on Friday than there's calls, that kind of says a little bit of
Juice
upside.
it, baby.
Yeah, they're juicing it right now for a rocket ship. I mean, I'll see how earnings come out, man. And you can always buy TSLL, which is the Tesla long ticker. Let me kind of put that here.
I always like what I don't
That's
like.
leverage and long. So
what I don't like was my own rules for Tesla. Typically, of course, if you're buying into the event, you sell before the event. If we
Right.
are going to sell into an event, I like to wait after that expiry. Now I'm on the 26th right now, but after, not always, but as a rule, 70% of the time, even if they have a good earnings, it typically, in my view, sells down before the open the next day. You see the underlying
Yeah.
tip profit taking, and then you see that next expire, or that once that first like the 26th, when that expires, you'll see the actual Tesla run. It'll just start moving.
Right. And for a lot of high volatility trades, you do leaps, or if you're bullish, do leaps.
Leaps are a great
caution.
way to express that trade.
Yeah. And they won't have high IV. They'll be more expensive. If you are a true master trader like Mr. Pelosi, you'd buy like deep in the money, leaps. So you take the advantage of the 100x leverage, and you're essentially expressing the upside. And
Without
IV
too
crush
much
doesn't
exposure.
impact you. Yeah, exactly.
In a pretty big fucking way.
Yeah. So, and then you can make 500 grand in like 2 weeks. So
there's another thing we do here too, man, and I don't know if you've seen us do this, but when we come into the big tech earnings, where each quarter when we come into the big tech earnings that can actually swing an index, like Netflix can swing an index, any of the big heavy hitters in tech that can move the needle on Qs or SPY. One of my favorite trades, we do this here all the time, is you pick up the zero dates like at 4 p.m. or 4:01, puts or calls, and you can get that exposure to, let's say, a Tesla that rips faces off for the first 15 minutes or so, and then you're not dealing with like the Tesla drop before their guidance and Elon does stupid shit, and then by morning, it's been monetized on the underlying. So you can easily, dude, make all that money in 15 minutes on a close. Literally, in a zero date, you can go from like 10 cents to $1.40 in moments. The one key thing to state on this, though, is you make sure you put your stops in on the ups. If you're bearish, put your stops into the downside right when you take that trade, or even to the upside. So if you buy a 10-cent call, you're going to, in your mind, say, this is going to 90 cents. I'm going to monetize at 70 cents. So if we rip really high fast, you're already out of the trade.
Right.
Same on the downside.
No, I completely agree. You know,
Cheap
it's
exposure, dude. 20-cent calls. Why buy $4 fucking Tesla calls expiring tomorrow when you can buy them for 20 cents? 10 cents.
Right.
Absurd.
So,
sorry, go ahead. Go on.
No, it's cool. I agree with that. I also think it's you know, Nvidia. The reason I always remember their earnings time, because they don't change it. It's 4:20 in the afternoon, which is always really funny because you can't buy options after that point. So, okay, so Tesla
is famous for that, isn't it? Or they were always famous for.
Yeah, I mean,
they've
a lot
dropped
of
earnings
people don't know
before
that.
open too, right? When no one was ready for it. I think that them or AMD. I can't remember which one. Or no. Is it TSMC that does? Is it a?
TSMC does it before market open because they're based in China.
There's one of them, dude. One of them was like one of the CEOs said that they hate the gambling on earnings season, so sometimes they'll leak their earnings. I forget which company that is.
I'm unaware. Apple does 420 as well.
Yeah, no, one of these chip companies will sometimes leak like a day before or earlier in the afternoon, and I'll try to find out which one it is that does that.
Gotcha. So I have this little handy dandy chart. It is, it kind of tells you if it's before market open or after market open, the close, and what the implied volatility is right now, the percentage move. So for Tesla, 124, it was 5.84% is the implied move on the stock. So if you're gonna buy, like, that's how the straddle is priced right now, but that much of a move. Lam Research, 5.4%. Tomorrow, Las Vegas Sands, 5.22%. IBM, 3.62%.
Probably bring up straddle sellers as well. People selling straddles or selling options into these ERs. Because they lose like 2 out of 10, but you win 8 out of 10, right? If you're selling puts and calls.
Yeah, or like if you have a directional bias, you can, as I said, you can use a calendar, which is basically you are short.
Too.
Yeah, you are short a call or a put in the direction you want, out of the money, and you buy the same strike a week later. So what happens is the IV crush from the earnings being done, reduces the value of your sold call. So you have more money coming in from that leg. And if the price goes up still, your
no IV crush.
No IV crush for a week out. So you actually capitalize on that end too, on your long side. So calendars are a really good way to express moves, especially with high IV stocks, because you can still get upside exposure or downside exposure without having to pay for like the nearest expiry. So
maybe you can cut one side loose if it does go against you at some point too.
Yeah. If it gets too much in the money, that's why I said it has to be. You have to do it like you have to kind of like know what you're selling, right? If the options market is saying that it's 5.84 percent, implied move for Tesla at 200, that means it's like almost like $12 is what it's expecting. Do you expect it to move $12 up or down? Sure, but how about $20 up or down? Do you expect that? No. So maybe you like buy, if you're bullish and you think it's going to move, $12, $15, why don't you buy a $240 call or sell a $240 call, which will have a lot of IV for today, for this expiry, and you sell. Actually, you know what? We can look that up.
Find high IV strikes. Make sure there's a bunch of people on them. And then you've also got the other thing too here is ratio spreads, bull or bear, can print bank on those trades as well.
So
on the high IV, high expected moves if they get the expected high move.
So we're gonna
going down or up doesn't matter.
Right. So I'm just gonna like kind of build a.
Yeah, do your thing, man.
Yeah. So I'm gonna just to illustrate, like, where is that's 208. So 240 call. No, so
are you doing Tesla right now or no?
Yeah, I'm doing Tesla. So
what date right now?
So I am selling. I'm gonna sell a 225.
What's the date of the strike?
26th. 26th.
I'm looking right now to see where the highest IV is.
Yeah.
Well,
we're not going to do. Well, highest IV will be at the money. But we don't want.
Right? Is that a high IV?
No, I got 225 because I'm just saying that if the implied move is like 6% at the moment, so let's get $17 above spot. So we're outside. So chance of that going in the money is like less.
You got
because if it goes,
too.
So
on the put side.
Okay, so I have the call option at 225. I'm gonna sell that, and I want to buy a call option for the 2nd of Feb for 225.
I like that trade.
Right. So let's calculate this and look at that. So at expiry, which is this weekend, if the price is any place over $210, or sorry, any place over $204, you're making money. You guys see that? Calendar spread is fantastic, especially with high IV. Willie Loman gets down. I'm seeing an IV of 8% for Tesla. Yeah, so it might have increased today. That, as I said, that chart is that I showed is not updated, is updated as of this morning. So that is totally possible. But what I'm saying is you can look at a calendar spread. And if you start looking at calendar spreads, they can pay out money because you're not risking as much. So this spread would cost you $1.39 for the same strike for 225 Cs. And it can pay out, like if it goes, let's say it actually goes to 225 and it expires at 225, it will give 444%, which is kind of fantastic. So I like calendar spreads just for that reason. Just saying might be even more IV, which makes the calendar spread even more appealing. Absolutely. That's what I'm trying to say. Don't do straight puts, straight calls. Options are fantastic. Pick up a book, ask questions. People are always willing to answer. I'm always willing to answer. You cannot see it. It's really small. Okay, yeah, man. I got you. Let's see. Control shift.
Nice.
Yeah, you guys can see that?
Yeah, it looks great, man. Do a slow scroll, start at the top so they can see.
No, I'm just gonna put it all there. So what the trade is we are going to we are going to sell a 225 call, and we are going to buy a 225 call. We're going to sell the one for this Friday, and we're going to buy the one for next Friday. And I'm not saying do this. I'm saying this is a calendar
not
spread.
Financial advice.
Right? I'm not going to play Tesla.
They do this to me. They're like, you told me this. I'm like, did you take the other 5 trades? No. I only took the one trade that I wanted to take that you were taking.
Yeah. No,
I'm
illustrating
tripled down, and then it's my whole account, and I'm like, can't do that shit.
So this is as a percentage of maximum risk. So as of right now, if it ends at $225 on expiry, that would be a 444% gain on the position, as an example. Now, if you see the one right above it, 225.75 strike, if it goes up there, you make less money because now your sold strike is going in the money. So if your sold strike starts going in the money, you might just want to call that and close out your position.
Tell them why, though. Tell them why when something goes into the money, what can happen if you go too deep in the money.
If you end up going too deep into the money, your intrinsic on the call sold is not going to outpace the value of the time that you have for the extra 7 days.
There's some assignment risk too, right?
Yes, that's very true. Somebody can be like, I want to buy this right now. Sell it to me right now. And then you're kind of boned. You can lose a lot of money that way. So a calendar spread, just look at this, right? Let's say tomorrow. So today is the 23rd. Tomorrow on the 24th, the price is at 225. If you sell that right now, according to this, you will make 91.4% of the risk money, like the money that you risk. You will make $127.
I got to stop in for. I apologize. I have to interrupt really quick. Just a heads up here, guys. We're coming into 1:53 p.m. If you're on a QQQ chart with half-hour bars, I want you to focus on this last half-hour bar here. Okay. On
I
the
have it up.
Qs. Thanks. I appreciate it. And this. So watch this last half-hour bar here on the Qs. The bulls here must get a new high here. My preference here is that the bulls on Qs get this new high on this half-hour bar. If they fail to, there could be a capitulation move to the downside. So at least this green candle, I want to see price on the. I would prefer to see price above, at minimum above 422.20. But I don't want to see it any lower than 422.20, and my preference would be that we're above 422.60 for a ramp into the end of the day today. So just keep your eyes on this at home. So yeah, because bulls can't be losing this stuff here. You've got the first high was back on the 12:30 candle. The sellers tried to take out the next candle and failed. And then the prior half an hour, we came all the way back down and tested 421.80. So this closing bar here, you really need, because they can pin this market right in the close, or even roll it down and some weakness into the end of the day here. So pay attention to this 2 o'clock hour here. What happens here in Qs? All right, sorry. Go ahead. Keep going back to what you're doing.
Well, no worries, man. Like I'm listening. I'm enjoying this as well. I do have a call wall at 424 for the Qs, and that comes from existing positioning. Like that's like the max upside as of this moment. You kind of want this to get rolled up. We have right above it 424.67 ish. We have a big call, a combo level, and that's where we bonked off of yesterday. Like that was the
they're
high.
losing it right now.
Yeah, so it's the Qs are supposed to go sideways. That is the thesis.
Yep.
Because what is happening is that what we should start seeing is like XBI. We should start seeing IWM start to pop, and we should see the Qs start to. This is something that happens when I have both the trigger and levels on. So that. So what I'm saying is, like it just kind of compresses.
Look at that grind.
Yeah, and so I'm kind of
just supplying right into that red line right there, right?
Yep, and like that's the 5-minute trigger at 422. That's also 422. Also happens to be a combo level of options across QQQ and the NDX and NQ. So that L3. So that's a pin area. Like we should go sideways or downwards, but like this is where we should stay. But we should start seeing like XBI start to pump a little bit, and we should start seeing IWM start to pump. Always, I tell people is keep an eye on Dixie. Dixie has been the canary in the coal mine for equities. If Dixie is rising, chances are we are not going to have as much upside as we expect. So anyways, the grind is still going. VIX is still dying. Look at that. It's under a 13 handle. So yeah, Dixie is going, and like let's look at TLT. TLT is not having a good day, guys.
So if there was a ticker that you think we should watch on 4 screens for the end of the day for ER reports, what do you think we should put up?
For ER reports, let's see who. Well, out of the ones that are reporting today,
yeah,
I don't think who is that?
Let me take a look at the ER
Texas Instruments. I think Texas Instruments does Netflix. Netflix, dude. That's the market.
I know that's the big one already. I already got that one written down.
Yeah, Netflix.
Is anybody offering up tickers they want to watch on the end? I can't see. Hold on, I'm not logged in right now directly to the chat on Twitch or YouTube.
There are times when IB gets crushed on the long leg more than the options profit calculator shows. Yes, that is true. It can get crushed. It says, I think when you look at their
2 minutes left. Watch out. We're looking for this new high. SPX looks SPY trying to get that high in the last 2 minutes here into 2 p.m.
Okay, let's pull up SPY. Yeah, SPY's going for it, man.
They're going for it, dude. Right into this half hour
Yeah.
right here.
Yep. And the call wall on SPY is right at 485.
Let me see if anybody's got any tickers they want to watch into the close here. You keep talking. I'm gonna read some of the comments directly.
Gotcha. And let me know, man. I can move the screen and whatnot.
No, you're good. You're good. I prefer to do it in the background here.
Gotcha. So yeah, we're seeing. Let me go on the 1 minute chart of this. Yeah, look, we are coming up on a combo level on SPY. And at 484, and that's kind of been our bane so far. But let's look at, you know what? Let's
WM baby ripping.
Yep.
Chase, that Dixie being up 4% since the beginning of the year in market up is not necessarily a bad thing. Yeah, if Dixie goes down too far, it's really bad for the market, believe it or not.
Yeah, so because here's the thing, that means people are abandoning the dollar and the U.S. market. And right now, Dixie going up and market going up means that people think that the best quality globally in stocks and equities and debt.
So you want me to put?
Yes, America.
They want me to do it. What ISRG is ISRG?
Yeah.
So NFLX. You got? Did you say Texas?
Instrument TXN.
Yeah.
Texas Instruments is really important, guys, and I think people are sleeping on it.
ISRG.
It's above its call wall at 175. Ooh. Ooh.
Thurston Howell, he goes, this reminds me of a Series 7 exam. Hold on, all right. Keep doing your thing. Keep doing your thing, man. I'm gonna check out the calendar.
Yeah, no, you're good, man. I enjoy this. ISRG, actually.
It's a blast, isn't it, dude?
Yeah. It's fun. I'm not doing any trading myself though, so that's not fun. I would rather be trading myself.
That's how so when I'm streaming, it's like if I was not streaming and just trading on my own, it's so much easier. But then of course I'm trying to trade while streaming, so much harder. I've been through like the fucking meat grinder, dude. Last 2 years, meat grinder.
Yeah, no, I bet it. I bet. I'm long IWM 205s for 315. Should have bought them earlier, but that's all right. Anyways, let's see. Sorry, go ahead.
No, I've been using this new earnings calendar, and I haven't checked on these guys in a while. I can't forget the name of the company. Shit. What are you using for your earnings calendars right now?
Oh, I like to see the guys on Twitter, Earnings Whispers.
Yeah, I used to like them. I'm trying to see right now if I can find this. Let me see. I'm having some lag here.
The best one was Consensus Gurus, but I think they sold their account to somebody.
I think that might be who.
So there's a big call wall at 390 on ISRG. Then somebody was talking about, Willie Loman. Willie Loman gets down. 390 call. I like that at 400. There's 395 and 400. There's calls too. There's not enough puts down there, but there's plenty of puts down here to vaporize.
I was pushing these guys for I still do Yahoo is where I get most of my detailed stuff. I put a bunch of that stuff in Excel files, but forget who these guys are. When did they sell? When did Earnings Consensus sell?
I don't know, like about 3 or 4 months ago.
Yeah, that might
it was just a quad.
Black Swan Street.
Okay.
That's who it is. Have you been to Black Swan Street?
No.
Oh, dude, you got to check these guys out. And they offer you a free account. Matter of fact, I got to log in right now.
Black Swan Street.
Yeah, Black Swan Street has been outstanding.
All right, I'll check them out. Not right now.
Black Swan Street's like old school Earnings Whispers. when they were earnings whispers used to give a lot more stuff, and they stopped.
Yeah, everybody's trying to, do things. Yeah, we're going into that supply that I have marked out for IWM. I'm okay with this. I bought time, about 2 months on these 205s, $10 out of the money for $2.70 a piece. So let's go get it. Let's go check that 196.44.
I don't see an update for them for Black Swan Street right now. I hope to contact those guys. I thought they were doing a great job.
Yeah. So his ISRG, there's a lot of puts that expire in February on their calls, on their options. A lot of puts, 40% compared to 10% of calls.
Dude, I gotta contact this guy. He shut it down. I'm gonna contact him right now. He shut it down. Black Swan Street. I loved it. It was a great. I gotta talk to this guy. Oh, I'm gonna get off right now. You keep chatting. I'll be right back.
All right.
Bye.
Sorry, did you say TXN is good? No, I think TXN is important. Let's look at that chart. They are one of the only America only chip manufacturers. They're not on the cutting edge, but they make a lot of stuff for the defense industry as well. So if you're long RTX, you should kind of keep an eye out for TXN. Now let's look at that over a 4 hour. Let me turn off. Yeah, that's turned off. So it is been benefiting. It bounced on the weekly trigger and it went up, $10. You could do some rudimentary TA here. We're kind of up against that trend line. That's not good. That's not bad either. But this kind of looks like a range expansion. I don't know. I could make this bigger and we could do more TA on it. But yeah, no, it's I don't know. TA wise doesn't look too promising. So calls are coming in now, and puts were being sold, but people are also buying puts. So this is like earnings stuff starting to happen since like 145 or so. They're above their call wall, so they are naturally what I would say is like extended. But wait, I need to go back at this. We need to look at some history of this because that'll give us an indication of how things have been positioned over time. TXN. History. Oh, let's make it bigger. Can you guys see this now? Control Shift and plus.
So I'm gonna put the Qs up for the close. I'm gonna put SPY up for the close, all on the 1 minute triggers. And for earnings today after the bell, and then I'm also gonna put up Netflix, NFLX. And we got Netflix up here for the close. They're parked on their hourly trigger. And then we'll do ISRG. You guys want me to do ISRG?
Yeah.
All right.
Okay. So
ISRG.
what I kind of want you guys to kind of look at this history tab that I have here. The call wall has kind of stayed steady at 175. The key delta strike has rolled up from 155 in last expiry up to 175. And the key gamma strike has gone up from 160 to 175. So 175 across the three, like everything has rolled up to it. And that is what is confirming a pretty strong gamma to me. Like it's like this is where like peak delta is peak. Well, not peak delta, like it's above this. Dealers have to chase delta, dealers have to chase gamma. The call ball is right here. So this is like the biggest call concentration.
Let me ask you a quick question here. If you had
What's
to
up?
make a call on Netflix, all right. Oh, sorry. keep doing what you're doing. I apologize. I'll ask you
Sure.
after. I got two questions when you're done.
Yeah, for sure, man. And then if you look at the put wall's rolled up from 150 to 172.5. I don't like that. That's a very narrow range that's happened. This means that there has been some like put selling that has happened in the last day. But that means somebody is looking for a pop, and this might not stay. Generally, everything going up is bullish, but this, like the range being essentially what it's telling me is between 175 and 172.5, that is very suspect to me. And this is, again, I'm looking at PXN. I need to make this smaller, guys, just so I can read this a little bit better. Fixed strike matrix. Yeah, there's more reaching for calls up here too today. That doesn't really tell us anything. It's volatility skew is insane. Like, yeah, people are definitely, it's a smile. There's no edge here looking at all of this for TXN. Yeah. Anyways, Cap, you were asking.
Okay, so don't if you're listening out there right now, don't be like, hey, they called this, they called that. This is more like shit, hold on a second here. I'm doing something in the background. I want you guys, or how about this? Trader Podcast. If you had to say Netflix ER and guidance, do they beat on their ER? Don't worry about it. Just like off the cuff, like putting you in a position right now. Do you feel like, or do you think they beat ER, or and then do they have good guidance or bad guidance?
So here's
what
I'm going to say.
Or in line. You guys get three choices.
Yes. So I'm going to say they're going to slightly beat ER. They're going to be small beats on EPS and guidance.
Okay.
But it's not going to be as big as what the market is pricing in.
So do you think ultimately the Netflix is down or up in the open tomorrow?
So we talked about that earlier. And, it's kind of like what I like seeing. Like, okay, so if you can see my screen right now, Cap.
Yeah, I'm watching.
500 is like the call wall, right? But what I really like is all of this, build up of calls above the 500 strike. We're trading, I think we're trading like 490 or something, like right around there. Is that right?
We're trading 489. Parked right on that hourly trigger right now.
Yeah, man. So 490, if you see like right here, there's like a big call gamma, but there's call gamma at 490, 495. There's big call gamma at 500. So everything above like 485, like there's attraction to the upside.
And chasing, right? You have the dealers helping out.
Exactly. The dealers will have to help out because a lot of them have sold these calls, right? So
that's right.
And then, and over here too, there's, above the 490 strike. So my cursor's on 490 right now. Everything you see above the 490 strike, the blue stuff, that's puts. These are going to start losing value. There is a lot of thrust up to 500, right? And I could see that happening. But unless it is, and this is where like the steepest move is on this gamma curve as well. So up to 500, but then it starts slowing down. And so what I'm trying to say is if earnings are not bumper, right? These calls, they're not going to like have much of an impact, because the only time the impact starts happening is like, oh my God, we underpriced Netflix too much and we need to chase with these calls. And then you get an explosive move and you're looking at like I'm looking at 550 as a target there, because there's plenty of gamma. Like there's plenty at 510, there's plenty, this is 510, this is 520, this is 530. There's plenty of stuff there, like they're going to be like, okay, let's go, let's start the chase. But the issue is looking at this, the last time I saw something like this was at an ER for NVIDIA, the last ER. And it was around the $500 strike. There was just calls on either side, and the $500 strike was like monumental. And they had a good ER, but it wasn't as great. So price fell a little bit, like they popped a little bit, but the next day price retreated. It did not go up above 500 significantly. So that's what I'm concerned about.
All right,
Like
so I want you to tell me, is Netflix going up and be green in the open tomorrow or not?
Oh my God!
Answer the question. You could be wrong, dude. No, dude, this is the magic of streaming. Are we fucking gonna be green tomorrow on Netflix or not?
Okay, we're gonna be above 490.
About 490 on the open tomorrow. Good.
No, we're gonna be above 490.
Oh, above 490 tomorrow. Okay.
So above where we are, like that's I want to say that.
All right, cool.
I want to say that where we are right now, like what options is looking like, we're gonna be above that.
Yeah, your time and market, your experience, everything you look at ads on your own. What is your call? It's okay to be wrong. I get this shit wrong all the time, man.
If I was playing Netflix for earnings, I would be selling a next week 520, 530 spread.
Cool.
That's what I'm saying. Like I would take that position because to me that's like a less risky position than expressing an upside or downside. I think there's going to be a measured upside, so I can capture some value in a credit call spread.
Mm-hmm.
So that's the way I would look at it. Like right here, like these two nodes is what I would be targeting, 520, 530. So
I think they're generally in line with their reports. I think their guidance is going to be really good. I think they're going to talk about tailwinds with the strikes, and then
see the other thing, So the thing is, they released bad news yesterday.
Yeah.
Right, and they released good news today.
Yeah.
So what are they going to release during ER? Everything is getting priced in right now, and there's still so many calls above, and that's why I'm like, oh, I don't know, like that they need to like go in and really nail, the guidance, and basically say like we had a bumper year, and we're gonna have a bumper year for the next 3 years, and then the chase starts. Right now, given how the action has been, given how 500 is the call wall, and the way the option structure just looks, man, that just looks to me, this looks to me like this is trying to, like, the option traders are trying to price a much bigger move, like in EPS and in guidance, than what the consensus is. But we've already moved up so much. I don't know if that's really going to happen. So that's where I stand. I know it's like, it's not, are we going up, are we going down? But like, I think we're about 490.
I think that people there's so much mincing of words out there in general. Protect you, what you say, all that kind of stuff. That I think people here tend to like a simplified answer. Like, what's your take? Like, I can sell you the up and down all day long, and be evasive. Myself for Netflix, I think the initial reaction is going to be flat to down, but I think the guidance is going to come out. It's going to be ripping into the open tomorrow. And then, what are your thoughts on Intuitive Surgical? Because I think that I'm bearish on them into their ER today after the close. I'm bearish on Intuitive, and I'm flat to bullish on Netflix. Though I agree with you on the options chain. They need something. They need to beat big on. They need to beat big on their reports, and then their guidance needs to be smashed
out of this
too.
world.
Yeah, it has to be, or it gets repriced.
Yeah, and that's where, like, I'm trying to say, like, this is trying to price in a much higher upside.
Yeah.
Than I think is possible.
One other note to all of you out there too is, as we come into this close here, it's now 2:18, but there's oftentimes into these reports a pinning action on the indexes. So be careful. You might see like a squeeze in the individual tickers as they report, or a bloodbath into their reports. But then what you'll see is like a sideways and down action to the indexes if they can get impacted from some of these reports. Netflix should impact Qs and SPY. So you may not want to be even trading that until 401, believe it or not. You see like blood heading down into if you do see blood heading down into 401, PM, and
Cap,
then you
now
jump on that
somebody's
trade.
selling puts on VXX now.
Nice.
So that's what's this is interesting. We are picking up flows of non-SPX put variety.
Nice.
You know, because that's telling you puts are not going to pay. The implied volatility chart, like this, is telling me puts are not going to pay right now. And so whoever is doing this, whoever is trading the VXX is saying that, okay, puts might not pay straight up, but I think volatility is going to pay me straight up.
Do you think if Netflix, go ahead, continue.
No, if Netflix dies, I think markets, like tech earnings, are not going to go well.
Yeah, or at least
like
for the
2
first
years
report
ago.
or two, right?
Yeah.
CNBC's going to come out and say stupid shit about.
Yeah, they're going to say like, oh no, you know, is this the end of streaming? You know, like Disney's going to take a dick if that happens. Google might take a dick too, because YouTube is one of the only like money generating places they have right now, because search is getting
all
decimated
tech's being
by AI.
repriced into their earnings now, and then of course you get good reports and they blast off again.
Yeah, and that's the narrative that has been there in the market. Like, we are too low, like expectations are too low, except for Netflix, because they released a bunch of information before. So you know, it's like ripping into it. But see, it used to be like everybody like really paid attention to Netflix, and this was like during COVID time and like right after COVID time, everybody paid attention, because the way Netflix went was the way Google was going to go, was the way, you know, like advertising was going to go, because that's essentially what it is. Like, how much screen time is like the average consumer spending on screens, and how much of their attention can we get? Because essentially that's what it's telling us. And so I think people are going to remember that again, especially because Netflix is now back at the levels it was.
Says their IV right now is at 7%, and or the expected move is 7% move.
Right.
And then I'm going to check their history right now to see what. So they tend to follow their report pretty big in a productive way, up or down. Netflix does.
Right.
And historically, I'm looking at their historical ERs right now, and Netflix tends to follow their trend as well. So if Netflix is heading higher, they tend to, after their ER, continue higher, or if they're tending to go down, they tend to go down. Not every example, but I'm looking back here into
let's see,
January of 2022, and they tend to follow their super trend.
Right. So this was their last. See, when they had the last earnings that I have on here, yeah, it just kickstarted like a bull run. Like,
that's one example where it went the other direction, but the other like 9 or 10, of the last 9 or 10 reports, they stayed right on trend. Actually, that was on trend right there too. So that might have been one of the on trend ones.
Yeah, and then this one was like, you know, it popped and then set up a bear plane into the next earnings. So yeah, they will, like, you're right. Like, once this
I'm looking at every single one of them, dude. Last like 10 of them right now, and they stay
this
on
one
trend.
this one went, you know, was decent earnings or not, but it kind of like the weekly picked it up and took it high to the next earnings. Now here's the thing, I'm gonna try something. I'm gonna look at something really, really quick. This earning bad all the way down, and then this earning bad all the way down, this earning good. So bad, good, bad. Well, this was good, but it's undecisive. Good, bad, and now good. And so the thing is, do we get good or bad? And we are 393 is the monthly trigger. 439 is the weekly trigger. We are above the daily. So just seeing, if you just think of this, I like to think of this as like super trends as well. I know that's not necessarily what the trigger is for, but this to me like kind of tells me that there is move to continue hugging and keep going.
Yeah, those triggers do match up to that too. So you do get super, and there's some other key points on that. If price is above that blue line is your bull market, or is it for the individual ticker? If price is below it, you're in a bear market for that ticker. Price is above it, you're in a bull market for that ticker. Then the orange line is the weekly. That's the emotional line. You'll see people get really frisky when price is below it, or when price is stretching past it.
Right.
And now
So
we're trending up and above all of those lines. We're generally bullish here. Even if we have a bad ER on Netflix, unless they break below that monthly trigger, they are in a bull run right now. Everything's positive right now on them.
Right, exactly.
And then you've got your intraday and weekly trends on the daily and hourly. That's where you get like your 1 month, weekly, intraday kind of stuff.
Right. So with Netflix, I think, that's an interesting ISRG. I think.
So you'd be hoping today if you'd have I guess my point on that would be, you're in a positive environment with Netflix right now. If they don't have a completely fucking awful report or guidance, and it still sells off for what he just showed on that chart, you'd be looking to buy that dip. You pick like 100 tickers, and you're like, okay, I got 100 tickers in front of me. I know what tickers are bullish or bearish, and if I get a report that's not so bad, look for an entry. Matter of fact, we had an AMD trade like that when they didn't bring up AI, and then a week later they did. They sold their fucking ER. This is 2 or 3 reports ago. They sold their ER, and they didn't mention AI, right? And then a week, and it was like there was like huge short interest to cover a day or two later. Then they dropped the AI shit, and it was buy the dip and run with it. So when we were questioning that as well, like, why did they sell this ER? And it was more of a function of the options market, and you should have still bought that dip. And Netflix, to me, would be one of those tickers if it does sell at the close that you'd still.
Yeah, no, I think they're making good decisions, right? Like they had spent so much money, they were not getting, like the revenue from their
repriced, right? They repriced the ticker, so they went through a correction. Fuck yeah.
Yeah. So, but again, I don't think it's gonna break 500. So,
well, Joe Donut told me that NVIDIA. I remember in the beginning of the NVIDIA run, he said everyone out there said it's a scam, right? And it's gonna go back down to zero and stuff. And I was like, yeah, but not before it hits $600-700. And people were like, get fucked, that ain't ever happening.
So, did I ever tell you when I opened my NVIDIA position?
No. Tell me.
No. So I opened my NVIDIA position the day I made my first deepfake.
Nice.
Hells
yes.
So when I made my first deepfake, I was like, all right, if I can do this sitting at my home. Now I have a nice computer. Like I work with, like big data sets. So I have like a nice computer and I have a nice graphics card in it. And I made this first deepfake, and I was like, if I can do this in like a year, everybody can do this. And it was actually a year ago, like 4 or 5 days ago, that I made my first deepfake. And
was it really a year ago, 4 or 5 days ago?
Yeah.
Congratulations, man.
Yeah. So that's when I opened my NVIDIA position, and I've been an NVIDIA bull since then because I see the value. Everybody says this AI thing is a fad, dude. Like, give me like some Celsius and like 5 days, and I could build a company that writes marketing copy, generates images, writes newsletters for you, and I could just make your entire like half of your marketing department obsolete.
Yeah, dude, this is it's weird. Joe and I were talking about this too. We were like, this isn't a phone, this isn't a car, this isn't an EV car. No. Excuse me, this isn't the
no,
the
we're gonna
start
see
of
like
something. Like it's the only thing that I see for a black swan is if either the UN or a nation state puts major controls on a chip producer or AI for their country, specifically like the United States.
The US is not going to. The EU might try to do that. They're
EU, yep.
Yeah, but you know what? That's fine.
They'd probably be the first ones, right? If there was a group.
But that's fine. They'll all use our services anyways. So
yeah.
That's what I have to say about that.
I get that. So like an event, like something happens due to AI or is blamed on AI, AI, excuse me, that would be the only. Those are the two real risks to the price of AI. But other than that, I mean, the door's been kicked down, right? The door's been kicked in, and it's the future. It is the future, or at least in my view, it is.
Right. Yeah. See, I use ChatGPT every day. Like I do a bunch of programming. I'm like kind of sitting here like talking to you guys today, but I do a bunch of programming, and I'm not a programmer. I just use ChatGPT as like my pair programmer. The flows are coming in, guys. Like this is looking very bullish to me now. We are negotiating, the 30-minute trigger, and we're kind of back checking the 5-minute. Now we're like getting ready to look at that. There's like no more puts coming in, and that's my indicator. If somebody thought market was going down, they'd be buying puts right now. Nobody's buying puts right now. So,
all right. So, do you guys have any more questions? You want to say thank you to Trader Podcast for coming on? What do you guys got out there? Skynet will eventually kill us all.
Right. And then party on Garth. And you know what? I am okay with the computer being an overlord.
I am, as long as they keep us.
Yeah. As long as, they'll be consistent, though, with their decision making. So there's that.
I always wonder about that, dude. It's like, how do you make profit if, how do you make profit if everything is defined? It's like having AI attorneys, right?
Well, see, here's the thing, too. Like,
you have more defined outcomes.
Yes and no, because the thing is, we cannot understand the internal logic of a lot of machine algorithms, machine learning algorithms, right? We can't understand the logic because our brains are not wired or programmed to visualize multiple connections. I think there was like a study done in 1960 that kind of like looked at, hey, how much information can humans hold in their brains at any given point of time? And depending on the person, it was either between 4 pieces of information or 12 pieces of information. And they kind of averaged that out to be like, okay, about 7 to 8 pieces of information is what you can keep in your mind at any given point of time. So if there is a lot of data that is being fed into a machine learning algorithm, right? And it's using like hundreds of connections and hundreds of, relationships within the data to like come out with an output, there's no way a human brain can understand that. We cannot visualize it. We can't do it. So what will always happen is people will say that machine learning algorithms and these AI technologies are black boxes. And they are, because we can't visualize them. And the problem occurs when, based on the data, and like something like small being changed within the data, right? You get a vastly different result. Like saying the algorithm, if it's a trading algorithm, saying like, buy instead of a similar situation, which is everything is the same, but let's say like the VIX is like off by like 0.05, and it says, no, this is a buy now instead of a sell. So, the human cannot attribute like, why is it telling me one thing versus the other when like consistency is like what I really look for. And this is what a machine learning algorithm is supposed to do. So that's because the internal relationships have changed.
Would it still come into play then, the human aspect? Let's say you had an attorney that was a AI, and then you had a DA that was an AI, and they were running different outcomes. Do you think that as a DA you would want access to a defense attorney's AI so that you could run their probable outcomes as well, or no? Do you think that then begins to muddy the outcome? Yeah, like if I was DA, I could say, well, I can run all this through and find out if we're going to win or not, this case or not.
That's interesting.
It's a tough one, right? Then you got different. Like
this is a tough one. No, so the thing that I will go back to is where it was in Jersey where they started using AI to determine if you were going to get bail or not.
Yeah.
I don't know if you heard about this.
Yeah.
Happened a few years ago, right? So the issue becomes is like, what is that algorithm being trained off of? And what they found, like they did that for a little while, and they found that, hey, this AI algorithm is basically saying that if you're African American, you're not getting bail. And that was because historically the data that had been given to it, like fed into it, had, higher instances of African Americans not being given bail. And even though it does not use, they said it is blind to race. but they were giving it information like which zip code did the crime occur in that this person is like accused of, which zip code did they live in.
Yep.
And then, if you look using historical data, they would, be like, oh, if this person who lives in a predominantly black neighborhood and the crime occurred in predominantly a black neighborhood, historically, we haven't given that person a bail.
It's wild too, you saying that.
So they basically ended up, rejecting that, not doing it. And that's why, data integrity and, like AI safety became like a clarion call, like this is what we need to look for. But
it's fascinating. Good.
So I think an application like that of AI, where like the AI is the DA and then other AI is is your defense lawyer. I think those are there's more stuff we need to do. There's more data we need to do. There's a lot more like things we need to feed it before like it becomes usable. Where it is usable right now is if you're sitting and you want to start a company or a trading firm and you want to use the file the paperwork, ChatGPT will help you file the paperwork, or an AI from like something that allows you to that's been trained on standing up businesses or whatnot will be helpful. So what I'm trying to get at, Cap, is that we are the best value right now is not just leaving an AI agent by itself to do something that might be subjective. Mechanistic projects, that's fine. Subjective projects, not so much.
Yeah, like a bureaucracy would put that AI right in the. If a bureaucracy was making a decision about your, I don't know, immigration status without any kind of an outside input, or let's say you're, I guess you're on a probation or something. If you're arrested, and they're using AI to punish you or something, or manage your punishment, and you had no other inputs from any other source, they would use something in their own favor, right? At some point,
right.
And then to your point on the data set collecting, I noticed last week I was talking about how some of the data might not even be accurate. Like you're saying, they can't look at race, but then they're looking at demographics and postal codes. You might have had a 10-year period where maybe African Americans moved out of a neighborhood. Now you've got Caucasians living in this one neighborhood. And the data is good, but it's not good, right? It's like 10-year-old census data or something like that. So it can really impact decision-making in a negative light, right?
Right.
Or give you a false sense of, hey, they're not going to be racist towards me because I live in this white neighborhood, but then because of the color of my skin, I'm going to get fucked anyways, right? Or something like that.
Right. And that's why I think because all of that stuff is like subjective, right? And that's why I don't think we are going to see mass adoption of AI by AI agents by themselves with autonomy in those areas. And that's why I think the real key is going to be like, how do we like put an AI agent with limited capacity to improve optimization, like basically optimize a part of the task that the worker does. And I think that's where, like there's a conversation piece yesterday that I read where it was like, hey, don't think of, NVIDIA and AMD spending money, like gaining data center share. This is more like they are going to be gaining worldwide IT spend share. And I actually agree with that statement. That's why I'm like omega bullish on both these companies. Duopolies have existed in America and they have built America, so Marathon, like if you look at the oil companies, the oil barons, they kind of like hated each other, but they worked with each other. Pepsi and Coke hate each other, but they work with each other. MasterCard and Visa, they hate each other, but they work with each other, right? So, this is how duopolies are where like new industries are like built. And I honestly think that there's going to be enough of an ecosystem start building. You don't get mass adoption of things unless you have an ecosystem around an innovation. There's lots of studies in sociology. There's studies in information technology that have talked about this. What you need is an innovation ecosystem together to really push through, a new development. And what's happening right now is the innovation ecosystem is going to be in tier 2 and tier 3, which is going to be like the software products that come along that use all this new AI technology. So I see for the next 4 or 5 years a bunch of products, bunch of software that comes out that incrementally, uses AI to help out. I don't know if you saw what Adobe's done with Photoshop. They have generative
Crazy.
AI now built in to Adobe AI, to Adobe Photoshop.
Crazy.
So, right. And now what that really does is, like, for your average, media creator who's making like images and stuff and using Photoshop, they can do that much faster. And that is the operational efficiency in like all these like small, like niche areas that it's going to come out, and it's going to be very specific. We're not going to get a generalized AI, but we're going to get specialized AIs, ASIs, artificial specialized intelligences. And we're going to see a whole plethora of them, like thousands of them, for different use cases. And I think that's what's going to like really move the economy forward. We are, in a way, in the next gold rush. And you want to be selling picks and shovels, and the picks and shovels play is TSMC, is NVIDIA, and is AMD. That's my thesis, and I'm gonna stick with it. Yeah.
Pull it here. Yeah, I gotta do something here in the background. That's Netflix, and then we've got ISRG down here. Make sure everybody can see this on the chart.
Right. I see.
So you like selling the shovels and not good. Go on.
No. So actually, picks and shovels is the first wave and second wave play. So NVIDIA for the next year or two. The real money maker is the software, and finding where the software or the next
that was my question
big software kick is going to be, because that's what moves technologies. Like the internet had been around since the 70s, but the internet didn't take off till AOL Messenger and email became a thing. And those were the sticky software uses of the internet. Oh, I can have instant messaging, and always, this is going to sound really weird. Pay attention to what the porn industry is doing. The porn industry is always the leader when it comes to the use of technology. They were the first ones.
New technology.
Exactly. They were the first ones to take, money online. So credit card processing, they were the first ones to do it online. They were also the first ones to have 1080p streaming video. They were also the ones to do a VR 3D
with no buffering issues, like compressing all that stuff. They were first.
Exactly. And so keep an eye on what porn is doing. And I don't know, like I play around with AI, dick around with it all day. And I know that within like 2 hours, I could create a pipeline where every day I could create an Instagram thought doing like a stupid TikTok dance. She's got like, and then just, kind of like just have an OnlyFans page for her or whatever and just rake in money. People are doing that right now. All it takes is about 2 hours to like set it up, and then, like about 30-35 minutes of processing every day. And people are running farms of this. There's a real concern amongst the OnlyFans community, creator community, that AI thoughts are going to make your, typical Insta thoughts completely obsolete. Like, why do you do that? And then to top it off, you can use a large language model with the Insta thought, and you can have them text message back and forth with your subscribers. So
I was thinking about just the PayPal maybe, or the online banking with using AI and lonely people, or people trying to break it, like just trying to break through what they're doing. I think you get your Twitter up right now. Be careful there.
Oh, sorry. This is Black. I followed Black Swan, so like he just responded, and I was like, "What is that?" Oh, it's a canned response. Okay. Anyways, so that is weird to look at this. We're just no calls coming in right now, but all those puts being sold, and market is going. So there is no fear right now.
All right. So I want to say thanks for coming on today. I appreciate your time. I think everybody here in the stream appreciates your time as well. Please follow at Trader Podcast. It's TRADER and then PODCASTE, like a caste system. Find him on Twitter. He's also quite internet famous on Wall Street Bets. He posts meme, I would call it a meme videos, usually with J Powell, some other people in there as well. So you probably see his memes all over Twitter and the front page of Wall Street Bets as well. He's a friend of the shows. We're trying to actually pull him in and try to get him here more frequently, and maybe even start to do some kind of a market uptake kind of a thing down the road or whatever he's interested in. He's in the chat all the time. He pops in and out all day long. So if you have any questions for him, give him a big shout out and thanks for joining us today.
Something just happened with Moderna. Thank you so much. Something just happened in Moderna. There's a lot of calls coming in, and somebody just sold a lot of puts. And 104 is the call wall. So somebody's trying to reach for that right now.
Moderna, baby. All right.
So anyways, all right. Thank you so much, everybody. Have a great day.
All right. Oh, let me switch back over here. I put up the screener. Oh, no, did I do that wrong? So right now I've got I can switch over to this screen right here if you want. This is showing SPY, Qs, ISRG, and Netflix, or I can go back to the main screen, and we can go to the main screen here if you want. Here, hold on here, main screen, and then what I could do is come back to this chart possibly. Let me see if I can jump on this and put it back to a one screener over here. And we can stay on SPY for a minute. And then towards the end of the day, we can come back to, I'll pop the 4-pane screener up for you guys a little bit closer to 4 p.m. Does that work for you guys out there? Yeah, all right, so I'll do the mainstream for right now. And at about 3:45, I'll switch over to the 4-pane screen that shows you the reports. So if you guys want to stick around until after 4 p.m., you're more than welcome to. I will put an NFLX for you into the close here. And what else? I will be back with you guys at 4 p.m. for that report. Code for Spot Gamma. I used to have a code for Spot Gamma. There might be one in the description. If you guys check YouTube, I think I do have an affiliate link for Spot Gamma inside of the description of the video down below. So if you just go to the actual live stream, there is a code. Let me take a peek, see if I can find one right now. Hold on here. Let me see if I can get a code here. Let me check and see if I got a code for Spot Gamma. I think that I do. Let me check here. I think I did and then I didn't, or it doesn't work anymore. I don't know if this actually works. Let me check here. I think I got one right here, so let me just check and see. I think I see one here. Hold on, I'm missing some. I'm missing some of the chat here too. Hank, some of you guys, someone just tipped, I think, and had a question. Let me get back to that here in just a second here. Details. Let me see what I got here. Spot Gamma. I don't know why that's not showing up. I have one in the description of the videos. Let me let me see if I can do this way. Go to my channel? My channel right there. Go to my channel. And then let me videos maybe. Yeah, I don't see them here. I don't know why. I got to talk to Binky about that. And then if this one works. Hold on here. More. Here we go. I got a Spot Gamma link right here. Copy link address. Okay, we'll turn that off. And I'm going to read. Here's a link to. Hold on here. Here, I believe this link works, but I'm not positive. Can I please do Tesla? Here's a spot gamma link. I don't know if this is going to work or not. It's telling me no. That's so weird. Anyways, in the description of these videos, in the description of the videos on YouTube, there is a link to spot gamma, but I don't care if you use it or not. Kevin Hill is asking me to do Tesla, so we can talk Tesla here for a minute. Tesla, so this is the Tesla chart down here, okay? So Kevin Hill, this is Tesla down below. We're cycling in and out of it. I like to see Tesla velocity at minus 50 or more. We're at minus 25 right now. We've had 2 attempts at a breakout to the upside, but I still expect Tesla to reject. So we had 1 failed breakout. Here's another failed breakout. I am expecting still a breakout. I'm hoping for a breakout up here to that 232. And I have 235 calls on. That's the trade that I'm on right now. And then I'm expecting more downside to come on Tesla. Now, we can get a failure and just bleed down as well. There is some real risk here. Downside targets, 165. With this wave of momentum coming down right here, we're opening up doors downstairs right now to $68. I'll be honest with you. Not guaranteed, but the percentage probability of that happening is increasing as time passes to that downside move. I don't know what that negative news is going to be for you. But for right now, Tesla 30-minute chart stating that we are not ready to buy a dip that's more like not permanent, but for a significant upside move, we haven't hit the place yet. So even if we get a move up on Tesla, I'm not expecting 400, 500, something insane like that, or even 300 or anything like that. I'm expecting another downside move to come. So until we get that minus 50 or minus 100 on Tesla, there's no sure thing buy on it. Maybe I could rephrase that. So on a short-term basis, Tesla, I'm still looking for a turn to the upside, but I'm looking for that turn to fail, and I'm looking for more downside to come. And then those downside targets, they're growing in probability every day right now. Does that answer your question, Kevin, or no? Are you looking for a dip to buy or to continue to be a seller, I guess would be the question to you. If you could answer that question in the chat, I'd appreciate it. Almost kind of a failure up here. I guess you could drop this one down a little bit. There's the gap kind of goes right there. I would have liked to have seen more squeeze, and I still want to see more squeeze right now on SPY. Get that going here. Are you still there, Kevin Hill? Hey, Kevin, do me a solid, man. Send me a DM, brother. If you're not a member, if you can't chat, there's 2 ways for you to chat. You can chat on Twitch if you sign up for Amazon Prime Gaming and subscribe to me via that way. If you don't want to tip again, you don't have to tip, man. Just hit me in DM and say I'm a buyer or I'm a seller, and I'll talk to you more about it. But for like that, hey, buy a dip, I'm buying the underlying, we are not there, dude. Even if we go up from here, that is not the place. Sucks to say that, doesn't it? Yeah, I can't. He made a post earlier. Kevin Hill on YouTube made a post earlier. Let me. I'm going to open all 10 of these. I'm going to turn that off. Turn this off. Turn that off. Turn that off. Turn that off. I'm going to turn this off here and that off there, and I'm going to go in here. I'm going to shut that down right there. I'm going to go to this over here so I can read your chats. And then I'm going to load that chat over there, his Twitch chat. All right. Trader Podcast joining us live today, giving us insights into the markets and what he has some expectations. Also gave us off-the-cuff kind of a picks for the close today on the reports. And what else we got going on here? I think that's all I got right now. Poke the Juice Box, I appreciate you asking for the code. I got to get a bunch of new codes. Someone mentioned that the codes that I have before, I think they did update them for me, but I'm not positive. All right, I will be back with you guys in just a minute here. I'll be back with you guys at closer to 3. If something crazy happens, I'll be back. I'll be back with you guys at 3:45 for that report at 4 o'clock. Oh, here we go. Dubbed the mother of all breaches, the massive leak revealed 26 billion records, including popular sites like LinkedIn, Snapchat, Venmo, Adobe, X, and formerly Twitter. Hey, what's that coming from? RW6869. What's the mother of all breaches? More. Who's that? What company is that had the breach? Shit, I got Venmo. I got LinkedIn, but I don't use it. Adobe, I've got that. I've got X, and they got all my shit at X. Yeah, what ticker is it related to? RW. Are they trying to relate this to Spoos? Maybe. I'm not seeing it hit the wire on the feed here yet. I'll look to see what they say. I was gonna say that the mother of all breaches. Who posted that? Was it Gergovin? I'm not even gonna. How about this? Did Gergovin post it? It sounds like a word he'd use or a phrase he'd use. Mother of all breaches. Yeah, who's the news feed brother? Did that come across the wire on a specific ticker, or is it just market wide? Oh, it's Zero Hedge. Got it. Okay, I'll be back with you guys at 4 p.m. Doesn't it sound like Gergovin? I'm not trying to make fun of Gergovin, but it sounds like some shit he'd say. Or Zero Hedge. We are breaking through right now, trying to break through that wall of sellers to the upside here. Looking to squeeze right now, Spoos, all the way up to our 144.84. Target above that. You see that red line, that red box up here? That's the target up there. For some reason, CNBC, man. Let's go, CNBC. Let me press play on this thing. What's going on, CNBC? All right, we'll turn that back on here in just a moment. And I'll be right back with you guys. It's like Tesla, is there a dip buy here? Yeah, there is. I'm long Tesla here, but I'm not expecting much out of it. Matter of fact, my expectations are getting lower and lower as time passes.
Now.
We got a little more than 2 minutes left in the program. Several more stories we want to tell you about. Number one is 2024 Oscar nominations out today. Oppenheimer in front with 13 picks, including Best Picture. Barbie trailed behind with 8 nominations, but surprising to many, Greta Gerwig was not nominated for Best Director, nor Margot Robbie for Best Actress. And when it comes to production, Netflix came out on top as the most decorated producer. Wow. 18 nominations. Apple received 13. This tells you about the changing business. It's not the studios per se. It's these studios, Netflix, Apple. They are the studios.
Well, and they're getting big name stars to go into really serious, deep movie. You know, the quality that you are seeing on streamers is really remarkable. Yeah. Well, we'll have to wait and see how all that shakes out.
They got the money.
Johnson & Johnson has reached a tentative agreement to settle an investigation into the marketing of its talcum-based baby powder. The deal includes 42 states and Washington, D.C., with J&J set to pay nearly $700 million to settle the claims, although they continue to insist that their talc does not cause cancer. I will say one thing to factor in here is that usually in these kinds of situations, insurers end up being on the hook. Yes,
they ultimately fit the bill here. Their liability coverage kicks in. Interesting. All righty. The world's top hedge funds raked in record profits last year amid a resurgence in stock markets. New analysis shows the 20 leading fund managers made $67 billion in investor profits in 2023, up from $65 billion in 2021. Included among the best performers were Christopher Hahn's TCI, Ken Griffin's Citadel, and Andreas Halverson's Viking. The company's doing well in bull markets. They did not have a good 2022, relatively speaking.
And Alibaba co-founders Jack Ma and Joe Tsai have picked up more than $200 million worth of company shares between them in recent months, according to a regulatory filing and the New York Times. Alibaba shares down roughly 21% since the planned spinoff of its cloud business was canceled.
All right. Thanks for watching Power Lunch, everybody.
And Closing Bell begins in 5, 4, 3, now.
Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make-or-break hour begins with the recent record high for stocks and whether the bull market is too stretched or if it is just right. We'll debate that in just a little bit with two well-known Wall Street watchers on two very different sides of that debate. In the meantime, your scorecard with 60 minutes to go and regulation looks like that right there. Dow is trying to get off its worst levels of the day. It's moving that way. S&P, NASDAQ now positive. Well, 3M's been dragging the Dow all day long on the back of its earnings report. That stock has been weak. Look at that, by 11%. Weakness as well today from Goldman, from Home Depot, and Travelers out of the insurance space. They're all in the red at this hour. On the flip side, United Airlines a big winner after beating expectations. We're also watching Microsoft here. It's been making a bit of a midday run, trying to hit $3 trillion in market cap. You see it steadily creeping higher through the session. We are watching yields pretty closely, too, as the 10-year hits 4.15. The 2-year moved above 4.40. We did have a pretty good bond auction earlier, and maybe that took the simmer off of rates today. It does take us to our talk of the tape. Is there enough going right for stocks to keep going up? Let's ask Greg Branch. He is the founder of the Veritas Financial Group. Our bull, Brian Belsky, chief investment strategist with BMO, is going to be along shortly. The stage, however, Mr. Branch, to begin, is all yours. Is there too much exuberance in this market or not?
Surprise, surprise.
Turkish
Scott.
parliament approves Sweden's
so.
NATO
look,
membership bid.
From someone who readily admitted that I missed much of the performance in 2023, who readily admitted that on December 13th, when we had the Fed's posture pivot, that even I had to increase my exposure or let I miss more performance. But when we look back at what kicked this rally off, when we look back at all of the fire that was thrown, all the gasoline that was thrown upon the flame, much of that has reversed, yet the market hasn't reacted to that. And so let's talk about the jobs number that came in at 150. We'll talk about CPI core that came in at 20 bips back in October. All those things leading us to believe, or at least leading some to extrapolate, that we had reached a new paradigm. Well, those numbers have reversed. We jumped back into that 30 to 40 basis points of month-over-month core growth for the last couple of months. We saw the jobs number rebound. We're seeing historic low claims again. And so even though we had a posture pivot from the Fed, even that has reversed to some degree, where you have even the most dovish members like Bostic, like Waller, coming out and trying to say, as diplomatically as they can, wait a minute, We're not looking for 6 or 7 cuts. We're very clearly saying there might be 3 cuts, and we're very clearly saying that none of that is going to happen on March 31st. And so we once again have a very bifurcated situation where the market expectations are very different than what the Fed has articulated, very different from what the Fed said that they would do. And even the things that I think caused the rally at 22 times, we're just not seeing those things continue, and we're not getting the earnings to continue to propel this rally.
But why are you trying to find bad news in the good? I mean, you can't have it. You can't have it both ways. You can't say, well, we're going to have a recession. We're going to have a recession. We're going to have a recession, and then the economic data remains stronger than you think, and then say, well, now the economy's just too strong, and that's going to force the Fed to keep rates higher for longer, when the evidence would suggest, and the trend would certainly suggest, inflation coming down, growth remains good, the Fed regime is changing, they've made a pivot, they're going to cut. Who cares if it's March or not? Cuts are coming. No more hikes are coming, more than likely.
Well, the devil's in the details here, Scott. And I never use the R word. I challenge you to go back over 2023, because it doesn't matter what we call it to me.
Well, you cited the long and lag effects of the policy. You intimated that that's where we were heading. Come on, let's not get semantics here. We both know what you were inferring.
Of course, and I never back away from what I infer and what I state explicitly. And we do need more slowing. We need more slowing. We can't, as you just said, we can't have this both ways. We're not going to get to a sustainable 2% number at the rate that the economy is growing right now. That's just not going to happen. It has never happened in all of history with these type of financial conditions. And so we do need more slowing. We are seeing some. We are not seeing enough, given that we are still fighting this battle with inflation. I don't think we can call it over. I think the Fed goes to great lengths to remind people that we can't say that it's over. And so I'm splitting hairs a little bit here, Scott, but it's not slowing fast enough for the Fed to have to cut. And it's growing too strongly to say that, yes, inflation will get where we need it to get. Inflation will meet the Fed's mandate on its own.
I'm glad you bring this up, because it could not be more timely for commentary we got from James Bullard. Now, he's the former St. Louis Fed president, so he's retiring. However, he gives an interview a little while ago in which he says the Fed could begin lowering interest rates before he expects that they will, before inflation hits 2%, and that it could come as soon as March. Quote, they don't want to get into the second half of 24 and inflation's already at 2%. You still haven't moved the policy, right? That would be too late. Inflation on a 12-month core basis, could get to 2% by the third quarter of this year. So, I mean, that was an influential member, maybe non-voting on the Fed in this particular go-around. But nonetheless, there's your Fed speaker who suggests inflation is going down at a fast enough clip, and they're going to cut rates before it gets to target. And they told you that themselves.
Well, like you said, non-voting member. We had 3 voting members come out and say that it's unlikely that it'll be March. I guess we'll see. The key to me, Scott, is that hidden in that December 13th notes and the dot plots is that the Fed expects that we're going to get to an unemployment rate of 4.1%. Now, that in and of itself has been revised. They used to say mid-4s, but let's take 4.1. I haven't done the math the way that they have. We're right now at 3.7. We're still getting lower and lower claims. We're still getting lower continuing claims. I don't see how we get to 4.1, and I think it's incumbent upon the Fed to explain to us how we get to 4.1% unemployment in the current environment with financial conditions.
They don't need it to. They don't need it to get higher. In fact, they don't care about that anymore. What they once thought.
What they said in the notes, Scott.
Well, what they once thought doesn't need to happen. They don't need to kill the economy anymore like they first thought. They needed to crush demand and they needed to have unemployment skyrocket to kill inflation, because they come to the realization that the inflation that was caused was not primarily caused by some excess demand within the economy because of the growth. It was caused by existential things that happened as a result of the pandemic, plus some stimulus that was piled on top of it.
So when you say that they no longer believe that, I'm referencing notes that were from the December 13th meeting. I'm not referencing things that were 6 months ago or 8 months ago. If they changed their mind in the last 3 weeks, I guess, or 4 weeks, so be it. but I'm referencing the latest thinking that was intimated in the dot plots of the 4.1%, downgraded from the 4.4%. And yes, we can relitigate why the inflation was caused. I think I was early on that, calling for the correction in 2022, predicting a hyperinflationary environment. At this juncture, in order for us to get down to 2, because we've seen a steady 30 basis points month after month, we haven't seen a new paradigm shift in that, right? And we do need to get below 30 basis points. And so we haven't done anything, and I think something more will need to happen for us to have a new paradigm on that month-over-month growth report. Energy has helped us out, and that's been great. It might not always be that way.
Is your point that, I mean, you think the Fed's going to cut this year, but you think it's for the wrong reasons? Or what's the story there?
No, I think that we're more likely to see one last hike before they start cutting. Previous to this, again, I always own up to what I said. Previous to this, I did not think we were going to have cuts this year at all, just because we weren't experiencing enough disinflation. That may change. We've started to see the housing component move, right? It went in October from growing 60 basis points month over month, went down to 20. It's since come back. But this is what could make my entire bearish thesis wrong, is if the housing component moves in a significant way, that will be enough.
Just be careful here. Normally when we come up here, right, we're reaching up here like we are right now. Like the hand of God will come down. Supply, we'll use a blue Smurf right now. Hand of God will come down and slap the market down as we reach up here. So just be aware of it as we get up there. Could be a pretty big reversal at some point. So monetize your longs at some point as we reach up here.
Before that, and that in fact could come as early as March. What do you make of all this?
Well, the idea of the Federal Reserve cutting before 2% is sort of Fed policy. It's something Powell has mentioned. I believe it was policy before Bullard left the Fed back in the summer of last year.
It was policy going back to 1956. Tell them.
Expected. The question has been, Scott, when they might pull that trigger, and that's where the market's been going back and forth. What I think has been interesting is the Fed has been somewhat successful in talking the market out of March. And if you look at the probabilities of March, they're down below 50% now. Those were as high as 80% last year after Powell spoke at the December
USA's
meeting.
Gaza says, I see U.S. crude output growing 500,000
barrels. What's happened both to March. Now, what you do see is that those percentages go up as you get into May and again to June. And I think, Scott, as I've said before, my take on this has been, I think May is a better time for the Fed to hike because I think there may go every other meeting. Powell has shown that he likes every other meeting. I'm a little bit, what's the right word? I guess in disagreement with my good friend Greg Branch when it comes to the outcomes from inflation this year. Inflation has surprised everybody, Wall Street forecasters and the Fed, to the downside. It has come down inarguably, I believe, faster than anyone predicted. Whether or not that continues is an open question. But I don't think you can debate the idea that everybody was on the upside or the wrong side.
Coming in right now to retest. I'm going to mute this really quick. Coming right in right now to retest the prior high over here. Okay, just watch this right now. Coming back in to retest this high. Oh, get rid of that blue hand. So just right up in here. Oh, you can't see this. God damn it.
And save 92%.
Right there. Hold on a second. Just watch this. This is where the sellers came in prior, right here. And we're reaching right up right now to retest that prior high. You want to see us get above that red box right there, okay? If we're bullish, you're looking for not just the retest of this high, but a new high, even if it rolls. So even if we, goddamn blue, even if we squeeze up here, even if it pulls back, you want to see that high tick as a bull. Now, it doesn't necessarily mean bearish, but we're getting nice and up there right now. We're getting close. But as we go up there, you do want to see that new high if you're a bull. It does infer that we have buyers are stronger than sellers right now. So just keep your eyes on that red tick. And then above that, we've got 486.26 as the next target to the upside. Here comes that supply. You see that bar up there on Bookmap as well. You see that bar just showing up right now to the upside. Just right up here. Follow my cursor. There goes your R1 tick, baby. Spaceman 003. Tag it, baby. Take the money and run.
Where stocks have gone and why.
No, thank you, Scott, and thanks for your patience here on the shot today. You know, we've been on record since November of 2023 that the new bull market, in terms of the cyclical part of the bull market, began in October of 2022. Many people didn't realize that until, of course, the market was up over 20% last year. We think this, again, is part of a 25-year secular bull market that came into place in 2009. I'm going to show us the bears some grace, Scott. You're probably going to be surprised by this, but if you think about it, let's take 2 steps back. Since August of 2007, investing has been all about the Fed. That's when the Fed opened up the discount window and effectively started QE. And we continue to believe that there's been way too much focus on the Fed. We've been doing this for a long time. You and I have been talking back and forth for a long time. I remember the Greenspan briefcase indicator. When we'd walk into the 90s, depending upon the thickness of his briefcase, whether or not what the Fed was going to do, then we'd move on. We meaning the Stock Market Society. And the Stock Market Society would move on to picking companies, industries, sectors, and stop worrying about the Fed. I'll leave you with this, and then you can ask me, give my retort. Fed funds futures. Fed funds futures have been wrong for 2 years. For 2 years, they've been wrong, and we have this
because it's gambling.
I actually don't have any clue or understanding why anyone in their right mind was thinking about the Fed was going to cut in the first quarter. I just don't understand that, and that's because of this intense focus on the Fed.
It's gambling, and it's your own that you're pushing.
So guess what? We're running up the wall of worry. We're not seeing the forest through the trees, and we're missing great opportunities and great companies.
All right, so forget the Fed. Let's just
Scott.
Yeah, go ahead, Greg. Please. Yes, you can. Yes, you can.
I think Brian pointed out something that's really important. Even those of us who would like to get away from talking about the Fed and predicting the Fed, we just can't. So take the fourth quarter, for example, right? Remember, that was one of my big concerns of 2023 is that I thought the consensus was just way too high at 8% for the fourth quarter. Well, that turned out to be right, and 8% came down to 1.6% by the end of the quarter. Usually, downward revisions of that magnitude pose a stiff headwind to equity performance, and it just didn't matter because all that mattered was what is the Fed going to do? Yes, inflation is going to come down by itself. That became the conversation. So whether we want to focus on fundamentals or not, this just has to be a part of the calculus for now because it just has
just heads up down here. We've got a higher low on Tesla. Tesla looking to try to make another rip right here.
You know, the Fed needs it to get to. Leastman, I'd
the hourly trigger is currently at 210.11. You want to be above that number to take a long. 210.11.
In the last Fed meeting and the news conference from Chair Powell that he doesn't believe that the economy is too strong at this point to bring inflation down. He thinks it's a godsend almost that the economy has remained stronger than even they thought it would, and inflation's come down at the clip it has, which means they actually might be able to pull this off. And you could feel the confidence exuding from Chair Powell in the last presser, I thought.
Scott, I've been waiting for this moment on television for a very long time. I want to do my very best Bill Maher imitation. New rule. Here we go. New rule. In the wake of a pandemic that was a supply shock, you do not need growth to slow in order for inflation to come down. That's what we've learned. Inflation came down. Growth did not slow. And I will tell you this, Scott, I'm going to put up a graphic here that I believe to be wrong. I have never put up a graphic I thought to be wrong. This one I think is wrong. This is our CNBC Rapid Update. You're going to see two things, a piece of information in this chart. One, economists have had to upgrade their forecast again for the fourth quarter by 1.2 percentage points, again for the first quarter this year by nearly a full percentage point. But the thing that's wrong is, I think that's wrong, is they're still forecasting that slump. That slump right there has been something that's been moving ahead of us 2 quarters in the future, and it's been wrong, 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 and wrong. I don't know that that slump happens again. New rule, you do not have to have growth come down in order for inflation to come down in a post-pandemic period.
Because, Greg Branch, this time is different. That's essentially the argument.
I was going to harken back because I've had this argument off camera with both of you, both you and Steve. And so I continue to disagree, Scott. I think it is only different insofar as the cycle has been elongated. But yes, I won't use the R word, but we must see a cycle. I can tell you why the cycle's been elongated. It's the reason why I was largely wrong in 2023, because not only did we have the great wealth transfer from governments to companies and individuals, which strengthened and fortified the balance sheet probably more strongly and more solidly than many of us anticipated, but we also had the great refinance, which did that as well. And so we haven't seen spending come down, either from a corporate perspective or a consumer perspective, in the ways that one might expect after you have 500 basis points of rate hikes. And we need that in order to get to 2%.
Well, we can move off the Fed, too, and get on to earnings, because ultimately that's what's going to matter probably, at least in the near term, more than anything else. Brian, Greg makes the case that earnings are already not good enough. They haven't started out great, and they're going to prove to be not strong enough to keep this market going higher. You would make the exact counter argument to that, wouldn't you?
I would, just like I did a year ago. And we were right a year ago, and revisions are still pretty strong. And I think that comes from, looking at the market as a total. You have to take a look at the bottoms up side of things, and where you see the contribution of earnings coming in from especially technology and from communication services. And yes, there's parts of financials that have been very strong and don't discount the consumer. So I think that this argument about earnings not being strong, they're just not looking at the right data, just like they were a year ago. And I think it's more building about the bearish narrative in terms of wanting growth to slow. And I just don't see that. We don't see that. We see no analytical or anecdotal evidence of that with any of the earnings work that we do.
But I mean, even Ed Yardeni, who's like a huge bull on the market, is talking about an exuberant melt-up phase that could be underway as we speak. Howard Marks was on the network today, astute market watchers. He's a legend, talking about whether people are too optimistic, that so many things have to go right in order, and these positives, in his words, have been compounding, as if they're all just going to fall into line, Brian, and that's going to justify where we are and why we can take another leg higher in this bull market.
Well, let's look at my forecast, right? $250 of earnings at 5,100. That's not exactly jump up and down, especially given the fact that the market is at highs. I don't doubt we've gotten a little bit too far ahead of our skis here. I wouldn't doubt that we soften up a little bit, but common sense says, especially the second half of the year, as we kind of settle into new valuations and what we like to call year 2 of normalization with respect to price performance for the market being high single digit, low double digit, and earnings growth being that. I just see that the market's probably, I don't disagree, that a little bit ahead of itself, but you still should be an investor. If you would have been bearish, you would have missed the big Apple rebound. And you have to look at individual issues and buy when the opportunity comes.
Yeah, I'm looking at Apple's pushing back towards 200. I'm glad you mentioned that as the NASDAQ extends its gains. Microsoft pushes closer to $3 trillion in market cap. Gentlemen, I'm going to leave it there. Yeah, okay, go ahead real quick, Steve. Real quick.
I was just gonna make one small point, which is that I think it's possible for the economy to do well and it be a challenge time for margins this year. I think this is a year of consolidation where companies had high and rising prices last year. Hopefully this year they have at least stable, maybe even falling prices. So I could see this year being a year of consolidation before better profits in the year ahead.
It's interesting you say that. I mean, Adam Parker has made the case multiple times on this very program that this is going to be the year that margins hold up and margins do well, and that's why he's turned probably a little more bullish than he was in a handful of months ago. Gentlemen, thanks so much. I loved it. Thank you very much, everybody. Brian Belsky, appreciate it. Steve Leisman and Greg Branch. We'll see all of you soon. Let's send it to Christina Partsinevelos now for a look at the biggest names moving into the close. Christina?
Well, let's start with D.R. Horton. Those shares are dropping after the home builder posted weak quarterly orders. Keep in mind that at the beginning of that particular quarter, 30-year mortgages in the United States were around 8%. That's a two-decade high. So the company promised to reduce home prices and increase incentives to
Sunday
encourage
never
sales,
ends.
yet the
I was
stock is
thinking
down
about
9%.
if I'm like,
From price
if I'm
cuts to
not
price
on
hikes,
stream
Procter &
during the
Gamble
day, what
shares
I'll
are
do
rallying
is
higher after the company reported mixed second
when I
quarter
start
results.
chatting, I'll
The
do
consumer
this
staple
thing, like,
stock
so that
saw
somebody's
net
got their
sales rise
screen muted.
3% as
This
revenue
would
was
indicate
boosted
that I'm
by
chatting right
price
now, and then
hikes.
try to,
The company
when I-
also
if I
narrowed
can
its
remember,
full-year
turn that
outlook
shit off.
for its adjusted EPS, and you can see shares are above 4% higher.
So
All right,
maybe
Christina,
I'll
we'll be
put
back
it
in shortly.
maybe
We're
I'll
just
put it
getting started.
here
Up
or
next, your
something.
Netflix setup. The streaming
If you hear me
giant
chatting or
reporting
something,
earnings
you're
in
like,
OT.
I don't like listening
Big
to
Technologies'
CNBC.
Alex Kantrowitz and
I'll,
Odyssey Capital's Jason Snipe. He owns that
I'll just
stock.
post maybe
They're
like a
both standing
live
by to break down what they'll be
logo or
watching
something
from the
like
report.
that.
We're live from the New York Stock Exchange. You're
Well,
watching
so I'm going to
Closing
try to
Bell
get a better
on
one. I don't
CNBC.
like that one. Let me try something different. I don't like that fucking thing. I'm going to get one better here. I'm going to remove that thing. I mean, let me work on a different one really quick. I'm going to try to do a logo that'll like pop up if I'm chatting. So if you want to mute your, like unmute your TV or something, you'll see the microphone going or something like that. Yeah, forward PE ratios aren't that bad right now. They're pretty good. I was looking at them for S&P 500 recently on the show, and forward PEs are in line. We're not at any extreme valuation to the upside or anything like that. It's fairly well priced. The market's fairly well priced right now.
The trial.
We're back. Netflix preparing to release its Q4 earnings tonight in overtime. Investors will be looking for an update on the company's progress in cracking down on password sharing and interest in its lower-priced ad-supported subscriptions. Netflix announcing this morning it's going to begin streaming WWE's flagship program Raw next year, its first major foray into live sports. Let's bring in Big Technologies' Alex Kantrowitz and Odyssey's Jason Snipe to discuss. Both are CNBC contributors. Jason is the Netflix shareholder, and I'll get to you in just a second, Jason, but to you first. Alex, this first foray, as we said, into live sports, is that what you expect it to be, the very first of a bigger one?
Oh, yeah, I would say Netflix is already committed to live sports. They're doing WWE, they're doing Formula One, which you could call a sport. They're doing tennis, right?
They're doing the big tennis.
So they have this cash advantage against their rivals. They have to exploit that. And when you think about where they could be overtaken, right, you have Peacock spending $110 million on one playoff game. It's sports, it's live events. So I don't really see this as a one-off. This is the beginning of a program, and they're just going to keep doubling down from here.
Is it the right move?
I love it, honestly. This is the thing that's going to attract large audiences. It's not the hit business, by the way. You have sports. Let's say you do football, right? You can depend on that audience. They're going to be with you week in, week out, as opposed to a show that may or may not, hit. So I love the idea. It's a moment where the competition is weak. Netflix has this lead. How do you exploit it? This is the one area to go for.
Jason, does the shareholder like this?
Absolutely. I couldn't agree with Alex anymore. I think, it's a low-stakes deal. I think sports is a holy grail, I think, for a lot of folks. It's the only reason they're still attached to linear TV. It's a $5 billion deal over 10 years with an opt-out in 5. And I think they're able to attract a new audience. Again, from a distribution perspective, there's 250 million users. So there's opportunity to cross-sell. And to Alex's point, I mean, Breakpoint, great. On the tennis side, Formula One, they've already been in this space. So I think this is just the next continuum for them.
The street, Jason, seems to be a bit lukewarm going into the number. Now, a lot of that probably has to do with the fact that the stock has rallied so much. The average price target on Netflix shares is barely above where the stock is trading now. So what does that do to where expectations are going into the print?
Yeah, Scott, without a doubt, expectations are extremely high. If I look at the net sub-ad guidance for last quarter, it was a little over 5.5 million, and they produced 8.7 million. So now we're above 8, in terms of guidance, and we're likely going to be slightly above that. I mean, they're guiding right around there. So expectations are much higher. Again, to your point, the stock is up 20% in the last 3 months and 37% since reported last quarter. So it's moved a lot. This is important news, I think, today. But, the stock moves. I mean, it's been very volatile, obviously, as you know, through earnings, when they report.
Yeah, I mean, it was $700. Let's not forget about that, right? You always have to keep that into perspective when we look at these shares, Alex. So what do you make of what the stock has done, what that does to expectations going into overtime tonight?
It's in a weird position because it's still more than 20% down from its pandemic highs. But that said, it's had this large run up, and it's trading at an expensive multiple, right? So if you think about whether investors will rotate out of tech, like what's the first one you're going to try to move money away from? It might be Netflix. So I think there's definite risk there, and there's definitely been this run up on the stock. It's very expensive.
We know that the pickup of the ad tier, the less expensive version for subscribers, has been slow. Does it remain that way? Do we have a meaningful increase in subs or not, do you think?
Double-edged sword for Netflix on the ad tier. Now, there's a lot of hope, right? They've added many, monthly active users on the ad front. That doesn't correlate one-to-one to subscribers because you have many active users in one family. That's one subscriber. That being said, their ad load, according to reports I've read, according to a personal experience that I've had on the ad tier, is low. They're not selling through the ads at a rate that you would expect them to. So you could say that's going to be one or two things. One, it means that Netflix is just bad at selling ads, or two is that they're in the early days and they need to get a sales engine up and running so ad agencies are comfortable buying. And if they get to that point where ad agencies will buy, then you could see much more revenue come through the ad product. And very interesting thing that I just read is that the ad user might even be worth more to Netflix after they've watched the ads than the subscriber user, maybe something like $20 per user versus $16. So if they can fill those ad spaces, that's really, really good news for them.
Jason Snipe, live sports aside, do they have the new content to continue to add subs the way that you would like to see happen? I should also note this news, of course, that was, in the last handful of days, the film chairman is leaving that company to start his own venture. How are you thinking about what content they have and the ability for that to bring in new people?
So I think the content library has been rich for some time, and I go back to they're the leader in streamers. Again, 250 million subscribers. And when I think about creators, looking for distribution channels, I think this is the platform that's most attractive to them. And I think they are better positioned than the other streamers. And of course, the strike from last year is a headwind from all the streamers, but Netflix did a lot of content spending prior to, and that's why their free cash flow continues to grow, because they haven't had to spend as much money as of late. So I continue to like the content library, and I think that's an opportunity for them.
End it with your comment about that as well. Same question, content.
Yeah,
Good enough?
Oh, yeah, I think so. Everybody else has had to deal with the situation, and I've long thought that Netflix was in the best position to handle it because they have great reality television program, a bunch of great fun dating shows, Love is Blind, for instance, and then they're also heavy on the documentary front, and people are watching those documentaries. One about Boeing is getting a lot of buzz, and so I think they're very well positioned in terms of programming.
We'll leave it there, Alex. Thank you very much. Jason Sniper, thanks to you. We'll see what happens in overtime, so do not miss that earnings report. Up next, gaming out the Fed. Vantage Rock's Avery Sheffield is back. She's mapping out when she's expecting the first cut. We'll give her take there, what she thinks about this record rally in the stock market as the S&P extends its gains now. 48.61, NASDAQ higher too. We're back right after this break. Whoever I told earlier to take the money on that S1 or R1, congratulations. I don't know who that was out there earlier, but if you took your money and ran, congratulations, brother. Spaceman 003. If you took the money on that trade up there at R1, burr, baby, burr. I think Spaceman 003 on Twitch is like at home right now, stoked. Welcome back. The S&P 500 on track to hit another record close today with some modest gains. Investors digesting the latest batch of earnings, looking ahead to economic data later this week. Joining me now, right here at Post 9 with her outlook, Avery Sheffield, co-founder and CIO of Vantage Rock. Welcome back.
Great to be here.
It's good to see you. So S&P positive. Dow's still negative, but it's working off the lows. Even the Russell just went positive a moment ago for a second. We all good with this rally?
I don't know. What I do think is clear is that I think that they're, given the levels of the market and where we're at, S&P for 20 times earnings, NASDAQ 28 times, I think it's going to be like more of a show me story for especially those more expensive stocks in the market. But there's still a lot of stocks that are dramatically less expensive than that, with very negative sentiment still built in, that really could have the opportunity to really surprise to the upside this earnings season and throughout the year.
We had a highly regarded wealth manager on, you may know her, Cheryl Young, yesterday. She said, look, she's positive on the market, but she said we're priced for perfection. Right
exactly.
Now. You agree?
At a market level, it feels that way. I mean, certainly you can go back to the late 1990s. I mean, we can S&P multiples, NASDAQ multiples, if we get into stratospheric levels, it's certainly absolutely possible. But I think there are a fair number of stocks that are much closer to like being priced for perfection. Actually, maybe even trading at more of those stratospheric valuations. But I think the really interesting opportunity in this market is those companies that are less expensive, that have the opportunity for earnings growth to surprise to the upside over the year ahead.
Out of the S&P 493, you're obviously referring to.
Yes, but but
Tesla can't catch a break to save its life.
Those stocks actually, most of them are, I think, have the potential for nice earnings growth. Is it priced in? We don't know. But they are not, and I've said this before, like they are not the culprits of most of them are not the culprits of the, I think, excessive valuations that we see elsewhere. So there are some of those names that you're probably fine with. Do they have the most asymmetry to the upside, though, to your point? I think those probably come in the other 493.
Yeah. What do you especially like? Which part of the market? If we get even more granular, let's pick some places to look.
Right. Well, one place that we really like is telecommunications. With Verizon's report this morning, really reinforced our thesis that these companies have become just much more stable cash cows than the market had appreciated in the past. And with Verizon trading at over a 10% free cash flow yield, over 6% dividend yield, with churn down or churn stable, with them taking price increases, with having to give fewer cell phones for upgrades, really suggests the free cash flow will expand in the year ahead. So you have that stock compared to a Walmart, which has years where, some years they can grow earnings nicely, other years they grow earnings a bit, trades at 25 times earnings. Like there's a lot of room for valuation expansion. What's going to happen to the Fed? What's going to happen to the economy? I don't think it's really going to have that material of a difference on Verizon's earnings, and you've got a really cheap stock.
Ford and General Motors, you like those?
Yes. We do also like autos. So in a portfolio, you have, a spectrum. You have kind of your bond-like characteristics, stocks with more bond-like characteristics, stocks that have some more cyclicality. But what we really like about them and the companies we like in general is that they have the opportunity, and they're not just the opportunity, they are executing on their company-specific business plans, taking out costs, improving product, with an overlay of if things actually get weaker, rates go down. What happens when rates go down? Cars get cheaper for people to buy. So they kind of have a backstop if things do get a bit weaker. At the same time, they're both taking out meaningful costs. We expect that, we will probably see more of that to come. And the push out of EV adoption really gives them more time to build that out in a more cost-effective manner, develop products that are very competitive in the market, and at the same time have the benefit from their cash cows of, really the larger SUV vehicles, in the case of Ford, also commercial vehicles as well.
General Motors with the buyback, and they've cleaned up the balance sheet.
Yes, 25% of their stock is expected this year, maybe 20% next year. It's quite substantial, trading at under 5 times earnings.
Give me your idea, though. Let's go back to where we started with mega caps.
Yes.
Are the valuations crazy? No. Do you think the earnings are going to live up to it? Are we in danger of thinking that more broad market is actually going to be narrow again? And if so, so be it?
So I think you have to be very stock specific on these, right? So you have in the communication services area, you have, 2 of those companies are trading at multiples just over 20 times. Not that much more expensive than the market, like less expensive than the Nasdaq.
You own any of these, by the way?
Moats. We do own some, so I want to, yes, I mean, in particular, we like Google and we like Meta because we think they have franchises. A lot of people are wondering about Google's franchise with search and AI, but we think that they are going to be a massive AI beneficiary as well. Meta, I mean, Meta, I think what people might miss about it, or maybe why it's not as expensive as some of the other stocks, is AI enables them to have more rapid adoption of free content creation, right? Their whole business is based on free content creation. Well, now if my 9-year-old can create content with AI that's sophisticated, she's going to be posting a lot more. Not that I let my 9-year-old post,
right.
But
bullish taste on 9-year-olds posting. All right.
No. But the people who post more, there's going to be more content generated. They can advertise on that, and they can use AI, or they are using AI to have very efficient advertising. And I think with cookies going away, you are going to see the networks have more and more power because they have the ability, they have just more inherent information about people to make ads much more effective.
It's been an incredible, peak and valley and peak. I should probably better say for Meta shares. Worst year ever in 22, best year ever in 23, and it brings us to now. Speaking of now, the whole debate around the Fed, how many cuts we get, when we get the first. What do you think?
Yes. So what I think is there's just a lot of reflexivity, right? What we saw when I was actually last on the very beginning of November, I saw things are really getting bad. Gosh, I mean, it used to be bearish, but actually things were getting bad. Rates came down, and that was very stimulative. So now we have the benefit of the loosening of financial conditions we've seen since then. We've had interest rates come down, which is buoying the economy, right? The data points I'm seeing now are actually much better than they were in October.
Yeah.
So the question is, if things start slowing again, do we start anticipating rates go down again, and it's just a little blip, because then that buoys the economy up. So as we are now with the buoying we've had, March, unless there's some event that's unforeseen, it seems way too early. June is far enough out. It's certainly possible. I mean, real rates are near 2%. I mean, in the past, historically, that's been restrictive by itself.
Mic check,
but
check
we're not
one.
living in a by itself world, right? The market is giving votes to loosen conditions to
My
make
desk
things better.
I look like
which
I'm not
then
actually a
means,
coder,
I
but
think the easy money and kind of
my
assuming
desk
rates
looks
are going
like
to go
I'm a
down
coder.
quickly, it's probably been made
Hold
from
on a second here.
Is there opportunity? Well,
Can I
is
check
that
the
likely to
camera on
happen
or whatever?
maybe over
Let's see what's going
time?
on.
Should the market not, propel things higher?
go. You got
Certainly possible.
All right. Well, we will follow up. Thank you. Posting okay. Moderation is the key for posting. We can agree on that. Avery Sheffield, thank you.
My pleasure.
All right, up next, we are tracking the biggest movers as we head into the close. Pippa Stevens is standing by with that. Hey, Pip.
Hey, Scott. One industrial giant is sinking as consumer spending slows. We've got the details coming up next.
One quick second here.
2 million to the sell.
What do we got going? I got meet that thing back there.
Do you want to stay up to date with the latest
There.
non-farm payrolls?
That.
Then sign up today and get our special offer of Financial Use Pro. For
Yeah,
a year's
turn that
worth of
off.
our service for the
Okay. Turn that on. Hold on here. Says it's delayed. All right. Oh, wait a minute. What am I doing back here? I'm fucking this all up over there. Turn that off. Break time. Be right back. Turn that bad boy off over there. Okay. So we're going to take some looks around the market here really quick. Should I just look at Netflix here, maybe? NFLX. That's the big boy, right? Let's take a look at NFLX. See what they're talking about. What they're talking about. A Netflix 1-minute chart right here. Just riding up. It's a daily trigger right now. This is Netflix. Looks good. Be careful in the last few minutes. You might see some profit taking up here into the close the next 15 minutes or so. You guys already have my take on what to expect at the end of the day on this one. We're going to switch over to, I believe, hopefully I'm doing this right. Yeah, we're going to switch over right now to the main chart trigger screen. Oh, hold on here. Can I put my camera up in here? Webcam frame. Bam. Camera 2. Put my ugly ass mug in here somewhere. Put my ugly ass mug. There we go. Does that work? Where does this work best? Oh, yeah, dude. I feel like I'm in a 4-way gangbang right now with bulls and bears. This is a good feeling right here. I like this. Oh, yeah. Okay, yeah. Hold on a second here. What are we saying that? Earmuffs for the kids at home. Is that right or is that off? I think that's off. I'm kind of wonky on this shit. I don't think that looks right. I can't see shit on my side. Good enough for me for right now. We'll take it. What is this called when you get torn from limb to limb if you're in a cowboy and you did something wrong? Okay, so let's take a look here. Let's take a quick look here. We got this. This is S&P 500 right here at the top left-hand side. We had a nice positive bounce down here in the hourly trigger. We reconfirmed it on the half-an-hour trigger. Got the second leg up on SPY in the 1 minute. We're going to pay close attention to this as we come into the bell. I'm going to show you guys some trades if you are trying to synthetically trade. Move that one right there. Synthetically trade this close at 4 p.m., right? We're going to look at Netflix right here. This is the Netflix chart and see how this bad boy does, how this thing runs or gets sold. I have a really sneaking suspicion that Netflix sells on their reports but then blasts off on their you're seeing a little bit of just profit taking into the bell here on Netflix right now, not to be unexpected or anything like that. No shame in taking profit on their ER report. We're going to bring that lower here so you can have a bird's eye view on Netflix. That right there, I guess. That'll work. And then we'll do the SPY 1 minute chart over here. We'll bring that one over and drop this bad boy down because I want to tell you guys something right now. It's an important thing, okay? Very important here. Any kind of news, or how do I say this? I could put it a better way. So when they come into earnings, right? The 1 minute chart on Qs right here. Whenever you come into earnings, you can usually get a pretty good read with the triggers. It doesn't, by the way, in ISRG, personally, I'm bearish on ISRG. Looks like exit liquidity to me. So going into this event, this is a weird part about the triggers. Like heading into this event, I'm pretty fucking bearish here. Okay. Now, if they have a great report and it's outside of the expected, it's gonna moon, and there's nothing I can say about being bearish on ISRG on that, right? Events tend to do some really crazy shit here on the triggers, so just be aware of that. You're just watching this little bit of weakness here in Netflix into the close. This doesn't shock me at all. But like normally I'd say, yeah, you buy the dip here on this hourly and half-hour trigger. But with news coming, it can null that whole entire thing. So this only goes so far. But it does help with expected moves. So if you have an expected upside and downside move, they line up with an hourly trigger, a daily trigger on the down or upside. That can help in a good way for targets and alignment. Then the other way I'd do it is measure it. If there's no triggers underneath, I'd measure the previous highs to look for a target and the expected move that's priced into the marketplace. So we're gonna take. Oh, there you go. Look. Ooh, what's that? Qs, dude. Look at Qs right now. 351 squeezing again on Qs and SPOOs right here. Some hedging coming off the market on the equities market. You know what? I'm watching this right now, and I'm wondering if people are catching the hang of what we're doing here. This is abnormal to see this hedge come off into the bell. This looks, oh, man. You know, that's why I don't hate doing the live stream. I'm serious. Because we used to push this narrative around saying, you synthetically trade these tech reports at like 4:01 to 4:15, and you blast out these fucks. You blast these motherfuckers. Sorry, I'm gonna be swearing here. Like you blast these guys right in their ass for like 15 straight minutes. They get triggered out of their short on the market. Even if we're gonna roll down, I'm gonna tell you, if you want to short ERs, right, like actually short them, it's always better to wait until after the bell. And right now, this looks like a hedge coming off the market into the close here to me. They probably caught wind of this shit. I'm being honest with you. There's some real people that watch this shit, and they know what we're doing. We talk about it on Twitter. You synthetically trade. And right now, and that's abnormal. I don't normally see the hedge come off the last 5 to 15 minutes before the close here. So this looks like if you're like trying to be short SPOOs or Qs, you give it a minute. You wait until after. You wait until that news drops, and then you slam the sell button. Oftentimes, you'll see weakness into the close. Then at like 4:01, when the report comes in, it just fucking rips faces off. Calls going from like 10 cents to $2. Maybe not $2, but like $1.50, $1.40, $1.30. Craziness like that. So we're gonna take a peek. We might have. My point here is that once they find out what you're doing, they defeat it from you scraping their hands in their pockets, the little pennies and quarters that they have. So we're going to take a quick peek here. I'm going to take a peek at my account here. And we are going to look at what? SPY, baby. And I like SPY personally, but you might like a different way to do this trade. But take a quick peek right here. It looks like we already have the move, the initial move before the close here. Now, if you're going to take these trades, oftentimes I like to take them in the money, but they've already priced in 69 cents on 484, excuse me. Now trading down to 65 cents, but I'm keeping an eye on this one. There's also 541,000 calls on that strike as well. Interest on those calls, on those zero dates. So we'll keep an eye on it right now. And I like something a little bit more in the money. If you're not quick enough, also remember here as we come into this close, that if it's not in the money, let's say it's like trading 12 cents and it goes to like 70 or 80, it'll go right back down to 10 or 12 cents. Something a little bit more in the money will hold a little bit longer some of its value. So if you're gonna, let's say you're gonna be like, yeah, you know what, Cap, I'm gonna buy 485 C's. I'm super bullish here, Cap, into the close. And let's say you buy those 45s at 19 cents. That's what they're trading right now. I would put the upside limit sell. Either market, if you're too scared, market will trigger that sell no matter what the price is and get you out of that trade, or a better chance of getting out of that trade. Or if you do a limit sell for the upside move and just go like, if you and you got to plan this out in your mind. If you're like, okay, I bought at 19 cents, I'll be happy, or I think we're gonna get 80 cents. Take the money at 60. So even if it blasts to 80. You're likely going to catch that fill, okay? So blast 80, you're cursing. I didn't pick the 80 cents. I picked 60. I should have waited and just hand close them. Sometimes when you go to hand close that shit, you still don't get the fill. And I'm not going to name the fucking broker that's done that to me, but last fucking 3 months or so, I've watched the order flow right in the goddamn chain not fill my ass. That shit pisses me off. So there's like funky number magic going on, right? And I've had that happen on large, big trades in the past, like $160,000 trades, not wanting to fill that shit. I got to go even below the bid ask to get those fills, like low enough, even below. So be careful when you're trying to close these positions as we head into this close. SPOOs right now just blasting up. $1.07 on 484s right now. 45s trading 26 cents right now. Squeezing higher. Notice how the calls that are not in the money are not doing as well. The 44 is now trading 90 cents right now. Blasting 90 cents right now. 43 is trading $1.86, $1.87 right now. Nice little squeeze right there before we even get into the bell. 4 minutes left. Just slapping it right now. Huge move there in the options chain on zero dates right now on SPOOs. If any of you out there, I'm going to look for Netflix ER reports as they drop. But if any of you have them before I do, don't hesitate to drop those inside of the chat here. And I haven't even confirmed to see if they actually report right at the close. I could be wrong all day long on this. I think I remember them reporting right at the bell. So yeah, I'm on Twitter right now I'm looking up NFLX posting. Is that what I'm supposed to have? Like a big blackboard behind me? Wear a fucking ill-fitting button-up shirt with a parted fucking haircut from New York or some shit and fucking say, trade the clothes with me? Get fucked. I'm never doing that. You got a regular guy here. You're never getting some fucking some fist pumper. I don't understand the fist pumper look. I guess that does sell seats. You guys trust people when they wear suits and they have greasy haircuts and shit like that? Fucking people. I can't believe they do that shit. I got to show up to the stream one day dressed like that. I'll put one of my suits on for you and I'll like unbutton the fucking top collar, couple buttons down. I won't shave my chest either. I'll let it grow out a little bit. Spray some fucking Soul Glow in my fucking chest hair. I can get a glisten, shine a little fucking, what are those little lights that the streamers use, the circle light on it, so it's highlighting the glisten on my hairy chest. I'll break out the erase boards behind me. I'll be drawing a bunch of big shit. I'll have a script all lined up for you so I sound like I'm smart. Have a teleprompter reading it to me. Like, that guy can recall a lot of cool shit. He's like he's reading it off the Investopedia website or something.
Netflix's fourth quarter 2023 earnings and South Korean consumer sentiment.
Oh, yeah, a fucking pinky ring. Have my bros on with me. Just start sucking each other off right on stream. That shit sells just like Bear Doom. Why are you following that guy? He's got a fucking greasy haircut. He's got parted on the side, high and tight. He's got a tubatan. My kind of guy. Look at that gold chain on him. He's got to be rich. Call that new money, by the way. I like the pinky ring. It's the rock inside of it. Oh, look at Netflix. Oh, hold on here. Oh, Netflix, baby.
Seeing Netflix's fourth quarter earnings.
So far, no response from Spoos. Netflix off the charts right now.
That's a beat.
Squeezing all up, trading 505. Now hitting the downside, getting everybody's stops right now.
$2.11. That's a miss on estimates of $2.19.
Not a huge reaction right now inside of Spoos. Spoos trying to go no. Netflix just blasting.
That's a beat on estimates of 8.91.
Beats, baby.
Operating margin 2024, 24%. A beat on estimates of 22.7%. Netflix says it's not interested in acquiring linear assets.
Woo!
Sees 2024 free cash flow about $6 billion.
Slamming, baby!
Estimates of $6.03 billion.
Oh,
UCAN streaming paid net change
Netflix!
$2.81 million.
Dude, Spy, what are you doing? Look at Q's off the charts right now.
Streaming paid net change $2.91 million. A beat on estimates of $2.08 million. Netflix sees first quarter revenue of $9.24 billion.
Setting the stage should impact every other tech stock heading into their ERs coming up.
Cash spent on content
trading 525 right now.
$billion.
Someone's saying fuck you on Spy.
$8.83 billion. That's a beat on estimates of $8.71 billion.
44C's trading $1.06 right now. 45's trading 22 cents.
First quarter EPS at $4.49.
43's up above $2. Come on, Spy. Take off your hedge. Netflix mooning right now. Straight up mooning. Trading 528 right now. Banging right now on Netflix.
And South Korean consumer sentiment. At
Watch them let the hedge off spoos at fucking 415 here. Oh yeah, pay those fucking calls on SPY right now. Pay him before 415. Woo! Bears in shambles here, in shambles, having to rethink at least the next few days until the rest of the big tech companies start reporting. Oh, you're going to bring out the FOMO bulls. FOMO, you know what I mean? This is definitely not the tone. Definitely not the tone that bears want to be setting into the rest of the reports. Woo! Tesla in the background here. What the fuck is Tesla doing? God damn you, Tesla. What is that? Tesla's like, I'll go up a how about 50 cents? I'll give you 50 cents right now. In the after hours right here. Tesla, no real response from Tesla right now. Q's did pretty good. S&P, dude, look at this fucking hedge in the market right here. Disney popping right now. Yeah, that's right. NerdRx saying the right thing right now. I know, dude. Fuck you, Tesla. But Disney's a great trade to take with Netflix. Netflix reports well. Disney and the rest of them should as well. B Harder's like, screw E-Trade. I auto-sold my SPY. Ryan Morris checking in. Print my calls, baby. Financial Juice saying Netflix Q4 earnings EPS $2.11. Estimates of $2.19. Revs $8.83 billion. Estimated $8.71 billion in revs. Streaming paid memberships 260.28 million. Estimated 256. Beat there. Streaming paid net change plus 13.12 M. Estimated plus 8.91 M. So a beat there. They're looking like they're growing right now in users. APAC streaming paid net change plus 2.91. Estimated 2.08. UCAN streaming paid net change plus 2.81, estimated 1.76. So they look like they're growing with paying customers. Sees Q1 rev 9.24.4 billion, estimated 9.28 billion.
Do you want to stay up to date with the latest?
Sees Q1 EPS as 4.49, estimated 4.09.
Special offer.
Sees 2024 free cash flow about 6 billion, in line at 6.03 billion. Sees 2024 cash spent on content up. Woo! That's a big number. 17 billion. Oh yeah, here comes the take the money and run phase of Netflix here. This is where if you're long Netflix, you take the money and look for a dip to buy. Not too bad. And I was bearish on ISRG, and they look like they're squeezing up into the close here as well. They had a high target of 377. They were trading into the bell 371, so congrats on ISRG. Muted response from Q's and SPOOs. Excuse me. Into this close, I've got a ton of stress going on right now heading into this launch for the website. Remember, sign up for the free membership over at tradethetrigger.com, and you will be the first to find out any of the hype campaign that's going to be launching for a projected January 31st, February 1 launch of the website. Thank you for joining us today. I will check back in with you guys tomorrow at 9:30 in the morning. The stream will be up. I am I have my arms tied right now trying to work on a new Discord and a bunch of other meetings and crap that I got to do with a bunch of other important people that we have like little loose ends, T's to cross, I's to dot, that kind of stuff. So I have to make myself available as we roll into this projected launch. I appreciate you all showing up with us today. Hope you made some money on some zero dates into this close. We saw the ramp early before we got there. Looks like they took their hedge off early. Good thing to them. They look at them. They want to put their hedge back up. We did tag that nice red bar to the upside on SPY. I will see all of you tomorrow, baby. Tomorrow. You know, you're going to hear, you remember, right? CNBC, if you get a miss, a big miss, CNBC will roll out the red carpet for doom and gloom down the road. But Netflix here, some of their report was a miss, but a lot of their report was very positive, forward-looking into 2024. So I'm going to assume that their guidance is going to be pretty good here. So I'll talk to you guys tomorrow at 9:30 in the morning. You're not going to get the doom and gloom this time. So I guess you're going to get some people on FinTwit try to spin it. But right now, you definitely don't have the noise that expect bad things from ER. That looks good for Tesla, I guess. Or so someone's going to try to push that narrative. I will see you all tomorrow, 9:30 in the morning, baby. Remember to like these videos, man. Hit that like and upvote button. I appreciate